Before we start this video, do like and subscribe to our channel and not miss on any updates.
This is case study number 19. Case study number 19 is extremely lengthy to look at. देखो यहाँ से it's getting started. It will keep going on. 5 pages, 6 pages, 7 pages. So it's a 7.5 pages का case study. Okay. So we have to cover two questions from here. So first is your MCQ number 1. We will not be going through the entire case study. We will read the questions. Okay, Faiz is saying 2 more case studies. We'll try to solve this question first, and then we'll see if we have time or energy. We'll go on to one more case study. Okay, let's look at this particular multiple choice question. Whether the concern of the company secretary holds good in including a woman director in the board of directors. In today's session, woman director is coming third time. Now please tell me what is the section number. We've discussed it 2 times already. Women director. 149. 149. Okay. Faiz is saying just kidding. Okay. Okay, 149, correct. Composition of the board of directors. Every listed company has to have a woman director. We had discussed the prescribed limits also, right? Now here, the question says whether the concern of the company secretary holds good to include a woman director in the board of directors. So we'll just look at the facts of the question also to see what is this company secretary saying. Okay. So see, it's such a big 5-page case study. Generally speaking, in such case studies, the details relating to company law or directors is covered as a paragraph. Maybe sometimes in the middle, sometimes at the extreme end. So we can simply just go through this case study to see, okay, this first part is not relevant. It talks about manufacturing, opening stock, etc. This is again not relating to company law. And then we have got details which are relating to taxation. Then we have got another form which is not relevant for us. So like that, you can just scan through the whole case study to find the facts. So only these company law facts are covered in the extreme end. Let's read. Surya Limited is considering to get itself listed. So it's not listed as of now, but it is considering to get itself listed. As per the latest audited financial statements, the paid-up share capital of this company is 90 crores and turnover of this company is 275 crores. This is relevant for us. This will tell us whether this company needs a woman director or not. Now, the company secretary of Surya Limited is insisting the management to include a woman director in the board of directors as per the Companies Act. You are required to analyze. Now, should this company have a woman director or not? We'll have to check section 149. Section 149 says that following prescribed companies should have woman director. That is what? Every listed company should have woman director. Then every public company that has paid up share capital of 100 crores or more or turnover 300 crores or more should have a woman director. Now here the paid up share capital is 90 crores. It is not 100 crores or more. So that condition is not satisfied. Turnover is 275 crores. If it is 300 crores or more, then the condition would have been satisfied. So both the conditions are not satisfied. This company is not yet listed. It's not even listed. It is going to be listed. Now tell me, none of these 3 criteria are satisfied. Is this company required to have a woman director? Yes or no? Should this company have a woman director? Yes or no? Dheeraj says no. Anybody else? Should this company have a woman director or no? Okay, so this company is not required to have a woman director. So accordingly, we are going to select the option. Yes, Surya Limited is thinking to get itself listed. So if it's thinking to get itself listed, doesn't matter. As of now, it's not listed. So this first option does not apply. No, as Surya Limited is not listed on the relevant date. Okay, but other points also have to be covered. Yes, as it is mandatory to appoint a woman director. That's incorrect. D option, no, as Surya Limited has not met the prescribed criteria to get a woman director included in the board. Now, option B or option D, which is more accurate? D is more accurate. B simply covers one point, that it is not listed. There are two other criteria also. No? The turnover criteria is there, paid up share capital criteria is there. So D option is more accurate, as it says it has not met the prescribed criteria. So it is a broader answer. Okay. Okay. Moving on to the next MCQ. MCQ 2. Whether Surya Limited has defaulted in conducting board meeting as per the Companies Act. Okay. Board meetings. When the board meetings have to be conducted, it is covered in your section number 173, meetings of the board. So for that, we have to, before we read the options, let's look at the facts so that we can check if 173 is complied with or not. So Surya Limited has conducted the following board meetings. It has conducted these 4 board meetings from 2nd of April till the 15th of March. So they have given us from April to March. They have not given us for calendar year. They have given us for the financial year. The 4 board meetings that they have held. Okay. Now, based on that, we have to check whether section 173 has been complied, whether the board meetings are as per the Companies Act or not. Section 173 is not given, that you have to find out. Okay. So section 173 says that first board meeting should be held within 30 days of incorporation. That's irrelevant for us because this company has been incorporated long back. Subsequent board meetings, at least 4 board meetings should be there in every calendar year. And maximum gap between 2 board meetings should be 120 days or should not be more than 120 days. Okay. Now, what are these dates of board meeting? We'll have to individually check. See here, this first part, minimum 4 meetings in a calendar year. This we can't really check because they have not given us for the calendar year. They have given us meetings for the financial year. So this we can't check. But broadly speaking, let's say if in a financial year they have done 4 meetings, roughly, we can estimate that, maybe before 4th of April also, they must have done at least 1 board meeting. So this, we cannot really check this. Okay, so let's try to check if there is, let's check this second criteria. What is the maximum gap between 2 meetings? So when we say 120 days, it's basically 4 months. So do rough calculation. Okay, so see, 2nd April till 26th of July. April ke baad April, May, June, July. This is still less than 120 days. Okay, you can do some calculation. Now this 26th July to 27th of November, here the gap, if you try to calculate, this calculation will come to more than 120 days. So here the company has done some, like it has not followed the provisions of the Companies Act. Then next we have to check the gap between this date and 15th of March. Here again the gap will come to less than 120 days. Okay, so just in this 1 board meeting, the company has not complied with the provisions of the Companies Act because the maximum gap is more than 120 days. Got it? So accordingly, we'll have to select the correct option. Let's see. There is no default in the 4 board meetings. That's incorrect. There is default by Surya Limited as not more than 4 board meetings have been conducted in a year. Now, see, this we can't quite answer. So let's put it on hold. Let's put it as an option. There is no default since the Companies Act does not prescribe any criteria for board meetings. This is absolutely incorrect. There is a default by Surya Limited since board meetings have not been conducted in the prescribed frequency. So we'll have to select one of these B or D options. Okay, but the more accurate one seems this D option. Why? Because D option is broader. It covers all the criteria. It covers the gap wala thing also. It covers the 4 board meetings in the calendar year also. Okay, so therefore we'll select the option which is covering the majority of the options. That means basically it is more accurate compared to B. B we cannot quite check. Okay, is this satisfactory? Are you satisfied with this answer? Yes or no? Or do you have a doubt? Dheeraj says yes. Okay. Okay. So this, I think, let's keep today's session till here only. We have covered today how many case studies? We've covered 5 case studies from the study material. Then from the from the case study digest, we have covered case study 2, 17, and 19. 3 from there. So in total, we have covered 8 case studies, which is good. Hopefully, in all the upcoming sessions, also every session I'll try to cover at least 8 case studies to 8 to 10 case studies, because that's how we are going to be completing all the case studies. Okay. Okay. So let's wind up the session. Do you have any questions today? Any questions? Random questions? Chat before we close the session. If you have to talk about anything, you can. Any questions? Any questions? Can you share the case study files? Okay, I'll ask the team to share the case study files with the solutions. Will you share any summary notes? Yeah, mostly they will be shared with you. I'll check with the team and let you know. Please hide the answer while discussing the case study. Okay, sorry. Next time, pakka. ठीक है? Okay, I suppose that is it, है ना? Okay, so I'm going to be seeing you day after tomorrow now. Tomorrow you will be having a session, just not with me. Someone else is going to take the session. Okay, I'll see you day after tomorrow. All right. Take care. Bye-bye. Good night.
Let me go back to the question, my dear friends. Case study number 90. Slightly bigger case study, but we can complete comfortably because we have spent so much of time on tax audit report. Below is presented the P&L account extract of Surya Limited for 22-23. Revenue from operation, interest income, cost of goods sold, changes in inventory, loss of subsidiary written off, salaries and wages, bonus to employees, penalty for demand, contribution to employer-related funds, donation in cash to Sabka Saath NGO, other expenses. Other items which are omitted in the extract is duty drawback and dividend income. How can you miss that, my dear friends? Is the screen visible? Please confirm. Yes, thank you. Particulars regarding stock information. Opening stock is given, quantity manufactured is given, and sales during the period is also given. By that, we get the figure of closing stock also. Next. Surya Limited has sold a land, namely ABC Park at Delhi, on 1st December. The land was purchased by Surya Limited on 7th August 2012 at a cost of 10 crores. And they have sold for 15 crores. However, the consideration by stamp duty value is 18 crores, my dear friends. I told you that we have to report that in the clause related to immobile property. And they paid stamp duty as per circle rate. And accordingly shown gain of 18 lakh rupees while computing tax and cost per 50C. And Surya Limited has discarded a part of its plant and machinery at nil value on 31st October due to its obsolescence. And the book value of plant and machinery as on relevant date is 1 crore. But they have discarded the plant and machinery, my dear friends. Next line. Following particulars are shown with respect to pending matters relating to TDS. Sale of goods, Dharmavir, pan of so and so person, 1 lakh rupees Delhi. Professional services 20,000, Mumbai. Contract service 25,000. Interest for car financing loan. Name of the payee is Gansham HUF. According to accountant, no TDS is required to be directed against interest payment to HUF. Why? TDS has to be done. Section 194A. They have filed TDS written on 24Q 26Q as under. Due date of furnishing is given. Date of furnishing is given. So some cases there is a delay. Tax audit is due. However, tax auditor has told his assistant to prepare Form 3CD of the company. Instead of having prior discussion with tax auditor, he has directly sent Form 3CD to direct tax head of Surya Limited. Oh my God, crazy fellow. What is that he has done, you see? Previous year, 22-23. Assessment will also, please see, dangerous fellow. He wrote 22-23 only. And items not credited to P&L account falling within the scope of section 28. Proforma credits and drawback. How can you miss that? In the question, they gave some figures of duty drawback. That has to be shown, right? In the question, they have clearly shown some figures of duty drawback. Show that figure there. Getting the point, everybody? Next. Any other item of income, in the question they told that there is some dividend income also. You can see here in previous point, I remember they gave some dividend income of 1 lakh rupees, which are omitted, which is not taken in P&L account. That also we have to report there. That is another item of income. Next. Land consideration is 15 lakhs and stamp duty value, how can you show 15 crores? That has to be 18 crores, my dear friends. Next, depreciation. He has done something called block of asset. But the point here is, wherever it is put to use for less than 180 days, we have to charge half depreciation. For example, here you can see 5/12/22. When it is 5/12/22, my dear friends, which means it is less than 180 days. So for that much, we have to charge what, my dear friends? Half depreciation. And when it is manufacturing, we have to charge additional depreciation also, my dear friends. Bonus or commission to employees. Capital expenditure debited to P&L. There is something there. In the question, they gave something called loss of subsidiary. Like that, there is one language, loss of subsidiary, which is debited to P&L account. How can that loss of subsidiary written off be debited to P&L? That is capital in nature. And there is also something called penalty for service tax demand. That is also violation of law. Even that has to be reported in the tax audit reports. Penalty for violation of law. Getting it, my dear friends? Next point. Details of payment on which tax is not deducted. That is that point they made interest payment to that HUF, right? TDS is not done. Even that needs to be reported, my dear friends. Next point, 40A3, that is with respect to payments made single person, single day by other than account pay check. Just a second. Twenty-first clause. There is something related to capital, personal, advertisement, violation of law. Very good. Done. So coming back to the question. Are we clear with this part, everybody? And then with respect to this mentioned account pay check, here the answer cannot be yes, my dear friends. Answer has to be no, because there is some donation what he gave in cash. That needs to be reported there, my dear friends. Got it? Then next point, TDS, he has to report the clause of each form wise. He has to report what is the due date of furnishing, date of furnishing and all. Then manufacturing as a finished product, how can you miss out giving quantity details? Even that has to be discussed, my dear friends. So all these reportings that assistant has missed out reporting. Then Surya Limited is based in Delhi and also registered in GST. I think we are done with the tax audit report elements. For the assignment sent on 1st of January, IDT manager has been told by CFO to provide taxable intrastate and intrastate details. Location where goods which reach is Japan and goods would come under exempted category, it seems, my dear friends. If the goods are coming under exempted category and the location of goods, location where they're going is Japan, what is going to happen, my dear friends? It is exempt. So there is no question of GST coming into picture there. Next, location is Delhi. Purchaser is Mumbai, has instructed Surya Limited to deliver the goods Purchaser in Mumbai has instructed Surya to deliver the goods at residence in Delhi. So purchaser is in Mumbai, so place of supply will become Delhi. Purchaser is in Mumbai, he gave instruction, so place of supply will become Mumbai because of 10(1)(b), and it will become an intrastate supply. Madhya Pradesh, purchaser in Delhi has instructed Surya Limited, so answer will be Delhi only. Place of supply will be Delhi and will charge CGST as GST. Next, finally, Delhi purchaser will arrange his own transportation of goods. So that is also intrastate. So Mumbai will be, this 56 to 520 will be interstate, and these two will be intrastate. Japan, no GST at all. Next. They sells various products in various segments. One popular product is Kanti. And they gave opening inventory, goods purchased including GST, closing inventory, goods sold including GST. GST rate is 18%. A new assistant of IDT manager has been hired since software was not in operation on particular day due to technical issues. IDT manager told assistant to prepare the invoice manually for sale of Kanti products. Fine. Following invoice is prepared. Duty care, skin care, salary, wages, hair oil products. Oh my God. So all the details are given. And they mention the word invoice. Why is the word invoice? The word has to be tax invoice. Correct, right? Under GST law, it cannot be the word invoice. It clearly has to be the word tax invoice, my dear friends. Getting the point? And always, my dear friends, duplicate for recipient is not acceptable because in case of goods, invoice must always be in triplicate. Original for recipient, duplicate for transporter, triplicate for supplier. Got it, my dear friends? So it cannot be duplicate for recipient. It has to be original for recipient. I hope you are getting clarity, everybody. Next point. Supply of goods, and they gave here CGST and SGST. But the problem is buyer is in UP. When buyer is in UP, why did they charge CGST and SGST? It has to be what, my dear friends? IGST. Got the point, everybody? And the name, address, and GSTN of recipient is mandatory. And in the question, they wrote the word. In the question, if you see, they wrote the word supply of goods. But where is the description of the goods? Description of the goods is mandatory, no, my dear friends. Come on. And where is signature here? Signature is also missing, my dear friend, because signature is mandatory. And I hope the HSN code is there. That is also missing. HSN code is also mandatory to mention, my dear friends. Getting the point, everybody? So there are all the important points which has to be mentioned in that particular invoice, which is missing there. And they conducted board meetings and all. Very good. Then next, company secretary. Next, board meetings. Third MCQ. Calculate net GST liability of Kanti for January 2023. What will be the net GST liability, my dear friends? Very simple point. Calculate the tax on outward supply. Calculate tax on inward supply. Outside supply will be output tax. Inward supply will be input tax. Take that credit, set off that credit, and calculate the answer. Got it now, my dear friends? If I have to tell you the answer, my dear friends, wait a second. Goods sold within the state, 17,50,000. On 17,50,000, you apply 18/118. You will get the tax figure because they told including GST. 15,45,750 into 18/118. You will get the tax figure. You will get the tax figure on purchases. Whatever tax is paid on purchase, you take that credit. Whatever tax is payable on sale, calculate the output tax. Output tax minus input tax credit. Balance will become net GST payable. So if I have to calculate, my dear friends, 17,50,000 into 18/118. That figure is my output tax. 1545,750. 1545,750 into 18 by 118. That becomes my input tax credit. So when I reduce that, my dear friends, the figure what I've got is 31,158. That is the answer what I've got. Got it, my dear friends? Everybody, sir. Small rounding of difference can come. That's it. Next point. That is your MCQ number 3. MCQ number 4. Calculate the amount of taxable supply of beauty and personal care segments. Beauty and personal care segment. What is that they have given there? Come on, let's get back. Beauty products, that is definitely taxable. Skincare products, that is also taxable. Salon service, that is also taxable. Salaries and wages, why do you charge tax on that? That is the inherent cost of yours. Salon service is taxable. Hair oil products is also taxable. Reimbursement of conveyance expense to employees, why would that be covered, my dear friends? Shaving cream, that is also taxable. Service provided to United Nations, that is not taxable. Interest from debtors for late payment of dues, that will also be taxable. So any interest, late fee, penalty charged by supplier from recipient, that will be included in value of supply, no doubt about it. Getting the point, everyone? That's it. So that's the story of MCQ number 4. Then question number 5. Calculate the amount of taxable intrastate and intrastate supplies with respect to assignments sent on various locations. Sent to various locations on 1st of January. What is that? Actually, that was Japan story. Correct. So I already told the answer to you for that actually. So first one is not taxable. Delhi, this case will charge IGST. These two cases it is CGST and SGST. So answer will be 56,250 will be IGST and 146,650 plus 298,500. What is that figure? 146,250 plus 146,650, right? 146,650 plus 298,500. That total is coming to 445,150. That will be IGST, my dear friends. Come on, coming back. Let's see the options. So answer will be option B, my dear friends. 56,250 will be intrastate and 445,150 will be IGST, my dear friends. And Japan is exempt, so there is no question of GST. Done. Being the direct tax head of Surya Limited, what are the observations in Form 3CD prepared by Assistant of Tax Auditor? Already we discussed this point in detail. And also state correct treatment, even that we have covered. Being IDT manager, what are your observations under the scope of GST rules and regulations for manual invoice issued by your assistant? Even that point we have discussed in detail. That's it, my dear friends. That's the story of this very, very, very interesting case study, which has got so many brilliant points related to tax audit report form 3CD and also some good points related to GST invoicing. And I strongly believe that you are clear with all these points, my dear friends. A very, very interesting case study discussion. It has taken so much of time because I have spent you a lot of time. I've spent a lot of time with you on discussion about tax audit report. That's why it took some time. But you have to understand the importance and essence of the time what we have spent. Because we have revised also so many points. So you should take it very positively that I've spent so much of time on this. Clear, everybody? That's it, my dear friends. Can you please confirm that you are clear? Yes. And I also believe that today's revision has been very useful. We revised so many sections and so many points actually. Done, my dear friends. That's it. Thank you so much. Shivateja signing off for today. That's all for today. The balance will take for tomorrow. I'll confirm the timings for tomorrow in some time. Okay. Thank you so very much, my dear friends. Take care. See you all tomorrow. Shivateja signing off. Take care. Bye-bye. Thank you. So let me talk about the next interesting case study, my dear friends. See that, my dear friends. Come on. SSP Co, a chartered accountancy firm, has been into practice since year 2009 at Vadodara, Gujarat. Senior partners of the firm, C.S. Sagar Shah, Simran Kaur, and Pankaj Bansal, started the firm after practicing individually for almost 3 years. And now it has grown into a big firm of 7 partners. Very good. Next. Since inception, this CA firm has always been in news among chartered accountants and the article trainees for its unique way of working. So nice. The three partners have given their best to inculcate a working culture of hard work, learning, training, development, and rendering best quality in the service industry it belongs to. Under one of the unique ways of its working, the firm annually holds a 1 month long and continuous competition among article trainees to motivate them towards working hard and reward 3 candidates as winning article assistants. All this is story. This year, around 25 article trainees, excluding the recently joined ones, were a part of the competition. And after 1 month rigorous continuous assessment of the performance, Pratham, Shivam, and Ragini were declared as winning article assistants. Okay. Pratham would assist Sagar in carrying out tax audit. Shivam would lead the team. He would be leading the team headed by Simran to carry out the work of accounting for different projects. That is accounting. Ragini would be an important part of the team headed by CA Pankaj to conduct TDS audits of the major clients of the firm to check their TDS compliance and report thereon. Let's see the story of Pratham. Tax audit under direct tax. Auditor has got responsibility to report everything in tax audit. Fine. He also tells about the amendments which have come. Yeah. What is the tax audit threshold limit, my dear friends? I hope you know that it is 1 crore, but 10 crores limit will come into picture in case where the cash receipt does not exceed 5% of total receipt and cash payment does not exceed 5% of total expenditure. Next. That is 44AB story. Now see. Peak QR Limited is engaged in the business of manufacturing of threads and having 97% of the receipts and payments through account pay check. Very good. That means less than 5% are through cash. Company has recorded turnover of 10.5 crores before adjusting the following. Discount allowed in the sales invoice. So if it is discount allowed in the sales invoice, that discount will be reduced, right? Exactly. Next, cash discount other than allowed in cash memo or sales invoice. So if it is not allowed in sales invoice or not allowed in cash memo, then it is not reduced from turnover, because it's clearly like a financing activity discount given after the transaction is over altogether. It is not allowed to be reduced. Next point. Trade discount. So trade discount, what will you do, my dear friends? Come on, please tell me the answer. Trade discount, what will happen, my dear friends? Trade discount is definitely what, my dear friends? Reduced. Because it's a trade practice. Next point. Commission on sales. What do you do with commission on sales? Please reply. Will you reduce the commission on sales from turnover, my dear friends? Commission on sales, it is not reduced from turnover as such. It's a separate expenditure altogether, my dear friends. Got it? Next. Sales returns. Come on, guys. Sales return, what will you do? Will you reduce the sales return? 100% answer is yes. Finally, sale of investment. Sale of investment, will you reduce from turnover or not? Come on, guys. It is never reduced from turnover. The logic is very simple, my dear friends. If the what do you call investments are held as stock in trade, that will definitely form part of turnover. You're getting what I'm saying, my dear friends? If the investments are held as stock in trade, then that sale proceeds will form part of turnover, my dear friends. Are we getting clarity, everybody? That's it. Next. Anurag, owning an agency of Samsung Mobile, has turnover of 97 lakh July 2023. XYZ, engaged in trading of electronic goods, is having turnover of 175 lakhs, and they're a partnership firm. And next is about government grants. That's all related to financial reporting. And it's all related to government grants. I'll proceed to Ragini with CA Pankaj Bansal. It's talking about the TDS provisions. Compute the amount of TDS, analyze provisions of TDS, all that they are going to do. Right, let's see. He hands over TDS working on compliance of various client firms to all team members and Ragini being a part of the winner trio. Come on, let's see what is that they are given. A commission of 60,000 was retained by the consignee PQR Packaging Limited and not remitted to consignor ABC Developers Limited, the client company of SSP and Co LLP. And Ragini had to examine the obligation of the client firm to deduct tax at source. Come on, tell me, my dear friends, will TDS provision apply? 100% answer is yes, my dear friends. Provided whenever commission is paid, the TDS provision will come under section 194H. TDS will not apply only when commission does not exceed 15,000 actually, 15,000, and here the figure is 60,000, my dear friends. Whenever we talk about retention of commission, that means we are keeping our commission with us and giving the balance to them. That also attracts TDS, right? Clear? Next point. Raj is working with ABC Developers Limited. He is entitled to salary of 60,000 per month. That means per year, 7,20,000. He has property which is self-occupied and he paid interest of 90,000 on loan during the previous year. That will take under income from house property, negative figure. He has notified his employer that there will be a loss of 90,000 as per his property. And Raj is not opting for provisions of 115 BAC. That means he's in optional tax regime. So from 7,20,000, we take something called standard deduction 50,000, which comes to 6,70,000, and he has got 90,000 of interest. The balance figure will come to 5,80,000. And if it is 5,80,000, definitely tax will come into picture. If its tax is coming into picture, TDS has to be done. Getting the point? Don't tell rebate and all. Rebate is only for those whose total income does not exceed 5 lakh rupees. 7 lakh limit is only in case of default tax regime. Next. By virtue of agreement with ABC Developers Limited, a catering organization receives 55,000 per month towards supply of food. So this will come under 194C, my dear friends. And 194C, TDS rate is, if the receiver is individual or HUF, it is 1%. If receiver is others, it is 2%. So in this case, if the catering organization is individual or HUF, it is 1%. If not, it will be 2%. And what is the limit for 194C? Any idea? Single payment exceeds 30,000 or aggregate exceeds 1 lakh. Very good, very good. Students are quickly replying. DK, a part-time director of ABC Developers Limited, was paid an amount of 3,50,000 as fees, which was actually in the nature of commission on sales. Tell me guys, what is going to happen to this? To whom it is paid? It is paid to the director. Sir, let me tell you, whenever salary is paid to director, section 192 will apply. But if director is paid any remuneration other than salary, TDS provision is governed by section 194J, my dear friends. And the rate of TDS will be straight away 10%. And there is no limit at all in 194G, my dear friends. 194J, my dear friends, in case of director's remuneration other than salary. Next line, come on. ABC Limited Pharma Company credited 18,000 towards professional services, 17,000 towards technical services. Total is 35,000. Let me tell you, there is no question of TDS. There is no question of TDS because 194J has got a limit of 30,000. So 194J has got 5 points. Professional, technical, royalty, non-compete fees, director's remuneration other than salary. In first 4 cases, in every case, there is a limit of 30,000. But in last case, there is no limit. Fourth, last point. XYZ Limited, a foreign company, pays outside India salary to its employee Raghav, a foreign national and non-resident, for service rendered in India. For services rendered in India. Fine. Services rendered in India, that will definitely be taxable in India. You are required to work out the following question as to how the winning articles would have worked out on this issue. Fine. First bit. Winning article training is told that, come on friends, what is told to them? The partnership firm, I repeat once again, partnership firm would not be able to ensure that aggregate of all payments received, including the amount received for sales, turnover in cash, does not exceed 5% of said amount, and payments also does not exceed 5% of said amount. Which of the following statements hold true with respect to taxability of business profits of the firm? When you talk about the firm, what did they say with respect to firm? The question they told that there is a partnership firm whose turnover is 175 lakhs. If it is 175 lakhs, without any second thought, they can happily proceed to offering income under presumptive income under section 44A(d), my dear friends. 44A(d), my dear friends. Because 44A(d) has got a limit of 2 crores. Next point. Second MCQ, guys. What will be the outcome of tax audit applicability as worked upon by Pratham in the case of Anurag Basu? Who is that Anurag Basu? So Anurag Basu is owning an agency of Samsung Mobile, which has got turnover of 97 lakhs. So let me tell you, in case of agency business, they are not covered in section 44A(d). 44A(d) section is not applicable to commission, brokerage, agency business. So there is no question of 44A(d). But moreover, my dear friends, you have to observe that. Moreover, you have to observe that turnover did not exceed 1 crore. When turnover did not exceed 1 crore, there is no requirement to get books of accounts audited, because the tax audit story will come only when the turnover exceeds 1 crore, my dear friends. So you need not get books of accounts audited. Good. Student is asking something in the chat box. What is it? Sir, if it is 5%, it will be 3 crores. Yes, you are right, my dear friends. 44A(d) generally limit is 2 crores, but if the cash receipt does not exceed 5% of total receipt, then the limit will be 3 crores. You are right. Third bit. XYZ Limited is required to deduct tax at source as follows in the case of payment made by it to Raghav. Come on, my dear friends. Payment made to Raghav. What is going to happen? TDS will apply under section 192 because the income is accruing in India. Good. Next point. What would be taxable on account of payment made by ACD Limited to the account of HG? What is that HG? Oh, that is your professional and technical services, 18,000, 17,000. There is no question of TDS because each payment does not exceed 30,000, my dear friends. And fifth bit is about government grants. Fine. That is related to your FR. Partnership firm can opt for tax audit, can opt for presumptive income under section 44A(d). They can definitely do that, my dear friends. And MCQ number 2, my dear friends, that was related to agency business. Since Anurag turnover does not exceed 1 crore, they need not get tax audit done. MCQ number 3, that was talking about payment to non-residents. Generally, section 195 will apply in case of non-residents. However, in case of payment of salary, TDS provisions are covered under section 192. And moreover, in this case, I'll write the word TDS is applicable since income is accrued in India. When it's accrued in India, it becomes an Indian income. Getting the point, everybody? Next. Note TDS on technical. And what other service was there in the question? Technical and professional services. Since each payment does not exceed 30,000. That's it. And MCQ 5 is related to your FR. Come on, friends, let me get back. Descriptive. Help Pratham working out the applicability of income tax audit. That will do. Explain the accounting treatment of, if any, for 2 grants received and the flood related compensation. That is why for next state, all TDS provisions applicable on ABC developers with respect to their transaction as stated in above scenario. We'll do that. But for applicability of tax audit, what is that I'm going to do? I have to check whether 10 crore limit is crossed or not. How do I check that? From 10.5 crores, my dear friends. I repeat once again, from 10.5 crores, I'll reduce the discount given in sales invoice. I'll also reduce the trade discount. Trade discount is also reduced. I'll also reduce the sales returns. Sale of investment, I'm not reducing only with a small logic that investment is held as stock in trade. Investment is held as stock in trade. Getting the point, everybody? Question number 6. Come on, guys. What is the turnover during the year, my dear friends? 10 crore. 50 lakhs. From that, I'll reduce discount in sales invoice. How much is discount in sales invoice? 9,50,000. Next, there is also trade discount 5,30,000. And there is sales return 6,60,000. Which 6,60,000. Next, net to turnover. With this minus sum of these 3. Come on, friends, how much is this figure? 10 crore 28 lakh 60,000. When it is 10 crore 28 lakh 60,000, my dear friends, tell me, guys, what is your answer? Provisions of tax audit shall be applicable since turnover exceeds 10 crores. That's it. That's the story of this interesting point. I hope we are clear. Fair enough. Then, what else they asked in the question? State all the TDS provisions applicable on ABC with respect to their transaction. Come on, TDS provisions, what will apply, my dear friend, with respect to the transactions? First one, for commission, there is 194H TDS. And for second bit, there is 192 TDS. And the third bit, 194C TDS will apply. And for fourth bit, 194J TDS will apply because payment is made to director. And for fifth bit, there is no TDS because each payment does not exceed 30,000. And for sixth bit, the TDS provisions will apply for a simple reason because the income is accrued in India. Getting the point, everybody? That's it, my dear friends. That's the story of this very, very, very interesting case study. I strongly believe that you are getting clarity on this point and you're clear with this case study. Please reply, my dear friends. Friends, come on, please don't relax. Please confirm, are you clear? Fair enough. Very good. Very good. Sounds good.
So start with case study number 20. Similar case studies we have done. Okay, maybe same also we have discussed. So as far as this case study is concerned, again, if you go to the questions directly, that is the strategy we have been following and we'll be following for the examinations. First one is on income tax. So there is nothing I will be discussing here. Then again, income tax. then TDS, then again TDS, then how the government grant should be recognized in the books of BCD Pharmaceuticals Limited. So what kind of government grant is there? So again, we have to go back to the case and see what is the government grant in this given scenario. Here it talks about a firm. This year around 25 article trainees have joined. Then Pratham assisting CA Sagar Shah on different audits. Here you can see 12A, 35D and all of those, so income tax credit thing. Then PQR is engaged in the business of manufacturing of threads and having 97%. Just a second, set my camera. Okay. Agency and in trading of electronic goods. Then CA Simran would do accounting of various complex operations of the client firms, providing consultancy accordingly. This year, CA Simran is dealing with grants received from the government during the COVID-19 pandemic and how to deal with them in the accounts of the various clients. She enlightens her team members on this topic and tells them that government grants to entities for various purposes, including for industrial, geographical, social development, to promote entrepreneurship, etc., whatever it is, they are offered. They could be in different forms, monetary or non-monetary. Government grants may be significant for an entity. So all these things, common things. Now, key thing comes here. Spectra Limited is carrying out various projects for which the company has either received government financial assistance or is in the process of receiving the same. The company has received 2 grants of 2 lakhs each relating to the following ongoing research and development projects. So 2 grants have been received, right? Now, the first grants relate to Clean River project, which involves research into the effect of various chemicals waste from the industrial area in Madhya Pradesh. No major steps have been completed by Spectra Limited to commence this research as on 31st of March. So grant have been received, but work has not been carried out. Grants have been received, but work has not been carried out. Means expenditure has not been incurred. Now, if expenditure has not been incurred, we cannot show this grant as income because no steps have been carried out. Even if you have received this 2 lakhs of grant, you have to show it under deferred government grant. You will not recognize it in the income statement. Clear? That is the first part. My screen is visible, right? Yes, it's visible. Then, next one, second grant relates to the commercial development of new equipment that can be used to manufacture eco-friendly substitutes for plastic product. They are confident about the technical feasibility and financial viability of this new technology, which will be available for sale in market by 24. Okay. Then in September 22, due to the floods near one of its factories, the entire production was lost and Spectra Limited had to shut down the factory for 3 months. The state government announced compensation package for all manufacturing entities affected due to the flood. Spectra Limited is entitled to a compensation based on average of previous 3 months sales figure, for which the company is required to submit an application on or before 30th June with necessary figures. Financial statements are to be adopted on 31st of May, by which date the claim form would not have been filed with the state government. So 3 cases are there. In 2 scenarios, we have already received the grant. In the 2 scenarios, we have already received the grant. Third scenario, we have to make an application. Now, we have not got it. So I think I missed it. If we come back to the question, how should the government grant be recognized in the books of BCD Pharmaceuticals? Okay. And the entire time I spent in reading the grant to be recognized or the grant related to Spectra. So simply, I spent time. If there is any other question, we'll use it, but don't do that mistake in the examination. BCD Limited received a grant of 20 lakhs for past research of COVID-19 vaccine, one of the top clients of SSP Company Limited, no condition attached to the grant. Now, question is about BCD. I wasted my time studying about Spectra. Okay. Now, what is the question? The question is, what is the accounting treatment for the grant in the books of BCD Pharmaceutical? To be capitalized, grant should be recognized in P&L. To be deferred till the work proves to be marketable, credited to a special research fund. Now, first thing is, there is no concept of special research fund. Second, we have already met the condition. There are no condition attached actually. So if there are no condition attached, then we should directly credit into P&L. No need to capitalize, no need to be deferred. So correct option is option B. Here, because we have discussed, let us understand this also. First grant here, we will show it in the balance sheet as a liability because we have not incurred any expenditure. Second, it is with respect to new equipment, and if they are likely, financial technology will be available for sale. So if the expenses have been incurred, you can take it to P&L. And third, because the claim has not been filed, we cannot account for it. Okay, only when the claim has been filed, then you will, you will recognize that in the books. But claim has not been filed. So because claim has not been filed, it is not receivable. So because it is not receivable, we will not do any account. Okay, so that is for the MCQ. Explain the help Pratham work out income tax audit not required for FR purpose. Explain the accounting treatment, if any, for the 2 grants received and the flood related compensation in the books of Spectra Limited. So finally, we spent time, but it was asked in this question. Question number 7. 2 grants received and flood related compensation. So again, coming back. First grant, Clean River project. Now, because we have not spent anything in relation to the Clean River project, we will credit it to a deferred grant account. We will show it as a liability. Okay, that is one thing. So we cannot recognize it in the books. Now, first grant relates to Clean River project, which involves research into the effect of various chemicals in the industrial area. No major steps have been completed to commence this research. So it is related to research. The appropriate treatment would be based on the expenditure. We should credit it to the P&L account. Now, of course, there could be one assumption that there is no thing about condition. But what is the most appropriate way? You should match your expenses and income. Expenses, if you are incurring subsequently, then you will have to recognize that expense in a particular year. Income should also be recognized in the same proportion or in the same order. Okay, so there are two. So as Niranjan mentioned, if you said, sir, there are no conditions, yes, in that case you can recognize in the P&L, but a matter of prudence, it should be taken in the proportion of the expenditure being incurred, so that you match the income and the expenses. Otherwise, what will happen is you will not match the income and expenses. So both the treatment are possible. See, with Ind AS, one problem is because it is a principle-based standard, you can take assumptions and solve the problem. Then the second grant relates to commercial development of a new equipment that can be used to manufacture eco-friendly substitutes for existing plastic products. They are confident about the technical feasibility and financial viability of this technology, which will be available for sale in the market by April 24. Now we are looking at 31st of March of 23, and they are saying by April 24 it will be available, right? So this is related to new equipment, means grant related to an asset. Okay, grant related to an asset. So when there is a grant related to an asset, what will you do? You will set it up as a deferred grant account, and as you depreciate the asset, you will apportion that amount over the useful life of that particular equipment, right? So based on the depreciation, you will account for this as an expenditure subsequently. Clear? Correct. So in the first case, what you need to understand is there are two parts. The question did not say anything about condition, nor they have said no condition are attached, but still major steps have not been completed. So if you say, sir, no conditions have been fulfilled, I want to recognize in P&L, yes. But what will be a more appropriate way? My income is in a particular year. If expense is coming in the next year, we are violating the matching concept. So a better representation would be to account for the grant in relation to this particular thing as a proportion of expense. Now, please keep in mind, Ind AS gives us option to set up deferred grant account, right? Why do we set up deferred grant account? To match it with expense. So considering this, second treatment is also appropriate. Okay, so that is with respect to your FR. Then coming back, then TDS provision. So that is a TDS related. So here if you see, in case the grant is conditional as to expenditure, grant will be recognized in the books over the year expenditure is being incurred. So that clarity is not given in the question, and hence there is a confusion. Let's move on to case study number, the next case study. That will be case study number 21. So this is on Ideal Fabrics, Ludhiana-based company, incorporated in 1996. Okay, then there is an extract of statement of profit and loss for the company. So that's on the profit and loss. Management of the company is asking from company secretary of the company regarding overall managerial remuneration as per provisions of Companies Act. This will be discussed as a part of the Companies Act, right? So here you have to keep in mind whether there is there is a profit. So based on that profit, how much of maximum managerial remuneration, the percentage of 11%, 1%, 3%, and all of those things you have to keep in mind, right? Then you jump to the questions. Section of TCS, amount of TCS and the form number. Sale, what is GST? That is related to GST, e-way bill. Then calculate the amount of loss or gain as per Ind AS 21 in respect of the machinery purchased by Ideal Fabrics in foreign currency that needs to be recognized in the statement of profit or loss. Gain of 6 lakh, loss of 6 lakh, gain of 3 lakh, loss of 3 lakh. Now we have discussed earlier also that as per Ind AS 21, monetary items need to be restated. So let us see if there is any monetary item here. Yeah, here it is. The company wanted to add a new product in its range of products in order to achieve this goal. So they want to do something, they want to expand or do something. The company has purchased a new machinery from USA for $1 lakh on 1st of January of 23. The exchange rate on the date of transaction is 68. Company is not required to pay for this until 30th of June. Exchange rate as on 31st March is 65. Mr. Mohan feels that the exchange fluctuation would not affect the financial statement of the company. Hence, he did not make any changes in respect of currency fluctuation. Very, very straightforward question. 1st of January, we purchased at 68. 31st March, amount is 65. Now, please understand, we have purchased, means we have to pay. When we have to pay 100,000 into 68, but as on 31st of March, it is only 65, means our liability is less by 3. We have to pay 3 rupees less. If we have to pay 3 rupees less, then there is a gain of 3 rupees into 1 lakh, which is 3 lakhs. So here there is a gain of 3 lakhs, straightforward question. Right, then remuneration of directors. Then the remaining parts are again related to law, which will be taken care in the law related portion. Okay. So now if you see in one case study, they gave so much from financial reporting. We had Ind AS 19, we had financial security deposit, long calculations, and also one more MCQ. But then if you look at this case, only single MCQ, so that there can be a variety. So sometimes what happens, if you find some topic to be complex or you're not able to handle something, choose wisely. For example, if you're very comfortable with FR, and if one question has 2 descriptive questions or a higher weightage in FR, you should consider FR because there you'll be able to score more. If one MCQ you are missing, you will lose 2 marks. But if you are able to gain in the written answers, you will score 5 plus 5 more, 10 marks. So that is one thing which you have to keep in mind when it comes to the case study selection. Which case study to be selected? Okay, that is where it becomes very, very important, right? So we'll conclude here today, and tomorrow we will continue with. I think law will be taken tomorrow, and then we'll post the schedule. Subsequently, what I will be doing is this week schedule for the case studies that will be covered, that I'll be sharing in the group just after the session, so that you can have a look at it and you can plan for those case study accordingly. This case study digest of November 23 is available in the notes section. You can download it and refer to it as well. Okay. Chalo. Thanks a lot.
Good evening, everyone. How are you all doing? How is everyone doing? How's your preparation going? Okay, so we are not going to be waiting for a lot of students. We are just going to start our class, okay? Because we have limited time and we have a lot of cases to finish. Okay, so as the students keep coming, they'll be joining in, but we'll start, okay? All right. So today we are going to be taking some case studies from the case study digest of November 23. Okay, let's start off without any further ado so that we can cover the maximum number of cases, okay? All right. My screen is visible. Let me know yes or no. My screen is visible. Yes, great. Okay, so first we're taking case study number 21. In this, we have got two questions which are relevant for us. First is MCQ number 5. So directly we'll start reading this question, and then we are going to check if we need to read the case or not. Okay. Yeah. So question number 5. With reference to para 3, the directors may receive remuneration under the Companies Act by way of sitting fees for attending meeting of the board, which shall not exceed 75,000, 1 lakh, 50,000 and 80,000. This is an easy question. Okay. Okay, is my voice audible? Please tell me just once. Is my voice audible? It's fine. Okay. Okay, thank you. So some of you have already answered this question and you all are correct. See, here we don't even need to see the case study. This simply is asking us what is the maximum sitting fees that can be given to a director. Okay, and we have got 4 options. All right. So here the relevant section for us is section number 197. In the section number 197, we have been given the different way in which the remuneration can be paid. So in this, for the director's sitting fees has been mentioned. It says that maximum sitting fees per board meeting or per committee meeting to a director should be 1 lakh, not more than 1 lakh. An independent director and women director should not get less than 1 lakh. Oh, sorry, less than the fees which is paid to other directors. All right. So this is very, very simple. So here, what is our correct answer? Correct answer here is B. Like many of you have already answered. 1 lakh is the maximum sitting fees that can be paid. Can we move on? Okay, let's move on to the next question. The next question is question 8. It is a descriptive question. Let's read this and let's try to understand this. With reference to para number 2, compute the overall managerial remuneration payable under the Companies Act subject to the provisions of Schedule 5. So this is a numerical. Here we have to calculate the managerial remuneration. Here it is saying that para 2 we have to read. So let's go to para 2 and try to read it. Then we are going to calculate the managerial remuneration that needs to be paid, the maximum that can be paid. In recent board meeting, correct, section number 198. In recent board meeting, the following particulars are extracted from the P&L account. All right. So we have been given gross profit. Then we have been given profit on sale of building. Cost price is given, written down value is given, and the profit is also given. So here we can do some calculations. This is going to be relevant for us. Here we are going to do some calculations like, can you calculate the selling price here? Okay, we are going to do the calculation later. Let's see what all is given. Gross profit is given. Profit on sale of building is given. Salary and wages is given. Sundry repairs on fixed asset. Compensation on breach of contract. Depreciation. Loss on sale of current investment. Interest on unsecured loans. Interest on debentures. Repair expenses on fixed asset which are capital in nature. And net profit is given. Now, based on all of this data, we have to calculate the managerial remuneration. Right. So let's first try to understand the provision very quickly. Only the relevant provision we are going to discuss. Then based on that, let's do the calculation. All right. Okay. So here, see. The first relevant provision for us is section number 197, which talks about the overall maximum remuneration that can be paid. Now, in case the company has got adequate profits, then the overall remuneration that can be paid to the directors should not exceed 11% of the net profits. And these net profits are to be calculated as per section 198. Okay. Now, in case the company does not have adequate profits, then we are going to refer to Schedule 5 and do the calculation according to Schedule 5. Now, that is not relevant for us. Here, the profits are adequate. So, we are going to calculate the net profits first. Based on the net profits, the maximum remuneration is going to be up to 11% of net profits. Okay, so now how the net profit is to be calculated, let's try to understand this. That is given in your section number 198, calculation of net profits. Now, it is very simple calculation. There are some allowable credits, some not allowed expenditures, some not allowed credits, etc. So, if suppose the company has received any subsidies or bounties from the government or public authority, then that has to be included in the profit. That credit will be allowed. Okay. Then some credits will not be allowed. For example, if the company has made any profits of capital nature, if the company has sold any undertakings and capital profit is made, that capital profit should not be included in our profit as per this calculation. If immovable property is sold again, or fixed asset is sold again, it's a capital nature profit, it will not be included. If the carrying value or the book value of assets or liability is adjusted and it is leading to some gain, some profit, then that need not be added here. If suppose a company has unrealized gains, notional gains, or revaluation of assets, again, this is not in cash, so this will also not be included in our net profits. If the company has received any premium on shares or debentures, cannot be included. If any sale of forfeited shares is done and profit is made, it should not be included. Then there are some expenses that will be added or not added. Let's see. What are the expenses that will not be deducted? Okay, so income tax will not be deducted. If the company pays income tax, we will not deduct it. That means we need profit before tax, right? If the company has a legal contract and that legal contract is breached and the company is paying compensation for breach of contract and voluntarily it is giving that compensation for breach of contract, then that will not be deducted. However, if suppose two parties have legally agreed that if there is a breach of contract, we will pay you compensation and the company pays the compensation. If legally bound compensation is paid, then it will be deducted. Otherwise, if it is voluntarily being paid, then that will not be deducted. This is important for us. Okay. This will be valuable for our question. Then loss, which is in the nature of capital loss. Again, if the company makes any capital loss, that will not be excluded. If carrying amount of asset or liability is changed, then that will also not be adjusted. Okay, then some expenses will be allowed, they will be reduced. That means, let's say interest is paid by the company on debentures or unsecured loans or secured loans. If there's working capital, working charges, if general day-to-day activity charges are there, expenses are there. If there are any other expenses that are not capital in nature, they will be deducted, depreciation will be deducted, etc. Right? So general charges will be deducted. Okay, so I hope you understood the basic of how the profit is to be calculated, right? So let's just calculate the profit. Based on the calculation, we are going to calculate 11% of it, and that will be our maximum remuneration. All right, that's what has been asked. So let's quickly see. Okay, so these are the details which are given in our question, right? So we'll do reverse calculation. We'll take 19,50,000 rupees, which is the net profit, and accordingly we'll do the adjustment of all of this. All right. So now repairs and expenses on fixed asset which are capital in nature. Do you think they should be adjusted here? Do you think they should be adjusted? Should we reduce or add them? Tell me. These are capital nature expenses. They have already been deducted, but they should not have been deducted because they are capital in nature. So we are going to add it back. Okay, so we are going to add this 3 lakh back. Now, interest on debentures, it is fine. There is no need to adjust it because interest on debentures is allowed expense. Interest on unsecured loan is also allowed expense. We have discussed loss on sale of current investment. Current investment. If it was a long-term investment, then we would have made the adjustment. But here it is current investment. So therefore, again, this is also not to be adjusted. This is allowed. Depreciation. Depreciation is deducted. There is no need to adjust this. This is okay. Then compensation for breach of contract. See here, we don't know if this is legally bound contract or if it is voluntarily paid. So because nothing is given, you will have to mention an assumption. So we'll have to write an assumption that, okay, we are assuming that this contract, in this contract, there was legally, the company had agreed to pay compensation in case of breach of contract. If you put that assumption, then there is no need of adjustment. This is allowed expense. However, you can also put that a different assumption. You can put an assumption that this compensation, we are assuming that, you know, it is voluntarily paid. And then you'll have to adjust it. You'll have to, this is an expense, this is deducted, so we'll have to add it back. Okay, if you assume that it is not legally bound, it is voluntarily paid. I hope you understand. Then sundry repair on fixed asset. Okay, so please note here, this is sundry repair of fixed asset, and here there are two items given. One is sundry repair of fixed asset, then repair expenses on fixed assets, capital in nature. There are two items given here. So the bottom item, that is repair expenses on fixed asset, which is capital in nature, it has been given specifically that this is capital nature expense. So automatically we assume that the above item, which is sundry repair on fixed asset, this is revenue nature. This is a general working expense, because there is already another item given which is capital in nature. Therefore, this is going to be considered as revenue expense. And therefore, iska we don't have to do any adjustment because this is general expense, this is allowed. All right. Salary and wages, no problem. This is also allowed expense, no adjustment, no treatment. Now, profit on sale of building. The cost price was 15 lakh rupees, written down value is 9 lakh rupees, and what they have done is 15 lakh minus written down value they have done, and they've given this calculation. So here we'll have to do some reverse calculation to calculate the actual profit. Okay. Okay, so here see, although they have given 7,50,000 as the profit, what they have done is they have deducted cost and written down value. However, if we do the calculation, what we are going to do is, say this profit 7,50,000 rupees plus the written down value is 9 lakh rupees. So if you combine this, you're going to get the selling price. Okay, the selling price is going to come to 7,50,000. Okay, 9 lakh plus 7.5 lakh. That's going to come to the selling price. Selling price is going to be 16.5 lakhs. Okay, cost was 15 lakh rupees. So what is going to be the profit? The profit is 1.5 lakh. Okay, so we'll have to adjust 1.5 lakh. Now 1.5 lakh is the profit on sale of building. That has to be deducted. Okay, because profit on sale of building, that is capital nature profit, that is not to be given credit of. So that will be deducted. So this we are going to reduce. Okay, so that means 19,50,000 plus 3 lakh minus 1.5 lakh. Okay, so that will be a net profit as per section 198. Okay, so if you do that maths, we'll get 21 lakhs as our net profit. 21 lakhs, we'll calculate 11% of 21 lakhs. That will be our maximum managerial remuneration. It will come to 2,31,000 rupees. All right. Is this clear? Have you understood this? Can we move on? Do you have a doubt? Can we move on? Okay. Okay. So next, let's move on. Next, we are doing case number 27. This has got another two questions that we have to solve. So let's go to the first MCQ. So here I'm taking up case study number 27 of your case study digest. Again, this is also a tricky question, so pay attention. Okay, let's read the question first. Now, with reference to the information which is given in para 1, whether any formalities would have been complied by YPL with respect to the appointment of Mrs. Sunita as the director of this company. Okay, so we just have to check. What do we have to check? whether any formalities would have to be complied with by this company for the appointment of Mrs. Sunita. So we just have to check whether Mrs. Sunita's appointment is accurate or not, if any corrections need to be made. First, let's look at the facts and then we are going to check the options to see which one's correct or which one's not. All right.
So let me proceed to discussion about the next interesting case study. Kindly please cooperate. We'll also talk one more case study today, my dear friends. Are we ready? Thank you for the cooperation. Yeah. Next interesting case study, my dear friends. Case study number 21. Please see that. Ideal Fabrics Limited is a Ludhiana-based company incorporated in 1996. Company is one of the leading textile manufacturers of India, having its presence across a wide spectrum from manufacturing lowest to highest range of fabrics. Company expanded its product offering and entered into strategic alliance with leading global textile players to gain access to state-of-art technologies. And Ideal Fabrics is one of the very few vertically integrated fabric manufacturers in India, producing large varieties of fabrics. In recent board meetings, what they have given? GP, profit, salaries, wages, compensation, depreciation, all details they have given. Management is asking the company secretary regarding the overall remuneration payable. Corporate law. Next. Rajesh is independent director. He plays vital role in management of the company and contributes to major decision-making process of organization. Company pays sitting fees of 60,000 rupees to him for every board meeting he attends. And I'm sure you guys know very clearly that whenever there is a payment of sitting fees by company to directors, TDS will apply under section 194J. 194J, my dear friends, covers professional, technical, royalty, non-compete fee, direct remuneration other than salary. That is nothing but sitting fees. First 4 cases, there is a limit of 30,000. Last case, there is no limit. This is point number 1. Point number 2, one more point which will come to the brain. Already student answered, that is RCM provision. Whenever a director is giving service to a body corporate, that service is covered under RCM. Next. In view of increased responsibility of directors, company proposed to increase to 1,20,000 per meeting. Very good. Ideal Fabrics is registered under GST in Punjab. Product of the company is making its market worldwide because of quality and price. One of the customer from Haryana is asking for a sample of the company. Company is first time sending its sample to one, my dear friends. Haryana. You getting the point, everybody? Sir, come on, please reply. Exactly. Next point. Company is generally involved in high value transaction, but this time it is sending goods of the taxable value of 48,000 rupees. The billing department of the company strongly believes that there is no need to generate e-waybill as the value is less than 50,000 and GST is applicable at the rate of 18%. Company did not issue e-waybill. Now you tell me the answer, my dear friends. Is it okay if we don't issue e-waybill? 100% answer is no. This is very clearly a mistake of the company. The reason because it is only their feelings and emotion and their strong belief. But what we want is not feelings and emotions. We want only sections and subsections. GST law clearly says that e-waybill is required whenever there is a consignment value exceeding 50,000. And consignment value always says value including GST. What is the word, my dear friends? Value including GST, my dear friends. Are we getting clarity, everybody, my dear friends? So speak out. Very good. Next slide. $48,000 plus GST is how much? 56,640. Done. More than 50,000. Waiver is required. Company wanted to add new products in its range of products. In order to achieve, they purchased a new machinery from USA for $1 lakh. Exchange rate was 68. Company is not required to pay for purchase until 30th June. And exchange rate on 31st March is 65. Mohan feels that exchange fluctuation would not affect the financial statement. That is their feelings and emotions. accounts team is not able to understand the TCS provision which has come into force. I hope you know, first of all, the TCS provision. Whenever seller turnover is more than 10 lakh rupees and there is sale of goods of more than 50 lakh rupees on value exceeding 50 lakh rupees, on value exceeding 50 lakh rupees, TCS will apply at the rate of 0.1%. But I'm sure you also know the point, my dear friends, that is, if the buyer turnover is more than 10 crores, if buyer turnover is more than 10 crores and buyer is buying the goods for more than 50 lakh rupees, on amount exceeding 50 lakh, buyer will do TDS under section 194Q at the rate of 0.1% on amount exceeding 50 lakh. But the point is very clear that if TDS, TCS both are applicable, then we'll apply the provision of TDS only. And this is an old provision. This is an old case study. That's where in the case study, you will find everything related to TCS only. But I hope you know that TDS also has come into picture. 194Q. Yeah. Company made sales to Kunal Textiles of 85 lakhs from April to September, of which 45 lakh is received till 30th September. And the amount received on or after 11022 is 40 lakh. Already how much received? 45 lakh. Now what we are getting? 40 lakh. Up to 50 lakh, there is no TCS. On above 50 lakh only, there is TCS. What is the figure above 50 lakh? 45 lakhs is over. And this figure is 40 lakh. That means 5 lakh will go in the limit. On the balance 35 lakh, there will be TCS at the rate of 0.1%. There is another buyer of the company to whom company has made sales up to 30th September 65 lakh. Amount received is 55 lakhs already. Only 55 lakhs is over. 55 lakhs is already over. And the sale is made on or after 11022 is 30 lakhs. And the amount received is 40 lakh. On entire 40 lakh, TCS will apply. Student asking, it is on receipt basis. Yes, the moment it is received, they have to collect TCS. Company's turnover exceeds 10 crores. Done. First point. As per the 11th section of TCS, the amount of TCS collected by the seller What is your question? Not on sales. See, ultimately TCS is collected. You have to understand one point very clearly here. The point what they told in the law is that every seller who is receiving any consideration, exceeding 50 lakh rupees, they have to collect from the buyer an amount equal to 0.1% of the consideration exceeding 50 lakhs. Got the point? Who is receiving any amount. So that means very clearly, while receiving the amount only, they'll collect that point. You're getting my point? Everybody? Good. Fair enough. Next point. The amount of TCS collected by seller shall be paid to government. So let me tell you, TCS has to be paid to government by 7th of next month. Same like your TDS. And the form in which TCS return is filed is very clearly, my dear friends, form 27EQ. So the answer is 7 days and 27EQ. By mistake also don't select 24Q, 26Q and all. 24Q is for TDS on salary. 26Q is for other than salary. 27Q is for payment to non-resident. 27EQ is for TCS. Good. Very good. Second bit. Ideal Fabric make a sales to Madhu Textiles for 18 lakh exclusive of GST. In addition to sales data given in the case study. What would be the amount of TCS collect on additional sales? So very simple, my dear friends. TCS will collect at the rate of 0.1%, my dear friends. And that 0.1%, my dear friends, very clearly will collect on the value including GST. Because whatever amount is collected by the seller on that figure, this story of TCS will apply. So on 18 lakh rupees, we have to charge 18% GST. On 18 lakh, 18% GST will be 18 lakh, 18% comes to 18 lakh, 18% will be 3,24,000. And the total figure will be 18 plus 324, 21 lakh 24,000. On 21 lakh 24,000, 0.1% comes to 2124. So the answer is option D, my dear friends. It is not option A. But the students keep thinking the answer is option A, which is not acceptable at all. because TCS provision clearly specifies that TCS has been collected on the value including GST. GST amount is included in the sale value. That will attract TCS. This provision is not for TDS like this. In TDS, we don't include GST amount. Next point. Difference to para 4. Which of the following statement is not correct? They're asking which is not correct. E-waybill is not valid for movement of goods without vehicle number. Obviously, that is correct statement. Once e-waybill is generated, it can be edited. How you can edit? The only option is you can cancel within 24 hours. It can be cancelled within 24 hours. That is correct statement. Even if movement of goods is for reasons other than supply. That is also correct statement. So answer is very clearly option B, my dear friends. Because e-waybill, once we generate, we cannot edit that at all. The only option is cancel that e-waybill. That too within 24 hours. Done. Next one, Ind AS. Next one, Companies Act. Descriptive. Whether e-waybill in respect of material sent to Raju in Haryana is required to be generated. Already I told you it is required to be generated because value including GST was coming to 56,640. Already we discussed that. E-waybill is mandatory required to be generated whenever there is a movement of goods where consignment value is more than 50,000. Consignment value always means value including GST. What will be consequence of non-issuance of e-waybill? If e-waybill is not issued, my dear friends, there will be penalty, and penalty will be equal to 10,000 or tax evaded, whichever is higher. Penalty will be 10,000 or tax evaded, whichever is higher, my dear friends. They didn't tell lower, whichever is higher. And moreover, my dear friends, that vehicle also will be seized, my dear friends. Goods, vehicle, everything will be seized. Next point. Compute the amount of TCS which needs to be collected from Kunal Textiles and Madhu Textiles. Already, I think I answered this question to you, my dear friends. From Kunal Textiles, 45 lakhs was over up to September, and from October, it is 40 lakhs. 45 lakhs over means 5 lakh you forget. On balance 35 lakhs, we will charge 0.1%. On balance 35 lakh, we will charge 0.1%. 35 lakh 0.1% will come to how much, my dear friends? 35 lakh 0.1% is 3,500. You're getting what I'm saying, my dear friends? Exactly. Next. Madhu Textile, what is the story? Madhu Textile already 55 lakh he received up to September 22. But after that, they received 40 lakh. On entire 40 lakh, we'll charge 0.1%. Because up to September, that provision was only not there. That is why 55 lakhs is being ignored. Getting the point, everybody? Good. What is the doubt you're asking? Said doubt for supply without e-waybill. Still, we have time to pay up to due date of the month. How could we decide as tax evaded for the purpose of penalty? So practically, sir, whenever there is a movement of goods without waybill, if the officer stops that vehicle, then and there only he'll tell pay the penalty. If he will tell very clearly, if you don't pay the penalty, we will seize the vehicle. That is what they do practically. So there is no question of having time till due date for paying the penalty. Next, what else? Come on. Any more doubts you can ask? Yeah, let me proceed then. One second. Done. Student asking one question. Sir, can you explain again why we are ignoring 55 lakhs? See, strictly speaking, in exam, if this question comes, the moment you cross 50 lakh, we have to start charging TCS. There's no doubt about it. But the only point I've ignored that is because there is an issue in the question with the dates. There is an issue in the question with the dates. That is the only reason why I had to ignore that point, my dear friends. You're getting what I'm saying? That TCS story has actually started from 1st of October. That is the reason why up to 30th September, whatever figure is there, that figure I have ignored. Done. Thank you very much. Next. Discuss about the due dates for filing TCS returns and furnishing certificates to buyer. Come on, my dear friends. Can somebody tell me the answer? What is the due date for issuing certificates? And TCS return, first of all. TCS return due date is, my dear friends, once quarter is over, next month 15th, we have to file the TCS return. For example, my dear friends, April to June, we have to file by 15th of July. July to September, 15th of October. October to December, 15th of Jan. But for last case, Jan to March, it is 15th of May, my dear friends. If it is TDS, we have time till 31st. But for TCS, it is only 15 days. Getting the point? And the certificate is very clear, my dear friends. Certificate should always be given within 15 days from the due date. That means 15th July means 30th July for certificate. 15th October means 30th October for certificate. 15th Jan means 30th Jan for certificate. 15th May means 30th May for certificate. That is how the system works. Getting the clarity, everybody? So that's the story of this very interesting case study, which makes a lot of sense, my dear friends. And I strongly believe that you got good clarity on this 2-3 interesting case studies, what we have discussed very clearly, my dear friends. Students are telling easy, sir. Very good. Good that you are feeling comfortable with this. That's it. So that's all for today's session, my dear friends. Tomorrow I'll meet you guys once again with some more interesting case studies where we'll talk a lot of interesting elements of taxation, especially direct and indirect taxes. Thank you so much. Take care. Good night. Shivateja signing off. Thank you.
Case study number 22, Aakash and Vani, close friends employed in the city of Delhi. So again, this background, not very, relevant for us. So they're given, things related to distance and all of those things, mostly to do with your, GST requirement. Provides direct subsidy for all the visits for holy places, packages for various customers. So a lot of things are there. Now, these type of questions again tend to scare us. Okay. Now, scare us meaning, how should we account? How should we retain? How should we read? So better thing is to be clear with the requirement. I've been repeating this again and again. Be clear with the requirement and then come back to the case. Okay. So that is that if you do this, if you follow this particular approach, it will be, easy for us. So first question talks about how would the firm recognize expenses amounting to 90,000 related to search engine optimization? Now, search engine optimization is something like, if you have not known about this, we call it SEO, right? Whenever you search on Google something, right? What happens is Google shows you some pages, first page, second page, third page, right? Now, to come on top, what we have to do is we have to do something called a search engine optimization. Our content should be such that the search engines will pick it up and show it first. That should be the objective. Second option is to take advertisements, of course, right? That is one thing what companies do. First thing is to spend on this. Now, this is the expenditure. Now, how should we recognize this expenditure? Is it for the current year, prepaid, and all of that? So let us see what is the information given for search engine automation. Long case study, so we'll take some time to figure out. So the business model, let us understand because it's a new thing. Both of them decided to launch the operations in the area of tourism with effect from 1st of April, wherein the customers would be provided complete package of tourist services in domestic territories and international territories. After a round of discussion, it was decided to incorporate a new partnership firm, Aakash Vani. Salary to the partners will be provided as per maximum limits, I think 40B, as per the Income Tax Act. In the Internet of Things, travel business must be visible to the potential customers when they type the keywords to find similar agencies. This is called search engine optimization. If the site doesn't appear on the top search results, most customers will not bother to find more sites. They will simply click on the top ranking sites. To improve SEO optimization. The company has subscribed for services of such kind for a period of 12 months from 1st of June for an agreed amount of 90. So 12 months, 1st of June means if you look at 1st of April till 31st of March, they have paid 90,000 for 12 months. So per month expenditure is how much? 90,000 divided by 12,000. So 12 sevens are 84, 6, 12 5s are 7,500. So current period there are 10 months. 10 months expenditure is 75,000. 15,000 is prepaid. Now tell me, what has this got to do with the case study? This, even a foundation student will know that this is how we will have to account for it. Okay, so the answer would be 75,000 is expense, 15,000 is prepaid expenditure. 90,000 is to be treated as expenditure, no. Prepaid expenditure, no. 15,000 as expense, no. 75,000 is the expense. Then we have GST, depreciation, 40B for partners, and income tax payable. Calculate the revenue receivable for 22-23 for Aakash Vani from the packages subscribed by customers as per its revenue models, right? So this is where we have to apply the, see the revenue model, and we have to see how much of revenue will be accounted for in the current, current period. Now, how do we approach that? So we'll go back to the customers, the model, what they have. Actual packages subscribed by customers during 22-23 with relevant details are below. So this is the travel given. Okay, this is more than FR. This is more like costing. Huh? So there are a lot of the list of locations given. Journey distance have been given, right? Then package has been given: platinum, diamond, golden, copper, etc. Number of stays 4, 8, 3 that is given. Agency through which the customer is acquired: vendor agent, universal agent. So the company functions through agent. Company functions through agent, right? The revenue model in aggregate collects the following types of charges from the customers. There are minimum fixed charges levied by Aakash Vani for the type of package chosen by the customer and corresponding package, and further hotel charges are varied as per customer's number of days stay in the hotel against the corresponding package. So India, platinum, diamond, golden, copper, silver, fixed charges 1 lakh, fixed charges of 75,000. So that is one, right? Then paid per day hotel charges 5,000, 4,000, 3,000, 2,000. This is also given. So depending on how many, what do you call it? How many days you stay in a particular hotel, you have to plot it. So the requirement is to plot this expense, relevant expenses against relevant map, your customer bookings. Then based on journey distance, you will charge so much per kilometer. So that is also given. It is noted that charges which can be levied from customers as per distance covered is subject to maximum of below limits. So location maximum charge per distance 1 lakh, 1,75,000 and 5 lakhs. So distance charges are capped. Company provides direct subsidy of 10,000 for all visits to holy places. The holy places are given here. Now, actual package. Now, for example, you take customer A. That customer has taken package of India. Package is platinum. So what you have to do? Go back to India. India platinum. So if you take India platinum, fixed charges is how much? Fixed charges is 1 lakh. So like that, we can directly go to the solution and see how do we plot it. The revenue. This is basically preparation of a service cost sheet kind of thing. So first customer India, package platinum. Number of days stay in the hotel 4. It is given in the question. Fixed charges 1 lakh. So you take the fixed charges from that. Then per day hotel charges is also given. You take it. Total hotel charges 5,000 into 4, 20,000. There is no other way to do it faster. Okay, because it's a descriptive question. You are preparing a service revenue sheet. Then billable distance charges. So how much distance did you travel? A lot of back and forth in this question. Traveled 700 in India. So 700 in India per kilometer charges. So 700 falls under this slab. So 700 into 200 makes it 1,40,000. But then there is a limit. In India, maximum charges should be 1 lakh. So you will charge only 1 lakh. So maximum amount charge is 1 lakh. Subsidy, if you have visited a holy place, you'll get a subsidy. So the total amount is your fixed charges plus this 1,20,000 plus 1 lakh, 2,20,000 minus 10,000, 2 lakhs 10. Like that, for example, you see overseas golden or Asia diamond. So Asia diamond, if you see again, if you come back, second customer, Asia diamond. Asia diamond fixed cost is 1,75,000. So there is more of a manual plotting of numbers. You have to be very careful while plotting the numbers. Don't make any mistake and consider the maximum charges for distance traveled. So here you can see maximum whatever is cap, 5 lakhs is cap for overseas. So you'll cap it here. Holy places visits, you will take the subsidy, right? So this gives what? Your fixed charges per day, hotel charges, total hotel charges and distance charges. So that is what you will calculate. Then how to calculate billable distance? 7 kilometers, cost per kilometer based on the slab, total maximum cap. So that it can be done. It's a simple explanation, right? Then this next part of the now here one more thing you have to keep in mind is, can we expect such a in-depth question in the examination? We may get, may not be such an elaborate thing, because to prepare this sheet itself, you will take more than an hour. Okay, you will not have Excel tools in the examination. You have to do a manual computation, a lot of plotting here and there. So if you get these type of questions, preferably keep it at the end. See, it is scoring. I'm not saying no, but is it worth the time? That also you have to consider. Then calculate the commission to be paid by Aakash, Vani to the respective travel agents for 22-23. Yes, it will take time. So that's what I'm saying. See, one thing you have to be smart in all the papers in CA final. What you have to understand is, if there is a new question, like for example, in November 23, we had that first question on consolidation. New question, multiple assumptions are possible. I can have my assumptions, students can have their assumption, institute has their own assumption. In that entire thing, what happens is, if you struggle there, you will lose out on other questions. So please keep one thing in mind. Out of 6 papers, 1 or 2 papers you will get such that one question will be bouncer or 2 questions will be bouncer. You don't know what to do. In that case, ignore those 2 questions. Forget those 2 questions. First finish remaining 80 marks paper or remaining 70 marks paper. Then come back to those questions. Okay, that strategy will only help you. Otherwise, what will happen is, in one question you will end up spending 1 hour. Suddenly you will realize you don't have time for remaining questions. So that is one thing you have to keep in mind very properly, right? Then agency commission, right? So coming back, this is the revenue model. Subsidy, factory packages, subscribe. It may be noted that Aakash, Vani has 2 travel agents, wonder agents and universal agents, through which it acquires business. Tie-ups with travel agents is facilitated by various services, arranging airlines, so on and so forth. The company pays 2 types of commission to its agent, categorized as paid as per flat rate and passenger count. Agents are paid respective commissions as per following details. Flat rate. Flat rate travel agent commission is the simplest type of commission, wherein every travel agent gets fixed standard amount on each booking. So if it's in India, 10,000, Asia, 20,000, overseas 30,000. In addition, very important, in addition to the flat rate commission level Aakash, Vani pays is determined by the business that has been acquired under that agency. Aakash, Vani pays them as per passenger volume, as per the rate pattern depicted below, wherein slab rate of commission would be applied to the travel agent for which he has done the total number of customer bookings during the year. Okay, this is more like a real life scenario. Actually, that's how it works. But these days we have computers and all to take care of all of those things. Passenger booking by agency during the year, 1 to 5 passengers, 2.5% of hotel charges and distance charges. Asia 5%, overseas 7.5%. Okay. 6 to 10 passengers, 5%, 7.5, 10, 11 to 20, 7.5, 10, and 12.5. 21 to 50, 10%, above 50, 15%, right? So that is how it is given. So again, calculation, you have to plot, the number of customers, right? And then the total amount, and based on that you have to pay. So calculations of question is what? It's a big case study. To respective travel agents, so both the travel agents. So first we have to see who has booked through Wonder Travel Agent. Again, come back to the question. So Wonder Agent is A, D. So like this, you have to plot. Direct is direct customer, Wonder Agent, Universal Agent, Direct, Universal, Wonder. So whatever are Wonder, we will pick it up and you will plot them. Yeah, Wonder Agent. Fixed commission, India, Asia, overseas. Based on that, you will put it up. Then whatever is the hotel charges, we can take it from the previous table. Distance charges total. On that, commission. Okay, so commission based on the slab rate. So 7 bookings are done by Wonder Agent. Hence, the slab of commission is 6 to 10 passengers. So 5% for domestic, 7.5% for Asia, 10% for overseas. So here 1,20,000 into 5, 6,000. So total is 10,000 plus 6,000, 16,000. 10,000 plus 5,600, 15,600. Like that you can do. Now in examination, to save space, you can put entire commission in a single column also. That will also be acceptable, right? Same way you will repeat for the second travel agency who has booked 11 to 20 passenger, and accordingly the slab rate should be done, right? So if you ask me, in this case study, there is nothing of FR other than a simple application that also any students of accounting will be able to do. And calculation part is also more logical than accounting based.
Done. Let's look at the next interesting case study, my dear friends. What is that student is asking? Student asking, sir, IBS exam will be easy. Oh my God, what a general question. Hopefully, let's expect that it will be easy. But one point is very clear. Couple of case studies will slightly be tricky, but other case studies will be those which will be very, very comfortable. So it's not that every case study what they give will be tricky. Some questions will be very comfortable for you to answer. See, we have spent all these days, so many days time, so many hours we have spent to get some very good clarity on a lot of interesting points. This will definitely act as an aid while solving your questions in the examination. There is no doubt about it. And copy paste can we expect means not mandatory always, but similar points may be covered. Not necessarily that the same case study will repeat, but a lot of points may be covered. High probability is there. Got it? Not in all the case studies, but majority case studies, they'll cover major points from here. Yeah, next. Akshay is currently working in one of the top multinational companies of the world in Gurugram, namely Kishaniti Limited. At present, he is residing in a rented flat in Gurugram itself and is a vice president finance of the said company for its Asia Pacific operation. Akshay is paid reasonably well by his company as per his designation. Akshay lives in a rented premium luxury flat in one of the premium colonies of the region. He pays a monthly rent of 1 lakh for the flat. However, there are 2 joint owners for the said property. And as per the agreement, 75,000 is paid to joint owner 1, 25,000 is paid to joint owner 2. And Akshay has a basic understanding that TDS needs to be deducted at the rate of 10% of the other party if the aggregate amount credited or likely to be credited or paid exceeds 2,40,000. Fine. That is what Akshay is thinking. So looks like this question is also having a lot of points related to TDS only, my dear friends. Are we ready? Next. However, landlord has shown a reference of website to Akshay that individual HUF who are subject to tax audit owner are obligation to do TDS. Akshay, being a salaried employee, is not required to deduct tax at source to other party. Not at all, my dear friends. In that case, we have got a brilliant section called 194 IB, where the rent is more than 50,000. I hope most of you know 5% TDS. But not on monthly basis, only the time of payment of last month rent will do TDS. Good, very good. Akshay, on the influence of landlord, has done the same and depositing gross amount of 1 lakh in their respective bank account. Oh my God. Recently, a new accountant, Rohit, has been hired by the company, and the company has following data in their books of accounts. CGST payable, IGST payable, SGST payable, receivable, receivable, receivable. That means there is input, there is output. Very good. TDS receivable, TDS payable, including carry forward balance, and TCS payment 10,000. Very good. According to Rohit, company needs to make a net payment of 40,000 for TDS, that is net of TDS payable and TDS receivable. Accountant needs the help of Akshay for the final amount of each title liability to be paid on net basis. We'll discuss that. We'll discuss that. Each net liability means what? We'll take the figures of output, we'll reduce the figure of input, balance will be net payable only. As simple as that. Clear? Next point. But of course, a basic common sense, I hope most of you know already that whenever a TDS is payable, 90,000 on the expenditure, what we have done, and there is something called TDS receivable. That means on the income, what we got. Can we set off the TDS receivable against TDS payment? Obviously, answer is no. This is our obligation, what we have to pay to the government. And somebody is paying to us. They have done the TDS. They'll fulfill their obligation. How can we set off these two? That's not possible at all. Accountant has been told by Akshay to show the treatment of entry is done for a given transaction so that TDS payable can be ascertained accurately. And before the deployment of TDS, Akshay wants to cross-verify the data to check discrepancy, if any. There is a firm and invoice amount is 2 lakh, GST 36,000, total amount 2 lakh 36,000. And what is the nature of payment made? Labor payment that is made. What will happen, my dear friends? TDS will come under section 194C, and TDS will do on what amount, my dear friends? TDS obviously will do on the amount of 2 lakhs. Next, Madanlal payment is made to individual 1,20,000, my dear friends, and contract for AMC. If it is individual, then 1% TDS. But the problem here is PAN is not available, and if PAN is not available, my dear friends, we'll do TDS at the rate of 20%. Next point. Johnson Appliances Private Limited company, total 10 lakh plus 120, 1120, purchase of machinery. For purchase of machinery, where is the question of TDS, my dear friends? For purchase of machine, purchase of goods, TDS will come only when your buyer turnover is more than 10 crores and buyer is buying goods for more than 50 lakh rupees, 194Q TDS. But here it's only 11 lakhs. Eagle Watch Security Private Limited, 80,000 rupees, security services. If it is security service, what will happen, my dear friends? Again, do TDS under 194C. Next. Mario Limited company, goods in the normal course of business, 5,25,000. It's not more than 50 lakh. Then where is the question of TDS? HUF, interest on unsecured loans, 50,000. Come on, my dear friends. If it is interest, then definitely TDS will come under section 194A at the rate of 10%, guys. To a partnership firm, 1,20,000. Consultancy fees is paid to chartered accountant. If it is consultancy fee, which section will come, guys? Come on, please reply. 194J will come. We'll do TDS at the rate of 10%. Next. To one company, 1,80,000. Technical fees, my dear friends. Technical fees, come on. Technical fees, what is the TDS rate? Technical fees TDS rate is actually 10%. It used to be. But last year, they made an amendment where for technical fees, they told TDS rate is 2%. And the question they told, certificate is issued by the officer at 2.5%. This is an old question. This is an old question. That's the reason why in the solution, they would have taken 2.5%. But don't be shocked. In exam, for technical fees, it is 2% only, my dear friends. But the problem here is you have to understand that it is technical fees for architectural services. If it is architectural services, my dear friends, it should ideally not come under technical fees, it should come under professional fees only. The reason being, what do you call legal, medical, engineering, architectural, technical consultancy, they're all covered in professional. So ideally it should be 10% TDS, but since certificate is given by the officer for a lower TDS of 2.5%, we'll apply TDS at the rate of 2.5%, my dear friends. If not for professional, it would have been 10%. Next slide. Good luck home solution individual. Brokerage is paid. Brokerage means what? Commission. But is commission 194H will come into picture. Next. Chotulal, an individual, service for whitewashing of building. It is service and there is a first invoice to the company in the given financial year. That means it does not exceed 30,000. So there is no requirement to do TDS. Next, AMC. If it is the AMC, my dear friend, which section will come? Again, 194C will come where we'll apply TDS at the rate of 2% because they told limited. It's a company. I hope you know that 194C, when receiver is individual or HUF, TDS rate is 1%. If receiver is other than individual or HUF, then the TDS rate is 2%. If receiver is individual or HUF, TDS rate is 1%. If receiver is other than individual or HUF, TDS rate is 2%. Next. Lotus Private Limited, rent is paid. Come on, guys. Rent, which section TDS? Speak out. Rent case TDS will definitely come under which section, my dear friends? 194I. Got it, my dear friends? These are all the cases where how TDS is attracting. Every point we have discussed. Only if it exceeds 2,50,000. What is 2,50,000? In case of 194I, the limit is 2,40,000. And here they told it is 2 lakh per month. And the 240 limit is per annum limit, my dear friends. Assume that all transactions are executed within the state only. And the company has filed TDS return for the month of March on 10th June. For the month of March, we are supposed to file by 31st of May. And not by 10th of June. There is 10 days delay. And for a delay, there is a late fees of 200 per day of default. Next. One of the companies of the group promoter, Shivalik, is separately funded by promoters of their own equity. Strategically, company's operation do not hold much significance from director's vision. Director wants to ensure that this company comes under the ambit of composition scheme and wants to pay tax under composition scheme. Company operates from 2 locations in the same state from where supplies are executed. Supplies are made within the state only. 60 lakhs, location 1, and there is exports 20 lakhs. Location 2, there is exports again. And there is inward supplies, which is where tax is payable under a reverse charge also, my dear friend. And whenever there is export turnover, how can you go for a composition scheme like that? In case of composition scheme, you cannot engage in intrastate outward supplies. Next. Following particulars related to property which has been sold by Kishanati Limited. Date of sale is given, sale price is given, brokerage is given, purchase value is given, brokerage or purchase is given, and purchase date is also given. Very good. So when all the details are given, we can happily compute the capital gains. But by the way, it is short term or long term. We purchased on 8/12/21. We sold on 1/12/22. That means it is held for less than 24 months. If it is less than 24 months, it will become short term. And if it is short term, there is no requirement for index numbers at all, because index numbers are required only when it is long term. Following information is extracted from company's financial: profit before tax, depreciation as per income tax, depreciation as per Companies Act, WDV figures, provision for doubtful debts, donations, interest on late payment of TDS, penalty for violation of law. Very good. First one, calculate the amount of capital gain for sale of property. Let's compute. Come on. What do we start with, my dear friends? First of all, full value of consideration. What is the full value of consideration in the question? 40 lakh rupees. Less expenses on transfer other than STT. Expense on transfer is 1%, they told in the question. Net sale consideration will be 39,60,000. Getting my point, everybody? All of us. Less cost of acquisition. Friends, let me tell you, in the question, they gave cost of acquisition as 20 lakh rupees and brokerage paid on purchase was 1% of purchase value. So which will be 20 lakhs, 20,000. The balance figure will be short-term capital gains, which is nothing but 19 lakhs, 40,000. I'm sure we are clear with this question, my dear friends. 19 lakh 40,000 is my short-term capital gains. So the answer is option B, my dear friends. Next, calculate the amount of deferred tax liability. That FR, there it makes more meaningful sense. That is based on WDV figures you take and you will calculate the deferred tax asset or liability. Next, what is the document name which Shivalik will have to issue with respect to sales made by it? If it gets registered under a GST scheme, directors are rooting for. That means they want, if they take for composition scheme. If they take composition scheme, what document they'll give? They'll give a document called bill of supply. And the payment made to Good Luck Home Solutions require TDS at what rate? Good Luck Home Solutions. Where is that Good Luck Home Solutions? Good Luck Home Solutions, they paid, brokerage is paid. If it is brokerage, 194, H TDS will come into picture. And 194H TDS rate is what, my dear friends? 194H TDS rate is 5%. No doubt about it. Question number 5. Calculate the fees on late filing of TDS return. I already told you the answer for this. It is 200 per day of default and there is 10 days delay. Late fees will be 2,000 rupees. Got it, my dear friend? The person is registered under a composition scheme, then they will issue bill of supply and not tax invoice. MCQ number 4. In case of payment of commission, TDS provisions under section 194H are attracted. And the TDS rate is 5%. MCQ number 5. As per section 234E, late fee for delayed filing of TDS return shall be 200 per day of default. Subject to maximum of TDS amount. And in the given case, there is a delay of 10 days. Hence, the late fee shall be 2,000 rupees. That's it. That's the story of this. Interesting MCQs, guys. Come on. Come back to descriptive question. Pass complete journal entries at the time of recognition of transaction which relate to TDS after consideration of provisions or rules as the case may be. Also calculate the amount of TDS required to be paid. That already explained to you. Each transaction I told you which section TDS will come, what rate also TDS will come. I discussed that with you already, my dear friends. And being Akshay, help the accountant to find out the liability of statutory dues to be paid in government treasury. And what is the liability to be paid? Straight, simple answer, my dear friends. The liability to be paid will be whatever is payable, from that payable, reduce the receivable. Balance with what you get is called net GST payable. And TDS, TCS, both the figures you have to pay to the government. TDS receivable, you can't set off as such. That means this 90,000 you have to pay to government, 10,000 also you have to pay to government. You have to pay the total 1 lakh has to be paid to government. And from this 270, 270, 180, you reduce this 70, 70 and 80. The balance will become net GST payable. That's it, my dear friends. Very, very interesting case study. I don't think it's a big difficulty for you to pass journal entries also, my dear friends. That is very comfortable thing which you would have done practically also. Are we clear with this? Done. Finally, let me talk about one more small interesting case study, guys. One second, let me share the screen. What happened? It just got stuck. Done. Should I ask him a question? Sir, did you get tens during exam time? Obviously, I got tens. There is no doubt about it. See, exam pressure, exam tension will be there for everybody. We are not an exception. Even while I was studying for my exams way back in 2010, that was almost about 14 years back. Even I was very much worried about my exams. Even I was very much tensed. And the pressure was building. But the whole point is all about how do you manage that pressure and tension and come out of it and do your preparation effectively. That is most important. Yeah.
Moving on to the next one, Akshay, working in one of the top multinational companies in Gurgaon, that is Kishaniti. I think Kishaniti is related to agriculture. He is staying in rented flat, so on and so forth. This is a lot of details on GST. Coming to the questions. Income tax. Calculate the amount of deferred tax liability to be shown in the company's balance sheet as of 31st of March. So now they've said deferred tax liability. I don't know why did they give this option. You just need to calculate the amount. So let us go back. Following information is extracted from company's financials for the year ended 31st of March of 23. So for deferred tax related calculation, what do we need? We need what is the carrying amount, what is the tax base. Right? Based on the carrying amount and tax base, that is how we'll be able to calculate what is your deferred tax asset or deferred tax liability. Right? So here, what they are given: profit before taxation, depreciation as per income tax, depreciation as per Companies Act, corporate social responsibility expenses, closing return on value of asset as per income tax, return on value asset as per Companies Act, provision for doubtful debt, provision of. Please understand, Ind AS will follow balance sheet approach. So these two, closing return on value of asset, so carrying amount minus tax base. We'll always see carrying amount minus tax base. Tax base is lower, means in future you will get lower deduction. Means in future you will pay more tax. Means there will be a DTL. So here 10 crores minus 8 crores, 2 crores is this difference. There's the first one. Then second, 2 crores is this different. Then provision for doubtful debts 5 lakhs. Now that provision for doubtful debt 5 lakhs will not be allowed for tax purpose. 5 lakhs of provision for doubtful debts will not be allowed for tax purpose. It will be allowed on actual expenditure. Right? When you incur the actual expenditure, that point of time this will be allowed. Right now it will not be allowed. Okay, that is the second thing. Then donations. Donations is a permanent thing, so that you get you don't get any deductions, or whatever deductions you get, that is done. There is no further treatment of that. Interest on late payment of TDS, that part also it is out. Then penalty for violation of law, again no treatment. Assume income tax is 25%. After the analysis, income tax rate is 25%. We need to calculate what is the deferred tax component. Right now, as we discussed, carrying amount, tax base, carrying amount, Companies at 10 crores, income tax at 8 crores, difference is 2 crores. This will result in what? This will result in deferred tax liability. Correct? Then provision for bad debt. Now, when you have a provision for bad debt, what you need to understand is provision for bad debt I've already deducted. In income tax, I will not get the deduction. When will I get the deduction? I will get the deduction when I subsequently, actually write off the bad debt. So I have already claimed a deduction, means my debtors in the book, if you have to understand it that way, my debtors in the book is less by 5 lakhs. Tax base, there is no allowance. Okay, so here, if I do this, it is minus 0.05. So I am left with 1.95 crores of differences. Or the other way to do is, this too will create DTL. This provision will create what? This provision for doubtful debt, because I will not get a deduction for taxation. I am paying more tax now. In future, I'll have to pay lesser tax. So this will create a DTL. So DTL on 2 crores at 25% will be 50 lakhs. Sorry, 2 crores 20. 2 crores, right? Yes, 2 crores 25%, 50 lakhs. 5 lakhs 25%, 1,25,000 of asset. So you have 4,75,000. Sorry, this is 50 lakhs. 50 lakhs minus 1,25,000, 49 lakhs, 48 lakhs. 48 lakhs 75,000 of DTL. Is this clear? So the answer is, wait, option is not there. So they have not given the option. These options are incorrect. How they have calculated? 2 crores is fine. Provision for doubtful debt. This will not create a DTL. Are we clear on this? This provision for doubtful dates, whatever I have provided in the books, will create a deferred tax asset because I will get a deduction in the future. If I get a deduction in the future, I'll have to pay lower tax in the future. Right now, I will have to pay a higher tax. So it'll create a deferred tax asset. Okay. Expenses disallowed creates a deferred tax asset. That also we can remember. So the options are incorrect. And hence, whatever we have calculated, that is what will prevail. Then document is fine. Payment on TDS is okay. TDS return is okay. Past complete journal entries at the time of initial recognition of transaction in the books which related to TDS after the consideration of provisions or rules. So this again to do with GST. Being Akshay helped the accountant to find the liability of statutory dues to be paid in government treasury for the month of March of 23. Now here in the second part you have to pay, when it says statutory dues to be paid in the month of March because you are in treasury. So basically you need to tell what is the amount that has to be paid. Okay. So amount that has to be paid, there will be various amounts like you have CGST, you have GST, you have TDS, you have TCS. All of that you have to calculate. You would have done it in income tax, and you have to figure out what is the amount to be deposited in the. Basically, you have to calculate what is the amount here, right? So after you have calculated the taxes, the same tax base and all you use, and you can do the calculate the amounts. Now, whatever case studies we have planned, we've completed. Few tips for financial reporting and audit that I would like to share with you. For financial reporting, important standards: business combination, consolidation, financial instruments, then your revenue recognition, leases, foreign exchange, government grants, impairment also has been asked. Then Ind AS 105, non-current assets held for sale, that is also be asked. Revaluation part may be tested. That is one aspect which you have to be careful about. So these questions, basically simple questions. Now, to strengthen your practice before the exams, if you want, or right now, whenever you have time, if you want to practice, what you can do is the test your understanding question or back questions of FR for these important standards. Just have a glance, not the longer ones, the shorter ones, the case study ones. So for example, I'll just show it to you what I'm talking about. Just give me a moment. So for example, Ind AS 20, if you see, what I'm referring to is all these short questions, right? So here, of course, Ind AS will have only short questions. Just have a glance. Same way in any question which is appearing as a case-based question, Just have a glance. Don't spend too much of time. Just give one reading of the question and maybe the solution. If you know one reading of the answer, that will be sufficient for important Indies. So if I'm again repeating Indies important thing, financial instruments, important business combination, this consolidation. Then you have impairment, Indies 105, your income taxes, earnings per share. They may test, they may not test. That I'm not very sure. Then revaluation related part, intangible assets related part, contingencies. So these questions, if you get a hold of it, you'll be able to answer in the examination, right? Do one question on calculation of goodwill, bargain purchase. Then Index 102 also have a look at it. Sometimes they have given questions based on that. Then when it comes to audit, the important standard are 300 series standards, 500 series standards, and 700 series standards, plus professional ethics. Okay, professional ethics just have a list of the thing. What are the what do you call it? Professional misconduct. Maybe this is not coming out. Professional misconduct, right? So under which part, which schedule, which clause it falls, that list you can have. They may ask, see, we have not come across a question where they've asked it, but they can ask things from professional ethics and the series standards that I mentioned, which are important. See, they can ask from anywhere, but everything cannot be covered, or you cannot carry everything, you cannot prepare for everything. DT, IDT is advantageous for all of you because you are writing group 2. So DT and IDT you would have written. The memories will be fresh. So you can use that and score better in. So that is one more aspect you have to keep in mind. If you get a question which is very difficult, which you have seen for the first time, keep it aside, do it at the end. If in a question you feel that I can attempt only half, do that half. Okay. MCQs and all we have seen, and we have seen it in the past, 7, 8, 6 years of old syllabus also. The questions are not really very tough. Okay. So we should be able to manage. Just that we have to keep our calm, utilize our time in the best possible. Okay. So that is my thing. I hope the classes were useful to all of you to get a sense of how to approach the questions, because content perspective, we may not be able to explain everything, but how to approach is very important. So ignore things which are, your things like when we see this, ignore things around introduction that is not relevant. Then ignore things around stuff like, what they are doing. Only when you look at the question and then you come back and then you do it, that will save you good amount of time. All the best for your exams, and hope to see all of you flying, passing with flying colors. And after the exams we'll catch up. In the meanwhile, if you have any doubt, if you have any concept related prop issue, you feel something else is missing, anything, you can ping in the group, and we'll be more than happy to help you. Forums are there, of course. So all the best, and thanks a lot.
Case study 26. Okay, so this has got 3 MCQs. Let's 2 MCQs and 1 descriptive question. So let's read it. Okay, this is also kind of simple. It's relating to audit and auditors chart. Okay, let's read. So I'm reading MCQ 3 of case study 26. Okay. Now, is the contention of Mr. M correct regarding disqualification of ABC and Associates as statutory auditor of RA Limited? So there are two entities here. RA Limited is a company and ABC and Associate is the company. Now, ABC and Associate, they have to be appointed as a statutory auditor of RA Limited. Whether they are disqualified or not, we have to check what Mr. M is saying. So let's read the case study for this. Then we can check, we have got disqualifications which are available with us. So disqualifications are covered in our section 141. We'll have to refer to them and accordingly we'll see. Okay, so let's read the case study. RA Limited has constituted an audit committee under section 177, and all the appointments including casual vacancy of the auditor, etc., are made by the committee. A proper manner and procedure for selection and appointment of the statutory auditor of RA Limited was undertaken. Finally, ABC and Associate was selected as the statutory auditor for this company. Before such appointment was made, a written consent, etc., was done, and criteria was checked, and all these formalities were done. Okay. Now, CAA is the engagement partner. for the audit of RA Limited. Okay. During the year, the husband of the daughter of Mr. M, purchased 10,000 shares at face value 10 rupees in RA Limited from National Stock Exchange after the payment of 95,000 rupees. In the preceding year, he had bought 40 shares of RA Limited at 120, which he still holds. Okay, so this is relevant for us. Now, is this ABC an associate, qualified or disqualified? So what is happening? We have got A, B, C and associates. We have to check whether they are disqualified or not. Now, one of the partners is CA. CA is the engagement partner. He'll be signing the audit report. So we have to check whether he is qualified or not. Accordingly, we can decide, whether this firm is qualified or not. Now, Mr. A has got a daughter and the daughter has got a husband. That husband of the daughter has purchased 10,000 shares. Face value is 10 rupees. Okay. Now, at 95,000 rupees. So market value is 95,000 rupees. Now, last year also, this man had purchased 40 shares at a higher market value, at 120 rupees market value. But again, 120 rupees market value is irrelevant for us. Face value is 10. So these are the number of shares that are held by the husband of the daughter of the auditor. Okay. Now, is there any disqualification? We have to check. Okay. So if you remember, section 141 talks that, what does section 141 say? It talks about the eligibility, qualifications and disqualifications of the auditor. It says, yes, Zoom user is absolutely correct on the chat. So it says that a person is disqualified if he holds securities of face value 1 lakh rupees. Face value, okay, or his relative or partner. So the person who or his relative or partner is holding security in the company or subsidiary or holding or associate or subsidiary of such holding, okay, where the face value is more than 1 lakh rupees. So up to 1 lakh rupees, it's okay. Face value of 1 lakh rupees, up to that amount, it's okay. There is no disqualification. But any amount more than that, if the face value is more than 1 lakh rupees, there is a disqualification on that person, or even if the relative is holding the securities, or even if the partner is holding the securities. So what is a relative? We have to first check the definition. Definition is given in 2 clause 77. Okay, it includes member of HUF, husband, wife, father, mother, son, son's wife, daughter, daughter's husband, brother and sister. So daughter's husband is a relative. So daughter's husband also cannot hold securities of more than 1 lakh face value, right? So here, can we say that this person CAA is disqualified? His daughter's husband is holding how many securities they are holding? Total face value is more than 1 lakh or less than 1 lakh? See, 10,000 shares, we don't have to take market value here. We have to take face value or nominal value. 10,000 shares into 10, that is 1 lakh rupees. 40 shares into 10, that is 400 rupees. So that becomes 1 lakh 400 rupees. 1 lakh 400 rupees security face value is there. So the person is disqualified? Yes, he is disqualified. That is relevant for us. So accordingly, can we select the answer? This is first MCQ. Is the contention of Mr. M correct with respect to disqualification of ABC and associate? Yeah, but in order to answer this question, we have to see what Mr. M is saying. Now, we know he is disqualified, but what is Mr. M saying? Is Mr. M also saying he is disqualified or what? Okay, so let's read Mr. M's contention also to correctly answer the question. Since RA Limited has invested in Chandra Suppliers Limited, Mr. M expects that the share prices of RA Limited would definitely increase in the near future to a lucrative deal. Irrelevant information. Mr. M has a slight idea about the provisions of section number 141 regarding disqualification, and since the shares were purchased for only 95,000 rupees, and that too in his name and not his wife's name, Mr. CA will not be disqualified to continue as the auditor. So Mr. M is saying that he's not disqualified. Is the contention of Mr. M correct? Is Mr. M's contention correct? Yes or no? Mr. M is wrong. Correct. Mr. M's contention is not correct. Okay, we'll select accordingly the right answer. Let's read the options. Mr. M's contention is correct or not? Yes. Yes, so any which way is wrong. Yes, since the total cost of the investment of Mr. M in the shares has not exceeded 1 lakh rupees. This is incorrect. Contention is wrong. No, though his cost of investment in the shares has not exceeded 1 lakh, he is covered in the definition of relative of this, holding securities of even small value as relative. This is irrelevant again. Okay. No, since the face value of the investment has exceeded 1 lakh rupees and he is covered in the definition of relative. This seems like the correct answer. C. Perfect. Yes, though the fair value of the investment has exceeded this, he is not covered in the definition of relative. Again, wrong. So C here is the correct option. Now, based on exactly this data and this provision, we have got question 4 also. So let's read question 4. It's based on this only. Assuming a circumstance that ABC and associate is disqualified. Just now we discussed, no? Assume that they are disqualified to be appointed as the statutory auditor of RA Limited due to a relative defined in Section 2, Clause 77 of the Companies Act, who has brought shares of RA Limited above the threshold limit. Within how many days can the auditor take corrective action? Within how many days? So Mr. A to be the auditor, within how many days should this relative sell off the shares or come within the limit? 90 days or 60 days? 90 days or 60 days? These are the options. So we'll have to refer to section 141 only. Section 141 says that corrective action has to be taken within 60 days. Section 141 says that if the relative has more face value shares or securities, then corrective action can be taken within 60 days of such acquisition of interest or interest. Okay. So 60 days is your direct correct answer, A. Okay. Okay. So we've done one more MCQ. Now we have got one more descriptive question left for today. Let's read descriptive question number 7. What manner and procedure shall be allowed in RA Limited for selection and appointment of ABC and associate? Refer para 2. Okay, so here it's a very simple, straightforward question. Manner and procedure we have to say. What manner and procedure has to be followed by this company for the appointment of the auditors? So for the appointment of the auditor, what is the manner and procedure that has to be followed? Okay, so just for reference, let's look at the case study also. So in the case study, what they've done in para 2, it is mentioned that, guys, can you give me just 1 second? There's someone on the door. Just give me 1 second. Meanwhile, please read this part. Hello, everyone. Thank you for waiting. Okay, let's read this part of the question. See, the first few lines, they tell us that an audit committee is appointed by this company under Section 177. RA Limited has constituted an audit committee under Section 177, and all the appointments, including filing of casual vacancy of the auditors, are made after taking into account the recommendations of the committee. Okay, so that means here we just have to check what are the procedures that an audit committee has to follow for the appointment of the auditor. So this is simply mentioned in our section 177 and the related rules. You simply have to copy paste the procedure here. Okay, so let's quickly go through it. So this is simple theory. There's no application of the provision or anything here. This is a direct question. Okay, so what is the procedure to be followed? It is mentioned in your rule number 3 of the company's audit and auditors rules 2014 that has to be read along with section 177. It basically lays down that the following manner and procedure has to be followed by the company and the audit committee in order to appoint the auditor. First, what? If suppose the company needs an audit committee as per section 177, then audit committee should be appointed. Otherwise, board of directors, they are going to be doing the appointment of the auditor. What are the steps that have to be taken? They have to take into consideration the qualification and experience of the individual or the firm that is proposed. So based on the size of the company and the requirements of the company, they first have to check what are the qualification of the auditor, experience of the auditor. It can be an individual or it can be a firm of chartered accountants, right? Next, they have to call for any additional information if required. Okay. Next, they have to check if any proceedings are pending with the ICI against that individual or firm. So if any proceeding or any matter is pending, they have to take consideration of that also. Okay. Next, now based on this, if suppose the company has got an audit committee, they will see all of that and make a recommendation. This recommendation will be made to the board of directors. Then the board of directors are going to consider this recommendation. If they agree with this, then this discussion will be further taken to the general meeting. The members will be given the details of the auditor, and finally the members are going to pass the ordinary resolution and appoint the auditor. But it may happen that board of directors, they do not agree with the recommendation of audit committee. If they don't agree, it's okay. They can refer it back to the audit committee. They can tell them to reconsider it and give other options. So it may be possible that audit committee reconsiders it and gives another option to the board of directors. If the board of directors agree, then that will be taken to the general meeting. Okay, if the board of directors do not agree, then they will write down their reasons of disagreement and they will send their own recommendations to the general meeting. Okay, so it's possible, ultimately the decision is of the board of directors. If they like the recommendation of audit committee, great. Otherwise, they will have to simply write down the reasons of disagreement and they can suggest their own own auditor and they can give this suggestion to the members in the general meeting. If they pass the ordinary resolution in the general meeting, auditor will be final. Right? Now, the auditor, once appointed, will hold office from the conclusion of that meeting till the conclusion of the 6th annual general meeting. Okay, so that is the provision that you will have to mention. Now, again, you don't have to write all of this in legal language. You have to read, understand, frame it in your own words, and then write it into points in the exam. All right. So with this, we have completed 5 case studies that we had to do today. Okay. So do you guys have any questions? We are done with today's session. Okay, now tomorrow also I have a session. Tomorrow I'll be covering another 4 to 5 case studies and mostly we'll be done with this like November 23 case study digest tomorrow. So tomorrow also I'll be coming at 7 o'clock to meet you. Okay. Okay. So let's wind up the session. Yeah, keynotes will be provided. I'll see you tomorrow. All right. Good night. Bye-bye.
I'll share the screen. Just a second. Give me 1 minute. Yeah. Please look at the case study number 26. Is the screen visible for you? Please reply. Okay. Please see that, my dear friends. RA Limited, a listed company, is engaged in the business of manufacturing aerated soft drinks. So they're in what business, my dear friends? Aerated soft drinks, which include various flavors like cola, orange, and lemon. Chandra Suppliers Limited is engaged in the business of manufacturing carbonated sugar, which is the main ingredient for aerated soft drinks. And Chandra Suppliers Limited has been supplying carbonated sugars to RA Limited since past few years. And RA Limited is the main customer of Chandra Suppliers Limited. And in the last financial year, 89.9% of the output of Chandra Suppliers Limited was procured by RA Limited. So the biggest customer of Chandra Suppliers is nothing but RA Limited. Next. RA Limited has invested in the share capital of Chandra Suppliers Limited on the first day of financial year at a cost of 55 lakhs and is holding 12% of Chandra Suppliers Limited total voting power. And the carrying value of net assets of Chandra Suppliers on the date of acquisition was 4 crores and the fair value is 4.5 crores. Excess of fair value over carrying value was attributable to one of the warehouse owned by Chandra Suppliers Limited, which is having a remaining useful life of only 10 years. So this has an impact on your financial reporting. At the end of financial year, Chandra Suppliers Limited earned a profit of 6,60,000 and a comprehensive income of 98,000. And the dividend is declared by Chandra Suppliers Limited in the year was 2 lakh rupees. So this is a story of all the relationship which is there between Chandra Suppliers Limited and RA Limited. Next point you see. RA Limited has constituted an audit committee under 177 and all the appointments, including the casual vacancy, everything is made. So this is all related to your auditing related elements. Just 1 second, my dear friends. Yeah, see that, my dear friends. CAA is the engagement partner for audit of RA Limited, and during the year, husband of the daughter of CAA, Mr. M, purchases 10,000 shares. Face value is 10 in RA Limited from the National Stock Exchange after payment of 95,000. And the preceding year, he had bought 40 shares in RA Limited at 120, which he still has in stock. Since the value of shares had fallen in the current year, he thought it was a good opportunity to reduce his average cost and earn good profits in the future. That's how people start thinking. Since RA Limited has invested in Chandra Suppliers, M expects that share price would definitely increase in the near future due to lucrative deal. And Mr. M had a slight idea about provisions of 141 regarding disqualification of auditor, since share were purchased only for 95,000 and that too in his name, not in wife name. Oh my God. That's a dangerous disqualification given in auditing. Yeah. So everything is auditing. Next. Wife of chairman of RA Limited is a renowned painter. She holds various exhibitions in India and around the world and has won several awards as well. Her art gallery is on the 4th floor of office building of RA Limited. Office building consists of 4 identical floors and other 3 floors are used by RA Limited for the business. So 3 floors are used by RA Limited. 1 floor is used by the wife of the chairman for the purpose of gallery. A machinery total rent paid by is 8 lakh rupees for the entire office building. So for total building together, the rent paid is 8 lakh per month. A machinery was purchased for 20 lakhs on July 1st of the financial year. On July 1st, a machine was purchased for 20 lakhs and was put to use on August 1st. Depreciation under Income Tax Act is 15%. And interest payable for the financial year for purchase of machinery amounted to 2,40,000. Very good, very good. And I hope you guys know very clearly that interest on asset purchase till the asset is put to use, that will be capitalized. Next. Municipal elections were held in current year and various representation from different political parties visited RA Limited for donations. RA Limited thus decided to give a full-page advertisement in the brochure published by political party costing 50,000 rupees, which is not registered with Election Commission of India. So let me tell you very clearly that if it is not registered with Election Commission of India, then we really cannot take that decision. We cannot take that deduction because let me tell you, section 37(2)(b), 37(2)(b), advertisement expenditure in a souvenir, brochure, pamphlet published by political party that cannot be taken as deduction as per section 37(2)(b). But of course, you might get the thought that, sir, why can't we take that here? The logic is very simple because it is not related to your business. So that's the reason why you will not be eligible to take that decision. You might get the thought, sir, what would have been your answer if he is a registered with Election Commission? Even if a registered Election Commission also, still I can't take under 37(2)(b). But there is one slight possibility that section 80GGB gives deduction for contribution to political party. By company to political party, GGC gives for other than company to political party. Student is asking, sir, please explain the point once again. Don't worry, let me explain that to you once again. Sir, what I'm trying to tell you is that in case of contribution to political party, wherein if there is an advertisement expenditure which is incurred, and advertisement is done in a brochure, pamphlet of political party, my dear friends, that advertisement expenditure, we cannot take it as deduction as per section 37(2)(b). However, my dear friends, we can still take deduction under section 80GGB in case of contribution by company to political party. And that too only when political party is registered with Election Commission of India. That is important. You got it, my dear friend, what I told? So to clarify, one line answer, advertisement expenditure in a souvenir, brochure, pamphlet published by political party is not allowed as per section 37 2B. However, we can take chapter 6A deduction under section 80 GGB or GGC. GGB in case of company to political party, GGC in case of other than company to political party. Next. RA Limited supplies the soft drinks pan India under the name of Too Cool. Wow. The goods are supplied to distributors in all the states of India and eventually to the retailers by distributors. Neeraj Transport Company has been hired by RA Limited for delivery of the products to all the Indian states. Company has made total payment of 10 lakh rupees during the year to Neeraj Transport for applying its goods from factory to the distributors. During the year, payment exceeding 10,000 in cash, 25,500 was made to Neeraj Transport in a day. But still, let me tell you, there is no problem at all. Why? Section 40 capital A3 says single person, single day. If you are paying more than 10,000 by other than account pay check or account pay draft or online transfer, that is not allowed. But however, the interesting point to be noted is that the limit in case where payment is made to a transport agency, the limit is not 10,000. The limit is 35,000. Got the point, everybody? So in this particular case, without any problem, we can go ahead and take the next. RA Limited made a provision for gratuity every year for 40 lakhs in the books of accounts. During the year, 2 employees retired from the company after serving for many years. And payment made to the employees towards payment of gratuity on their retirement amounted to 2 lakhs. So the point is very clear, my dear friends. Whatever is actually paid as gratuity to the employees, that much only we can take deduction. But provision for gratuity, that we can't take it as deduction. Because there is one section called section 40 capital A7, which clearly says that provision for gratuity is not allowed as deduction. Provision for gratuity is not allowed as deduction unless it is transferred to something called approved gratuity fund or it is actually paid to the employee. So in this case, the point is very clear, my dear friends, that they told they made a provision for gratuity. The provision for gratuity, that we can't take it as expense. Let me proceed to the next line. RA Limited incurred expenditure of capital nature of 7 lakh rupees on scientific research related to business carried on by it. Wonderful. And that too, that is incurred 3 years back. Friends, can I listen from you? If it is incurred 3 years back, is it okay, my dear friends? 100% answer is yes. Because we have got one section known as section 35, which talks about expenditure related to scientific research. Even if it is incurred prior to commencement, that is allowed as deduction. If it is incurred within 3 years, immediately preceding commencement of business. And let me tell you, my dear friends, in case of specified business, section 35 AD, there also expenditure incurred prior to commencement, that is also allowed as deduction. And it is important to note that in 35 AD specified business, there is no time limit of 3 years, my dear friends. The time limit of 3 years is only in case of scientific research. Next point. In addition, land was also acquired to carry out the capital research along with capital assets. This capital asset was sold in the current year without having been used for other purpose for 1 lakh. So that means you have taken the capital asset, land was acquired to carry out, right? So if it is land, we cannot take deduction at all because section 35 clearly says capital expenditure or revenue expenditure, both is allowed as deduction, but if it is related to land, that we can't take it as deduction. Got the point, everybody? Because section 35 clearly says any revenue expenditure, capital expenditure, that we can take it as deduction under section 35 if it's related to scientific research, except expenditure on land. See next. Profit of the company before accounting for all the above transactions is 5 crore rupees. Before accounting for all the above transactions, means the above transactions are still not yet captured. Next, CAA commenced the audit of RA Limited with the audit team consisting of 8 members. On examination of records, various observations came into the notice of audit team. You, a qualified chartered accountant, is also one of the audit team members. You volunteered to answer all the queries of the team since company audit has always been your area of interest? Oh my God. First question, significant influence. Not related to tax. Second question, not related to tax. Third one, related to disqualification of auditors. Fourth one, related to Companies Act. Oh my God. Yeah. RA Limited incurred two different types of capital expenditure on scientific research. Which statement is correct? Which of the following statement is correct? For capital expenditure incurred prior to commencement of business, expenditure so incurred within 4 years. Friends, is 4 years correct statement? Definitely answer is no, my dear friends. That is not correct at all. What is that they asked? Which of the statement is incorrect? Very good. So statement 1 is definitely incorrect. Statement 2. No deduction will be allowed in respect of capital expenditure incurred on acquisition of land, whether the land is acquired as such or as a part of any property. Very much true. This statement is correct statement, my dear friends, because section 35 clearly says revenue expenditure and capital expenditure on scientific research is allowed as deduction except expenditure on land. Statement 3. Capital expenditure incurred on scientific research which cannot be absorbed by business profits cannot be carried forward to immediately succeed in previous year. How is that? Unabsorbed capital expenditure on scientific research can be carried forward for indefinite period, like unabsorbed depreciation. So this statement is incorrect statement. Next point. Section 35(2) clarifies that no depreciation will be admissible on any capital asset represented by expenditure which has been allowed as deduction under 35, whether in the year of deduction under 35 was allowed or in any of the previous year. This statement is 100% correct, because once we take 100% of the cost of asset as deduction, there is no question of claiming depreciation. So what is incorrect is only statement 1 and statement 3. Those two are incorrect. So without any second thought, my dear friends, answer is option B. I'm sure we got clarity on this point. Friends, come on, please reply. Yes, very good. As per section 35, both revenue and capital expenditure on scientific research is allowed as deduction, except land. Further, expenditure incurred within 3 years prior to commencement of business is also allowed as deduction. It's a very, very interesting point, my dear friends. Just 1 second, guys. Yeah, thank you so much. So friends, I'm sure you got this point, everybody. Good. Thank you very much. Fair enough. Sounds good. Thank you. Go on. So descriptive questions. First point is very clear. Closing value, that's Ind AS. Selection and appointment of ABC, that's related to your auditors. 8th question. Calculate net profit of RA Limited chargeable to tax under PGVP after making adjustments for transaction given in para 3, my dear friends. Para 3, let's once again recall what are the points which are there and then take a decision. Go on. So what is it they have done, my dear friends? Total rent paid is 8 lakhs per month. And we have discussed very clearly that out of 8 lakhs per month rent, 1 floor is used for the purpose of wife of MD, which is nothing but personal purpose. That personal purpose that we can't take it as deduction. Correct? Then 20 lakh rupees is the cost of machine which we have purchased on July 1st and it is put to use on August 1st. So 1 month interest, whatever is there, that we will add it to the cost of assets. Interest payable is 2,40,000. So when, my dear friends, now tell me, when the interest payable is 2,40,000, my dear friends, what is it that is going to happen? interest till the date asset is put to use, that will not charge it to P&L account, that will add it to the cost of assets. Now, please tell me, what is that will add it to the cost of assets? Come on, you tell the answer. How many months you will take? Students are telling 1 month. But the point you have to note here is that in the question they told interest payable for the financial year for purchase of machinery amounted to 2,40,000. 2,40,000 is the interest for what, my dear friends? For the financial year. And how many months interest you have to capitalize? You have to capitalize interest for the period starting from when, my dear friends? For 8 months interest. That means technically it is put to use from August 1st. August 1st it is put to use. That means August onwards we will charge off to P&L account, and April, May, June, July, that 4 months interest, my dear friends, will capitalize. 4 months interest will be what, my dear friends? Capitalized. Did you get the point, everybody? So I'll repeat once again, please understand. In case where there is a loan taken for purchase of asset, interest till the date asset is put to use, that will be capitalized, and interest for the period after asset is put to use, that will be charged off to the P&L accounts. Correct? And in this particular case, what has happened? Total interest for the financial year is 2,40,000. When the total interest for the financial year is 2,40,000, my dear friends, out of that, from August 1st, it is put to use. Student is asking, sir, it was purchased in July. I totally understand that it's purchased in July, but in the question they told interest payable for the financial year. So when is that loan taken? That they have not given properly that point, my dear friends. If the loan is taken on July 1st, then obviously we'll take it for 1 month. But that clarity is not given when was the loan taken. So we can, we can take an opinion here that loan is taken in April only, and the machine was put to use on August 1st. And that interpretation I have drawn only because they have used the word interest payable for the financial year. That means April to March. April, May, June, July, I'll add it to the cost of assets. Then after that, we'll charge off to P&L. Then can I proceed? Very good. Municipal elections were held in current year. That donations political party we have seen. Next, goods were supplied to distributor. That cash payment, that is also okay. And gratuity, I told you that whatever is actual paid, that is only allowed. Fine, fair enough. I think we can do the working now. Can I proceed, my dear friends? Yeah. Profit before any adjustment of transactions. That's what they clearly told. Profit before any adjustment of transactions, my dear friends. That's what they clearly gave in the question, which is nothing but 5 crores. Friends, yes or no, my dear friends? And from that, what is the first thing we have to reduce? Rent. And what is the rent figure, my dear friends? Come on, please tell me. The rent figure is how much? Rent figure, we have discussed that it is 8 lakhs per month. Out of that 8 lakhs per month, there are 4 floors for the building. And out of the 4 floors, only 3 floors are used for business purpose into 12 months. This is what I'll reduce. Next, depreciation. Let me write here. Cost of assets is very clearly 20 lakh. interest till asset is put to use. Interest till asset is what, my dear friends? Put to use. So an interesting point, please note this point, my dear friends. Interest till asset is put to use will be 2 lakh for the interest they gave, right? 2,40,000 into 4 by 12, which is nothing but 80,000. And total cost of asset is 20,80,000. On that, I will charge depreciation at the rate of 15%, and I'll take it for a whole year, because we know that in the first year of purchase, if the asset is put to use for less than 180 days, we'll claim half of normal depreciation. And in the first year of purchase, if asset is put to use for 180 days or more, we'll claim full depreciation. So that is my depreciation rate adjustment, my dear friends. Are we getting the point, everyone? Next. Interest on asset after it is put to use. Total figure is 240. Out of that 240, 80,000 we capitalized. So I'll take this figure as 1,60,000. Friends, getting the point, everybody? And payment to transporter, how much we paid? We paid 10 lakh rupees. How much we paid is 10 lakh rupees, my dear friends. Then payment of actual gratuity to employees. I'm reducing this because they clearly told in the question that these adjustments have not been done. Payment of actual activities. How much is the actual payment of gratuity? Let me go back to the question. It's 2 lakh per employee or 2 lakh for all the employees? Payment, they made a provision for gratuity every year for 40 lakhs in the books of accounts. And during the year, 2 employees retired from the company after serving for many years. And payment made to the employees towards gratuity amounted to 2 lakh rupees. So what I should do is I have to reduce there only 2 lakh rupees, my dear friends. Done. There's a situation so far. Let us see if there is something else also. Rent we have captured, depreciation we have captured, interest we have captured, payment to transporter we have captured, gratuity also we have captured. Somebody is selling 2 lakh, we reduce 20,000. Did I? Let me check. Oh yeah, 1 second. You are right. Correct. Right. Got it. Thank you. Let me go back to the question. So donations, I'll not give any treatment because it is not allowed. Rent we have captured. Interest we have captured. 10 lakhs to transporter, that also we have captured. Then 2 lakhs gratuity to employees, that is also covered. They incurred capital expenditure of 7 lakh, that we have not taken because section 35 deduction is already taken. So 3 years back when we purchased, right? In addition, land was purchased. They have incurred capital expenditure of 7 lakh rupees 3 years back, which was deductible in full in that previous year. Means already we took that deduction. In addition, land was also acquired to carry out capital research. This capital asset was sold in the current year. Oh, so that means whatever 7 lakh asset we have, we have incurred capital expenditure of 7 lakh rupees on scientific research related to business carried on by 3 years back, which was deductible in full in that previous year. In addition, land was also acquired to carry out the research along with capital assets. This capital asset was sold in the current year without having been used for other purpose for 1 lakh. Very good. I understood what they are trying to tell here. Let me write. Sir, there is one provision in the law which says that as per section 41(3). As per section 41(3). If an asset is acquired for scientific research, when asset is acquired for what, my dear friends? Scientific research, and deduction is claimed under section 35. And such asset is subsequently sold, my dear friends, without using for other purpose. That is important. Then what will happen is deduction claimed or sale price, whichever is lower, is taxable under PGBP. This point is an important provision, my dear friends. So to this profit, I should also add profit on sale of capital assets, which is nothing but 1 lakh. You're getting my point, everybody? Is this point clear for all of you, my dear friends? So income under PGBP is nothing but this minus sum of all this plus this. So my dear friends, the answer is 4,12,28,000. That is how we arrive at the net profit. And I've done this working very clearly based on the point they told in the question that the profit figure of 5 crores is given without adjusting all the points. Since they have given that point very clearly there, this is what I've done. Are you all getting clarity on this point, my dear friends? A very interesting case study actually. Makes a lot of sense. Can I proceed? Please reply. Student is telling sir, last adjustment. My dear friend, last adjustment, let me tell you very clearly. If an asset is acquired for scientific research, we would have already taken deduction under section 35. Yes or no? 100% of the cost is taken as deduction. And law is telling, if that asset is subsequently sold, then whatever deduction you have taken, what is that line, my dear friends? Whatever deduction you have taken, or whatever is the sale price of that asset, whichever is lower, that will be taxed under PGBP. Logic is simple. Let's say we purchase asset for 10 lakh. 10 lakh deduction we have taken, and subsequently the asset is sold for 12 lakh rupees. Law is telling 10 lakh will tax under PGBP, 2 lakh will tax under capital gain. And in this case, the asset value is 5 lakh, and we subsequently sold it for 1 lakh rupees, 5 lakh deduction taken. And when we sold for 1 lakh, then law is telling very clearly that 1 lakh will be taxed under PGBP. Lower of sale price or deduction will be taxed under PGBP. Did you get my point, everybody? Please reply. Now clear, now clear, now clear. Done. Let me proceed. I'll proceed. Fair enough. Thank you very much. Good. Love the participation.
Good evening, everyone. So regarding that thing, right, notes. So financial reporting is almost ready. By tomorrow evening, it should be available. Right, and after that, I'll give you the notes related to audit and other subjects. So we'll continue our discussion on the case study digest part, where a law part has been completed. Audit also I'll be providing. Don't worry about that. So today we'll be doing case study number 26 from your case study digest for November 23. That is also a part of RTP May 24. So both will be covered in the same case study. Case study number 26. Let me just share my screen so that. So this is about a company called RA Limited. So let us have a look at it. RA Limited, a listed company, is engaged in the business of manufacturing aerated soft drink, for cold drinks, what you say, Coca-Cola and all of those things, which includes various flavors. Okay. Chandra Suppliers is engaged in the business of manufacturing carbonated sugar, which is the main ingredient for aerated soft drink. So they manufacture that. Chandra has been supplying carbonated sugar to RA Limited for the past few years. RA Limited is the main customer of Chandra Suppliers, and in the last financial year, 89.9% of the output was procured by RA Limited. Okay, so that is the background. Now, the next part talks about RA Limited has invested in share capital of Chandra Suppliers Limited at a cost of so much. So this gives us perspective of investment by RA Limited. So depending on how the question progresses subsequently, we will see what is to be done with that particular information, right? Then they have constituted an audit committee. This is under Companies Act. CA is the engagement partner for audit of RA Limited. So this talks about the auditor. There could be a related party, not related party, the appointment of auditor part, where you may or may not be allowed to hold the auditorship. Also, this will be a part of your Company Act. So because now company audit is not there as a part of finance syllabus, this is more from the point of view of appointment of auditors from law point of view. Anyways, we will discuss that if it is not already discussed. Just a second, there is some issue with the screen sharing. Just a moment. Okay. Then the wife of chairman of RA Limited is a painter. She holds various exhibitions around the world. And so whenever you see, things around painter, exhibition and all of those things, that will form part of GST, which will be discussed as a part of taxation. Right? Now, if you look at the multiple choice question, first, in your opinion, does RA Limited hold significant influence on Chandra Suppliers Limited? Right? Now, what does it mean? You have RA Limited. So if we come back to the question, RA and Chandra Limited. So here is where we have to search for the answer. RA Limited has invested in the share capital of Chandra Suppliers on the first day of the financial year at a cost of 55 lakhs and is holding 12%. What is the percentage required for significant influence? The question is asking whether there is significant influence or not. Now, what is the percentage of shareholding required for significant influence? It is 20%, right? So that part is one thing. Then here they said RA Limited is the main customer of Chandra Suppliers, and about 90%, 89.9% of the output is taken by RA Limited. So that dealing is also there. So we have the dealing. Then the carrying value of net asset is given. Excess of fair value over carrying amount was attributable to one of the warehouses owned by Chandra. So this talks about assets and all. We will see if any question is there, because we have to first establish whether there is significant influence or not. So now, if you look at the options, first, yes, if an entity holds directly or indirectly through a subsidiary 10% or more of the voting rights. So here, 10% is not relevant. We need 20%. Yes, since 89.9% of the output of Chandra Suppliers is procured by RA Limited, Chandra Suppliers will be dependent on RA Limited for continuation of its business. So RA Limited holds significant influence on Chandra Limited. Now here, The second part of the question, or the second bit what it talks about, is a significant dealing relationship. That is, one entity is economically dependent on the other entity. Now, when we apply the principles of your significant influence, or when we talk about related party, or whether there is significant influence or not, this could be one factor which is considered. We will see if we have more options that is available. Right? Second. Third, since the output of Chandra supplies procured by RA Limited is not 90% or more. Now, do we have any limit called 90% or more, which we have learned in any Indias? Do you recall something, where they have said 90% should be held for being significant influence? Now, can we say 89.9% is almost same as 90%? Can we say significantly is 89.9% almost same as 90%? Anybody else who wants? So one is, there is nothing called 90%. We have to see whether there is any significant relationship or significant influence, because one entity is economically dependent on another entity, whether such scenario exists or not. Now, whether it is 89.9% or 90% is only 0.1% difference, and it is not a law that you have to maintain 90%. Okay. Also, when we talk about Indies, we also have to look at substance over form. So if you look at substance over form, this looks more appropriate rather than this. Then third, if an entity holds 20% or more of the voting rights of an investee, only then it is presumed that the entity has significant influence, unless it can be clearly demonstrated that it is not. Correct? We need 20% or more, but this talks about 20%. If we have 20% or more, then it is an influence that we anyways know. But here, when we talk about, because it is 10%, this voting of 20% and this doesn't is applicable. So the economic dependency is where it becomes more appropriate to consider as option C. Is this clear? Right. So now, where do we learn this? So I'll just take you through the notes as well. So that, significant influence is the power to participate in financial and operating policy decision of the investee, but is not control or joint control. So if it is control, it becomes over parent subsidiary. If it is joint control, it becomes a joint venture. Substantial or majority ownership by another investor does not necessarily preclude an entity from having a significant influence. Means even if somebody else has 60%, 70%, we can still have significant influence, right? Now, some presumptions are there. If an entity holds directly or indirectly 20%, this is the case, but here it is a case of 10%. If the entity holds less than 20%, it is presumed that the entity does not have significant influence. Then there are some judgments that are required. And one of the judgments, if you see, representation on board, participation in policy making, material transaction between the entity and investee. Now, here we have not defined what is material, but because it is 89 or 90%, 89.9% dependency, it implies that there is a significant dependency, and hence it will be considered to be your significant influence, right? So coming back. Then once we have significant influence, then we have to see how do we account for that, right? RS Limited excess cost of investment over its share of net fair value of the Chandra suppliers will be treated as that dash and will be included in the carrying amount of dash, right? Now, please understand, when we have significant influence, we say that it becomes an associate. If it becomes an associate, we apply equity accounting. And as per equity accounting, whatever is the amount paid minus whatever is our net asset share, this excess amount is called goodwill. So which option is appropriate? Goodwill is appropriate. So it is goodwill. And this goodwill will not be shown separately as an asset. This goodwill will be included in investment amount. So option B is the right answer. Then coming to disqualification of auditor. So let us come back to this case. CA is the engagement partner for audit. During the year, husband of daughter CA purchases 10,000 shares, face value of 10 per share in RA Limited from National Stock Exchange after payment of 95,000. He had bought 40 shares in RA Limited at 120, which he still has in stock. So, husband of the daughter of CAA, husband of the daughter of CA, so CAA is the partner. During the husband of daughter, so you have a daughter, and then you have the husband of the daughter. Okay. Now that person has purchased, or that person, this person husband has purchased 10,000 shares of 10 each. So 10,000 into 10, then plus already he has 40 shares, 40 into 10. So 10,000 into 10 is 1 lakh. And the limit that we have, face value limit that we need to consider, that face value limit has exceeded. Correct? The face value limit has exceeded. Then, if you look at this husband of this daughter, husband becomes son-in-law, and tell me, is son-in-law covered under definition of relative? Or in other words, his daughter's husband, son-in-law, covered under definition of relative? Yes, it is covered under relative. The limit what we have is 1 lakh. Oh, is this already discussed? I was not aware. I thought it, anyways, I'll put it. The limit is 1 lakh. It is greater than 1 lakh, and hence it is, there is a disqualification. That part we need to consider, and I will stop the discussion. So this is also done. 5 is also done. Now coming to 6. Calculate the closing value of investment in Chandra Suppliers Limited using the equity method of accounting as per Ind AS 28. So we have to calculate as per equity method of accounting. So let us again come back. How does equity method follow, or how is equity method applied? Now, as far as equity method is concerned, what you need to understand is, so this is the summary of equity method. Initial entry, you will record investment at cost. So whatever is the cost paid, 55 lakhs, that will be considered as the initial cost. Then on that initial cost, we will add share of profit or loss of associate. So from the date of acquisition, if there is a profit, add. If there is a loss, we will reduce. That is the second thing. Then we will add share of other comprehensive income. If there is any other comprehensive income, that we will consider. We have to see whether if there is any revaluation or something like that. Then dividends will be deducted. So what you have to understand is cost plus P&L plus OCI minus dividend. These are the things we have to consider. So let us come back to the case. So here if you see, cost is 55 lakhs. So first we will take 55 lakhs as our cost, 55 lakhs. So I'm excluding last 3 zeros, okay? I'm just adding 5,500, you can take it as 55 lakhs. Then the carrying value of net asset of Chandra Limited on the date of acquisition was 4 crores, and the fair value was 450 crores. Means you have extra 50 lakhs of fair valuation of net asset. Now, if you have 50 lakhs extra as fair value, you remember this for your consolidation also. If fair value of assets is higher, you have to charge extra depreciation. You have to charge extra depreciation. The excess fair value was attributable to one of the warehouses having a remaining useful life of 10 years. So my extra amount is 50 lakhs. So I'll do a calculation here separately. My depreciation will be 50 lakhs divided by 10, that is equal to 50. I'm ignoring the last three zeros, okay? So that I'll have enough space. So if you take 50 lakhs divided by 10, extra depreciation per year will be 50 and three zeros, right? 50 and, or did I miss a zero? Just a second. 50 lakhs. This divided by 10. So this is 500, not 50. So my mistake here. Sometimes it happens. So this is 500. And if I add three more zeros, it becomes 5 lakhs. So that is one adjustment. This extra depreciation has to be removed. Then at the end of the financial year, they earned a profit of 660. In this 660, our share of profit is only 12%. So we'll consider that. And other comprehensive income of 98,000. On that also we'll consider 12%. Okay. Dividend declared was 2 lakhs. On this also we'll consider 12%. So very, very simple calculation, I would say. So what you have to do? Cost is equal to 55 lakhs. So I'm writing all the amounts in thousands. Okay. This is the cost. Add profit share. Now, what is the profit share? Profit they have given to be 6,60,000. Of that, it is 12%. So 660 into 12%. If I do 660 into 12%, if I do, that is 79,200. Then less excess depreciation, extra depreciation that we have to charge, you have already calculated. That is 500 into 12%. So you will reduce 60, right? Then this is done, depreciation. Then we have OCI, revaluation reserve as per Ind AS 16, other comprehensive income, that has come to 98,000. Or no, they have just said OCI. We don't know what is the thing. 98,000. So 98,000 into 12%. 98 into 12%. That comes to 11.76. So this will be 11.76. You will add here. Okay. Then dividend. They have declared 2 lakhs of dividend. 12% what we'll get will be 24. So this will be reduced 24. Okay. So the amount will be 5,500 plus 79.2 minus 60 plus 1176 minus 24. So if I do that, 5500 plus 79.2 minus 60 plus 11.76 minus 24. It is 5506 point. Oh, it is plus minus 24. Yes. 5506.96. $50 lakhs we don't consider. Fair value extra amount 50 lakhs we don't consider because that is anyways included in the cost thing. And when we calculate goodwill, that automatically will be covered. That is the first part. So that fair value of extra amount, whatever is there, that will be a part of my cost itself, right? So after purchase, what has increased? This 11.76 we have already considered here, OCI part. So I think I didn't get your question clearly. If you can reframe your question, maybe I'll be able to address it better. It is on the date of acquisition and the fair value is 450. Okay, fine. So we're done with this part. 55.54. We got something else, no? I think this is a mistake. This dividend has to be reduced here. Minus 24,000 is what has to be presented. Okay. So there has to be minus 24,000. They have taken it as plus 24,000. Fine.
Let's move on to the case studies from the case study digest. So we'll first have a look at case study number 27. Here. So case study number 27, MCQ number 4 is the MCQ, relevant MCQ here. So let's have a look at MCQ number 4. It says, with reference to the information given under para 3. So what is the para you will have to read here? We'll have to read para 3. Till what time period SKT had to make an application for renewal of its certificate so that it might be accepted, and the application should have been accompanied with what amount of fees. So this is basically about FCRA renewal, FCRA registration renewal. So let's first go to para 3 and see what para 3 says. So YPL provides donation every year as a part of its CSR activities to a charitable trust named Shiksha Kalyan Trust, who is engaged in activities of providing education to the poor children. The average net profit for the past 3 years was 88 crores. Accordingly, during the current financial year, it made a donation of 2 crores to SKT as its CSR spend. SPL, its subsidiary company, also proposed to make donation to such trust in India during the same financial year. However, SKT's certificate of registration under FCRA was to expire on 20th of December, and it had not applied for renewal of certificate before that, as the head accountant believed that they could apply for renewal within 1 year from the expiry date as per law, and hence pending. But the trustees decided to make an application for renewal of certificate sooner, so that the trust can accept donation from SPL, and the same was done as per the relevant legal provision. So what has happened here? There is SKT, a trust which wants to receive funds from, which wants to receive foreign contribution. However, it is not in a position to receive foreign contribution because its FCRA certificate has expired. So the validity of FCRA certificate, my screen is stuck. Just a minute. Is my screen visible now? Is my screen visible now? Yes? Okay, so I'll give you a gist of this again. So there's a trust, Shiksha Kalyan Trust, which intends to receive some foreign contribution. However, the foreign contribution certificate or foreign FCRA registration of this trust is going to expire on 20th of December 2022, and they've not applied for any renewal. So basically, FCRA registration is valid for a time span of 5 years. 5 years is the time span for which this registration is valid. Now, they have not applied for registration. However, they want to do so, and they'll do so within the other, as per the legal provisions. Now let's go back to the, before we go back to the MCQ, let's first have a look at the provision and then we'll come back and solve the answer. So as per the provisions of FCRA, if the validity of certificate of registration of a person has ceased in accordance with Rule 12, a fresh request for grant of certificate of registration may be made by person to the central government. So if the certificate of registration is no longer valid, then the person will have to make a fresh request. And if he wants to apply for renewal, what is the time span? Every person who has been granted a certificate shall have such certificate renewed within 6 months before the expiry of the certificate period. So here the certificate was going to expire on 20th of December 2022. So within a period of 6 months before this, that is from any within a period from 6 months before this up to 20th of December 2022, that is from June to the date 20th December 2022, the renewal application for renewal of certificate could have been made. If renewal has to be done, then the last date for applying for renewal would have been 20th of December 2022. And for renewal, Form 3 FC3C is filed, wherein an application has to be made with the central government. And every person who is seeking renewal of certificate of registration under Section 16 shall open an FCRA account and mention the details of the account in the renewal registration application for renewal. FCRA account has to be maintained separately, and I hope all of you all know about it, that a separate account has to be maintained by the people wherein they receive all the foreign contribution. And also when a renewal application is made, it has to be accompanied with a fees of 5,000 rupees. So let's now go back to the MCQ and let's answer it. Now, what is the MCQ asking? It says till what time period SKT had to make an application for renewal of its certificate. So we have understood it. It is 30th of December, 20th of December, because 2022, because that was the last date. That was the date of expiry of the certificate. So that was the last date for applying for renewal. So within 6 months before that, or the last date would be the date when it expires, so that it might be accepted. And the application should have been accompanied with what amount of fees? So what is the amount of fees with which the application should have been accompanied? 5,000. So we know both the answers now. The last date is 20th December 2022 and the fees is 5,000. However, if you look at all the 4 options, you tell me which option is the correct one. Why B? Which option is the correct one? What is the date of expiry? Why do you say it is option B? All the options given are wrong. I'm assuming that you're saying it is option B because here it is 2021 and the amount of fine is right. It cannot be C and D in any case because the amount of fine is 1,500 and 6,500, which is not right. It should either be A or B. However, there's a typo which has happened by the institute here in this particular case study. It should not be 20th December 2021. It should be 20th December 2022. Okay. I hope this is clear. Have you understood this? There's a small error in the options given, so don't panic. Whatever provision you know is the correct provision. Okay?
So let's go into the case study. Okay, so we'll have to read para 3. Oh, sorry, para 1. Okay, let's read. So Yantra Pedasu Limited, YPL. It is an unlisted public company. Okay. It is incorporated in 2005. Okay. It is engaged in steel business with 9 directors on its board of directors. All right. Now there is a company in Singapore named SYD Limited, in which it acquired 54% stake. Okay, so there are 2 companies. One is YPL and second is SPL. Now, YPL has acquired 54% stake in SYD, SPL. So this becomes the subsidiary company. Can we say that? Yes. So this is the subsidiary company. Okay, let's move on. During the financial year 21-22, and thereby it becomes the first subsidiary company. It is already given to us. Now, Mr. Sunil Verma has been appointed for the second consecutive term of 5 years as the MD, Managing Director of YPL. So this holding company has got a Managing Director, which is Mr. Sunil. Okay. Now, he has a daughter. He has a daughter named Mrs. Sunita, who is residing in Singapore for the past 6 years. Okay. And she has been appointed as the Director of SPL. So Sunil's daughter is Sunita, and Sunita is being appointed as a director in the subsidiary company SPL for the financial year 22 to 32 at the monthly remuneration of 60,000 rupees, which is equivalent to 3 lakh rupees. So this is the remuneration which is being given to Sunita. Okay, now you have to check whether Sunita's appointment is correct or not. So what is happening here? Holding company has a director, and the director's daughter is being appointed as a director in the subsidiary company at a remuneration of 3 lakh rupees. We have to check the appointment of Sunita. Is that accurate or not? So for this company SPL, is the appointment correct or not? So here, let's look at the relevant provision. So here, see, we'll have to check related party, whether Sunita is a related party or not. If suppose there is a related party transaction, whether this amount of 3 lakh rupees is accurate here or not. So what is the section relevant here? Section relevant here is section 188. Let's look at the section. So before we look at section number 188, so say this here, if you know related party transactions, we'll have to study related party transaction also. Then we'll have to understand what is a related party also, and relative definition also we need to understand. So first, let's try to understand if Sunita is a related party or not. Okay. Or okay, let's look at first section number 188. So section 188 talks about related party transaction. It says that there are certain transactions which require the compliance of section 188 if these transactions are to be taken or are to be conducted by the company. Okay, if the company does any of these things, then the company will have to comply with the requirements of section number 188 and related rules. Okay, so what are these transactions? Sale and purchase of goods and materials that are as per this section, or selling, buying of properties of any kind, leasing property, etc. Now, one of the items here is if a related party is being appointed in place of office or in place of profit in either that company or the subsidiary company or the associate company, then that will be considered as a related party transaction. Okay, if a related party is being appointed for any office or place of profit in that company or subsidiary company or the associate company. Okay, so here if we see, holding company's director's daughter is being appointed as a director in the subsidiary company, right? So here probably Miss Sunita is going to fall here. For that, we will have to understand what is a related party, just to understand if Miss Sunita even falls in this category. Then probably we can read further what section 188 says. Okay. So what is a related party? That is given in section 2, subsection 76. Related party means for that particular company could be the director or the relative of a director. Could be the key managerial person or his relative. And then we have got this whole list of people who are covered here. Okay. 1 second. Why can't I read? So you can read the whole related party definition. It is given in terms of which corporate bodies are going to be considered as related party, which firms are going to be considered as related party. But what is relevant for us, I'm only covering that because the whole section will take us too much time. Okay, so the first and second part of related parties definition is that the company's director is a related party, the company's director's relative is a related party, the company's key managerial person and his relative are also related parties. So that means can we say that Miss Sunita is a related party? Miss Sunita's father, Mr. Sunil, is a director, is an MD. So he falls in both of these categories. And she is a relative. Is she the relative? So for that, we'll also have to see relatives definition. See, relative has been defined in section 2, clause 77, which says relative is a member of an HUF, husband and wife, father, mother, son, son's wife, daughter, daughter's husband, brother, sister. So daughter is covered in relative. Okay, so director, Mr. Sunil's daughter, which is Sunita, she is a related party. I hope you understand. So now we know she's a related party. So now we'll have to comply with section number 188. So what does section 188 say? 188 says that if a related party is appointed in place of profit or office in the subsidiary company or associate or the company itself, then we have to comply with this. Now, what is office or place of profit? Okay, we have to see this so that we can check if she's being appointed as a director, right? If that is considered as place of profit or not. So office or place of profit means where such office is held by director and receives remuneration in excess of the entitled remuneration. So that means if a person is being appointed as director and they are getting remuneration and that remuneration is more than what is prescribed, then that will be considered as office or place of profit. Okay, now we know Sunita is being appointed as the director in the subsidiary and she is getting remuneration. Well, how much remuneration she's getting? She's getting 3 lakh rupees. So is this above the limit which is prescribed or not? So we'll have to check what is the entitled remuneration. So that entitled remuneration is given in rule number 15. Okay. So in rule number 15, if we check, it says that if office or place of profit is a person is being appointed in office or place of profit, then the remuneration per month should not exceed 2.5 lakh rupees. So 2.5 lakh rupees is the per month limit. More than 2.5 lakh is excess of allowed limit. Okay, I hope you have understood. So what is happening in the given case? We know Sunita is a related party, that is understood. She is being appointed as director in the subsidiary companies. That means she is holding office or place of profit and she is getting monthly remuneration of 3 lakh rupees. Is this 3 lakh allowed? Is this 3 lakh allowed? No. As per section 188, it is not allowed. Okay, if you want to give 2.5 lakh, more than 2.5 lakh to Sunita, then we'll have to take prior ordinary resolution and board resolution. Right? If that is taken, then we can give 3 lakh rupees. But if that is not taken, then this is not allowed. Okay, so accordingly, we'll have to select the correct option. Okay, let's look at the options. And you will have to tell me which is the correct option here. So let's read the question again. With reference to the information in this, whether any formalities will have to be complied with by this with respect to appointment of Ms. Sunita as the director of SPL, which is the subsidiary company. Let's read the options. A, no, as such appointment did not amount to appointment of Mrs. Sunita to an office or place of office. No, that is incorrect. She is being appointed for place of office, so this is not right. Okay. Next is yes, as Mrs. Sunita was a related party to YPL, and she would be drawing remuneration exceeding 2.5 lakh in the subsidiary company. This seems accurate. Okay. We'll still read the other two options. No, as even though Mrs. Sunita was a related party to YPL, but she would be drawing remuneration from SPL, its subsidiary company, and not YPL itself. This is not relevant for us. This is incorrect. No, as such provision with respect to related party are not applicable in respect of foreign subsidiary companies. There is no such exemption given. Okay, so correct option will be B. Is this clear? Is this clear? Yes or no? Yes. Was this a difficult question? Tell me. I want to know your feedback. Do you think this was a difficult question? Yeah, little bit. Okay, some are saying not difficult. Good, very good. Okay, let's move on. So next we are doing a descriptive answer, which is descriptive question number 7. Because the first part is related to company law. Let's read. So with reference to the information given in para 3, how much excess CSR expenditure has been made by YPL during the financial year 22-23, and whether such CSR expenditure can be carried forward in the next financial year. This is comparatively easy. CSR expenditure. Anyone knows the relevant section here? We simply have to calculate whether there is any excess CSR paid. Section 135. Very good. Perfect. If any excess CSR is paid, we'll have to calculate that, and whether that can be carried forward. So you simply have to refer to section 135. Let's look at para 3 to understand first. Okay, para 3. YPL provides donation every year as part of CSR activity to a charitable trust named Shiksha Kalyan Trust, engaged in activities of providing education to poor children. The average net profit for the past 3 years is 88 crore rupees. This is relevant for us. Accordingly, during the current financial year, it made a donation of 2 crore rupees. Now, please calculate. Do the calculation. Okay. Is the CSR paid excess or not? This is only this much is relevant for us. Rest, this is not relevant for us. Okay. So let's look at section 135 and see how much CSR has to be done. Okay. So section 135 says that certain companies have to do CSR. We are not going into which companies have to do CSR because that is not relevant for us. All we have to do is we have to do calculation of CSR. So let's assume this company is covered in one of these criteria. Okay. Now, section 135 says that at least 2% of the average net profits of immediately 3 preceding years has to be taken as your CSR amount in the current year. Okay. So 88 crore rupees is the average net profit. The company has to spend 2%. So that is how much? That will come to 1.76 crores. Company has to spend 1.76 crores in the current year. Okay. But how much the company has actually spent? The company has spent 2 crore rupees. 1.76 had to be spent. Company has spent 2 crore rupees. Additional 24 lakh rupees are there. So one part of the question is solved. Excess we have calculated. Now can this excess CSR which is paid, can this be carried forward? So for that, we have to refer to rules relating to CSR. Now, related rules, they say that yes, it can be carried forward. It can be carried forward for the succeeding 3 financial years. If the company wants, it can carry forward to the succeeding 3 financial years. So that means this 24 lakh rupees will be carry forward. Okay. Simple question. So we have solved the question also. And that is how you will have to, now if you want, you can refer to the entire answer also. You will have to state these 2 provisions. How much CSR has to be paid, 2% of average net profits. You will have to do the calculation. Then you will have to mention that as per the rules, the excess amount can be carried forward to next 3 financial years. Accordingly, you can answer that to conclude 24 lakh can be carried forward. All right.
We will proceed to the next interesting case study, my dear friends. Look at the interesting case study number 27, my dear friends. What is that tomorrow you're asking? I didn't get your point. Oh my God, what happened, my dear friends? Can I take one more session or not? Can we go ahead and discuss one more case study? Please respond. Done. One last case study for the today. One last case study for today's discussion. Please see that. Case study number 27. Yantra Pedasu Private Limited. What is the name, my dear friends? Some peculiar name it is. Is an unlisted public company incorporated since 2005. Engaged in steel business with 9 directors on board. There is a company in Singapore named so-and-so entity, acquired 54% stake, daughter, everything is related to your other than taxation. For financial year 22-23, my dear friends, they have appointed Chappan & Co as title auditor in the place of previous auditor. Fine. Also, they made return communication, wide post acknowledgement. Okay. One of the senior partner was appointed. So if you see, everything is related to auditing only. Where is tax? Yeah. See this, my dear friends. Apart from conducting audit assignment, my dear friends, apart from conducting what? Audit assignment, Mr. Kailash also used to solve the concerns raised by accountant of IPL with respect to GST and income tax matters. So after audit assignment is done, apart from conducting audit, Kailash used to solve concerns raised by accountant of IPL with respect to GST and income tax matters. And one such concern raised by accountant to him was with respect to ITC availment under GST, which is briefed as under, come on, please see that. The balance of ITC with IPL after discharging GST liability for April was 60 lakh rupees. Eligible ITC in 2B with respect to May month was 56 lakhs, whereas the input tax paid by it on invoices received during the month was 75 lakhs. I think you all know the answer. We can never ever claim input more than what is reflecting in GSTR 2B. The maximum input what we can claim is only to the extent of credit which is reflecting in GSTR 2B. At any given point of time, we cannot take credit more than what is reflecting in GSTR 2B. Come on, please see the points. So the ITC in 2B was 56 lakh rupees, whereas the input tax paid by it on invoices received during the May month was 75 lakhs. Output tax liability for the May month was 110 lakhs. So he was not sure about the amount of ITC to be availed for the May month, for which he consulted Kailash. And after following the advice, liability for May month was discharged by YPL through its balance in credit ledger only. Very good. YPL provides, what is that, my dear friends? Donation every year as a part of its CSR activity to a charitable trust named Shiksha Kalyan Trust, engaged in activities of providing education to poor children. Average net profit is 88 crores. So they're talking about your Companies Act, Section 135, Corporate Social Responsibility. And there's something related to FCRA also in the question. Okay. Next. YPL bought a machinery from Dusham Limited for its business, for which they received government grant of 6 lakh rupees. Very good. I think now it makes sense related to tax. They purchased a machine for which they got government grant. List price is 30 lakh rupees. Boxes used for packing the equipment, not including the price, about 60,000. That will include the value of supply, no doubt about it. Discount at 2% is offered on the list price of the machine, record in the invoice. So generally there are two types of discount. Number one, discount record in the invoice. Number two, discount given after supply is made based on agreement existing in the time of supply. And it is linked to the invoice. And proportionate credit is very clearly reversed by the recipient. You would have heard about something like this in section 15, my dear friends. 15.3 talks about what all we can reduce from value of supply. Good, very good, excellent. Next point is it. Since machine was recorded in the books at the cost of 30 lakh by treating the grant as deferred income, they have depreciated all its plant and machinery at 20% on straight line basis and does not claim depreciation on GST component. That means GST is taken as credit. On 24th Jan, YPL supplied 2,000 empty steels to SPL. YPL supplied 2,000 metric tons of steel. To whom did they supply, my dear friends? SPL. Just forget what was this. There's a company in Singapore named SPL in which it acquired 54% stake. So that means SPL is the subsidiary of YPL. Fair enough. Now let me proceed. So holding company made a supply to subsidiary company. 2,000 metric ton steel pipes to SPL at 1 lakh per metric ton on CIF basis. Insurance and freight were included at 11,000 metric ton. And on 5th February, it made supply of 3,000 metric tons to another Singapore-based company, Uno Pte Limited, at 95,000 per metric ton on FOB basis. So for their subsidiary, they have supplied on CIF, and for other entity, they supplied on FOB basis, for which payment was to be made Singapore dollars, 5 crore 70 lakhs in 3 months. And so in order to protect itself from foreign fluctuations, they hedged receipt of foreign currency in the forward market. Good. What is that they're asking? With reference to information given under para 5, what amount of additional tax needs to be paid by Y Limited if it does not want to repatriate the excess money with respect to supply of steel pipes to SPL? Wow. What amount of additional tax needs to be paid by YPL if it does not want to repatriate the excess money with respect to supply of steels to SPL? Very, very interesting points. So this question is related to your transfer pricing, my dear friends. Very, very interesting points. Let's answer this. No problem. We will answer. We're ready to answer this. I'll share the screen first. Yeah. SPL is a subsidiary of YPL. Correct, my dear friends? We are very clear that SPL is subsidiary of YPL. Accordingly, both are associated enterprises. And what has happened is there is supply of steel on CIF basis. And what is the value of supply, my dear friends? Come on, please tell me. At what value they have supplied? We need to compare something called arm's length price, my dear friends. Correct? Now, in the question, I remember that they made a supply at 1 lakh per metric ton. At 1 lakh per metric ton. But for unrelated person, the price is 95,000 per metric ton. And to that, let me add insurance and freight. You might get one doubt, sir, why is that you're adding insurance and freight? Because you have to understand that to our entity, we supplied at CIF, other entity, we have supplied at FOB. In order to compare both the prices, we have to first make them comparable, because name only says something called comparable uncontrolled price method to determine something called arm's length price. I'm using something called comparable uncontrolled price method. So what are the insurance and freight they gave in the question? 11,000 rupees. $11,000, I mean to say. ₹11,000 only, sir. It's not dollars, it is rupees only. Yeah. Now, arm's length price will be 95,000 plus 11,000, 1,06,000. But the transaction price is how much, my dear friends? Transaction price, what they have done is for 1 lakh. The difference is 1,06,000 minus 1 lakh, which comes to 6,000 rupees, my dear friends. And 6,000 is per metric ton. And total supply made is 2,000 metric ton. So the primary adjustment on account of transfer pricing. Primary adjustment of transfer pricing will be 6,000 into 2,000 metric tons, which comes to 1 crore 20 lakhs. This figure is an important figure because let me make you understand some interesting provision here. That is when the primary adjustment is more than 1 crore. More than 1 crore. And the excess money is not repatriated to India. Then repatriated to India, my dear friends. And let me tell you, for the purpose of repatriation, my dear friends, hold on, right here. Repatriated to India within 90 days, actually. If it's done return of income time itself, 90 days of return of income. If it is based on order passed by officer, from order we'll see 90 days. Then secondary adjustment is done. And as per section 92CE, what is section number, my dear friends? 92CE, he will be required to pay something called additional tax, my dear friends. He is required to pay what, sir? Additional tax. If he is bringing the money back to India, then it is fine. If he is not bringing the money to India, then he has to do secondary adjustment. Additional tax is required to be paid at the rate of 18%, plus surcharge at the rate of 12%, plus HEC at the rate of 4%. And this working will do basically on what value is nothing but the primary adjustment value. On that value only we are required to pay something called additional tax. So additional tax will be, what will be the percentage actually? 18%, no? And on 18%, we have to calculate 12%. Total is 18 plus 2.16 on this 4%. So the effective rate I'm trying to calculate 20.9664. That is the effective rate of tax on the secondary adjustment, my dear friends. So additional tax that is required to be paid is 20 point this into 20.9664%. So the amount of tax is required to be paid by the friends 25,15,968, which will be rounded off to 25,15,970. That is how we arrive at this secondary adjustment, my dear friends. Very, very, very interesting provision. And I strongly believe that you got clarity on this point. An excellent point, actually. There is no doubt about it. Good. Wonderful. 25,15,970. Answer is option B, my dear friends. Sir, if primary adjustment would have been less than 1 crore, this story would have not come at all. Next. Appointment of director, I'm not concerned. With reference to para 2, how much balance in credit ledger would have been available with IPL after discharging GST liability? The straight answer, my dear friends, we can take credit only to the extent of credit that is reflecting in GSTR 2B. At any given point of time, we cannot take more than what is reflecting in GSTR 2B. Clear, my dear friends? That means we can take only to the extent of which is there in 2B. I hope you got the point. Yeah, let's see the answer. Come on. 60 lakhs is for April month. For May month, 56 lakhs. Total is 116. And the liability for the output tax liability for the month of May is how much, my dear friends? 110. So 116 is the total credit we have got. 110 is what we have to pay. So we'll still have 6 lakh credit balance. That's it. Very simple question. So answer is option C, my dear friends. Done. Fourth question is not related to tax, it's related to your law. Next point. With the information given in para 4, what will be the value of supply for the machine supplied? I clearly told you that, my dear friends, to the list price, we'll add that packing material equipment. We'll also reduce the discount what they have given in the invoice. So technically, to that 30 lakhs, we will add 60,000 packing charges and we'll reduce discount. How much discount? 2% on list price. 2% on 30 lakhs is again 60,000. So 30 lakh plus 60,000 minus 60,000. Net figure is again 30 lakhs. And whatever government grant we got 6 lakh, that will not be considered, my dear friends. Because any subsidy from central government or state government, that will not be included in the value of supply. Got the point, everybody? That's it. Descriptive points. First one, it's not concerned. Next point, descriptive first bit is not our point. Second bit is again talking about your corporate social responsibility. That's related to your law. What else? The last one is Ind AS 20, related to your financial reporting. That's it. That's about the case study number 27, my dear friends. This is a very interesting case study. Especially I love the first point of transfer pricing. I'm sure you got full clarity, my dear friends. So that's all for today's session, my dear friends. The balance will take for the next session. And I'm sure that you guys have got some very good knowledge in today's discussion. Totally clear with this? Done. Thank you so very much, guys. Take care. See you all very soon once again. Bye-bye. Thank you. Shivateja signing off. Take care. All the very best. Do study well. Nothing is scary, my dear friend. Just a matter of revision. Just a matter of practice. That's it. Thank you so much, guys. Take care. Bye-bye.
Next case study number 27. Yantra Pedasu Limited is an unlisted company incorporated since 2005, engaged in steel business, 9 directors, so on and so forth. There is a company named SYDPTE which acquired 54% stake during 2021-22 and became its first subsidiary company. So see, if you see, a lot of focus is there on Ind AS 103 and 110, of course, also with equity method of accounting for associates in joint venture. Sunil Verma has been appointed for the second term, so on and so forth. That is even then. They appointed someone as statutory auditor. We have already discussed about this. Then ITC will be taken care in the tax. CSR activities. They bought machinery from for its business for which they received a government grant of 6 lakhs. So accounting for government grant. We have seen one more question where there was a government grant accounting. List price 30 lakhs. Corrugated boxes for packing the equipment not included in the price 60,000. Discount at 2% on the list price of machine recorded in the machine. So this I think is more from the point of view of GST rather than accounting. YBL supplied some steel pipes at 1 lakh on CIF basis, so it's related to custom. So first thing, tax. Second, appointment as director, not required for us. GST liability. Total fees, value of supply. With reference to accounting estimates given in para 2 that may give rise to significant risk, what Mr. Kailash should have evaluated in addition to performing procedures as per SA 330. So this is one thing which we have to address. With reference to information given under para 4, show the statement of P&L balance sheet extracts in respect of grant received by YPL for the first year under both the methods as per Ind AS 20. So two things we have to do. One is Ind AS 20 and the other one is SA 330. So first we'll do Ind AS 20 and then we'll come back to SA 330. Okay. Now, as far as Ind AS 20 is concerned on government grants, so we can take it as a reduction from asset deferred income. So similar thing we have discussed earlier also, the concept part of it. So we can directly jump into the solution on how to handle the government grants. So when it comes to government grant, let us see what is the information given in the question. Again, we come back here. They bought a machinery for which they received a government grant of 6 lakhs. Now, first thing is we have to see what is the value of machinery that we need to account for in our books. Okay. So once we get to know what is the value of machinery, then we have to see after deduction, how do we calculate? Without deduction, how do we calculate? And accordingly solve the particular question. Right. Now here, first thing is list price exclusive of taxes and discount. So list price exclusive of taxes and discount is given to be 30 lakhs. On this, 2% is offer on the list price of the machine. So 30 lakhs, if you calculate 2% of this, 30 lakhs means these 2 zeros go off, 30,000. So you have a discount of 60,000 that is given. So they have given discount of 30,000. That is the first thing, right? Second thing is they have recorded in its book at cost of 30,000 by treating the grant as a deferred income. They depreciate machinery at 20% per annum on SLM basis and does not claim depreciation on GST component. So if they don't claim depreciation on GST component, we don't capitalize that. That is very, very straightforward, right? Now, these boxes which are used for packing the equipment and all of those things, that is only for packing purpose. That is only for transportation purpose rather. So that is not included in the value of machinery, right? Now, they have asked us two methods. So first method is when you take this grant of 6 lakhs as deferred income. They have themselves said they will take it as a deferred income. Means what? Cost of PPE is 30 lakhs. Deferred income, you will consider 6 lakhs. Okay. Then on this 30 lakhs, we'll charge 20% depreciation. So depreciation for year 1 is equal to 30 lakhs into 20%, 6 lakhs. Deferred income also what you will do of this 20% you will transfer to income. So income from grant will be how much? 6 lakhs into 20%, 1 lakh 20. So in the P&L, what you will do is 1,20,000 of income will be shown, 6 lakhs of depreciation will be shown, and from 30 lakhs you will reduce 6 lakhs to get the carrying amount, and from this 6 lakhs you will reduce this 1,20,000 to arrive at the government grant. Right? That is the first part. Now, second method which they have not followed is what you will do is cost of PPE 30 lakhs less government grant 6 lakhs. So you have left with 24 lakhs. Then depreciation will be 24 lakhs into 20%, that is 4.8. Now in the previous case also, depreciation was 6 lakhs. Government grant income was 1.2 lakhs. So net impact anyways was 4.8 lakhs. Here also net impact is 4.8 lakhs. So whichever method you follow, you will get the same answer, but there are two ways to present. First, what the company has done, income method, and second, the deferred, the reduction from the cost method. Both the method are allowed under Ind AS, right? So if you see, yeah. If you treat it as deferred income, depreciation will be 6 lakhs. Government grant credit 1.2 lakhs. Net impact is 4.8 lakhs. In the balance sheet, PPE 30 lakhs minus depreciation 6 lakhs, 24 lakhs. Non-current liabilities. So it actually has to be non-current has to be 6 lakhs minus 1,20,000, which I have already reduced, which is 4,80,000. Out of this 4,80,000, next year you will utilize 1,20,000, and year after that you will in the subsequent year you will utilize 3,60,000. So this classification you have to be careful about current and non-current. Whatever you will consume in the next year, this will be current, and after that will be non-current. So 480 you should not show it here. You have to show it as 3,60,000, and under current liabilities you have to show 1,50,000. They have done it. This part they have done it correctly, and here they have taken it as 4,80,000, which is incorrect. It has to be 3,60,000. Okay. Then, if you deduct from cost of asset, asset value will come down. So depreciation will only be charged, and this is how you present in the balance sheet. Any doubt on this current non-current classification? Because a lot of students have problem here. Moving on to the next one is study number. Oh, sorry, to finish the audit part, right? With reference to accounting estimates given under para 2 that might give rise to significant risk, what Mr. Kailash should have evaluated in addition to performing procedures under SA 330. So what the question is saying is, whatever is required under SA 330, you do that. Okay, whatever is required under SA 330, you do that. Apart from that, what we have to do? Now, the moment you see accounting estimates, we refer to SA 540, where you do the auditing of estimates, fair value accounting, etc. Right? So you will have to consider what is required on the required as per SA 540. Now, first let us see what is given here, para 2. So for the financial year, they have appointed this company and they have made a written communication. Then Kailash senior partners was appointed, and here, so they have just mentioned that Kailash observed there are certain accounting estimates made in relation to certain items of financial statement that might give rise to significant risk. Therefore, they were performed substantive procedure in accordance with requirements of SA 330. So here they have said estimates. They have not told us what is the estimate. Now, when it comes to the evaluation of estimate part, what do you see? You will see what are the significant assumptions that are made by management. Okay. Then what are the, when you look at the significant assumptions, are the assumptions reasonable? Okay. Then when assumptions, once you evaluate whether it has been, whether there are assumptions are reasonable or not, you will also see whether there are alternative assumptions or whether there are other assumptions possible, and how has management addressed those specific assumptions. Okay. Then are the assumptions reasonable? That is, that is one thing you've already discussed. And when you look at the reporting part, how has the management calculated and all of those things we cover as per SA 540. Right? So if you look at the suggested solution, so this will be directly a thing that you will copy from SA 540 if at all such question comes in the examination. There is how the management has considered alternative assumptions or outcomes. So if there are any alternate assumptions, how they have considered and why it has rejected them. Why did we choose A and not choose B? Whether significant assumptions by management are reasonable, were relevant to the reasonableness of the significant assumption used by the management or appropriate application of applicable FRF, that is financial reporting framework. Management intend to carry out specific courses of action and its ability to do so. Now, when we make assumptions, when we make certain estimates, we are making assumptions saying that we will do some things and then we will get a specific outcome. For example, if you make provision for bad debt at 2%, So why only consider 2%? Because we will carry out recovery mechanisms and we will ensure that the doubtful debt is only 2%. Now, if the management is not able to take those actions, doubtful debt may be 5%. So that part the auditor has to inquire. Okay, so that is another thing which you have to keep in mind. So there is something on materiality also. The second question. With references to information given under para 2, what kind of factors might be there that would have indicated existence of certain transaction entered into by YPL for which Kailash was required to lower his materiality? Now, when we lower our materiality, okay, when we lower our materiality, materiality is covered under SA 320. When we lower our materiality, do we check more or do we check less? If the materiality level is lower, do we check more or do we check less? We'll check more. Okay, we'll check more. We'll cover more transactions. Now the question is not very, directly related to the case study given. What they've said is, for information given under para 2, what kind of factors might be there that would have indicated existence of certain transaction which Mr. Kailash was required to lower his materiality. So what could be some transactions? So again, if you come back to para 2, so what is there in para 2? There were certain transactions for which misstatements of lesser amount than the materiality for the financial statement as a whole. Financial statement as a whole could reasonably be expected to influence the economic decisions of users taken on the basis of the financial statements, and accordingly, Mr. Kailash lowered his materiality level determined for such transaction. So they have said they have already lowered. Now our thing is, what could be such transactions that we have to consider, right? Now, whenever we have to lower the materiality, something specific could be if there is something required by law. If something is required under law, the materiality level can be or has to be revised. That is one part, right? Then, if there are, for example, if there is something that has happened, for example, there is a case which has happened. If there is any legal case, in that case, we have to maybe lower our materiality. Then, if there are aspects, for example, if there is a amalgamation or a business combination, in that case, you may not look at materiality level and you may reduce the materiality level and you may disclose. So this again is a direct pickup from the standard. Okay, there is nothing which because they have not given in the question what are such transactions. So if there are related party transactions, that also we will not consider it to be, materiality aspects are not considered there. You have to look into even 1,000 rupees of payment to a director. Whether or not it is material, your level has to be lower in that aspect. So factors that may indicate existence of one or more particular classes of transactions, account balances, or disclosures for which misstatements of lesser amount than materiality for the financial statement as a whole could reasonably be expected to influence the decisions of users. First, law, regulations, or applicable financial reporting framework affect the user's expectations regarding the measurement or disclosure of certain items. For example, related party transactions, remuneration of management, etc. So here, if at the financial statement level your materiality level is 5 lakhs, here you will have to lower. In fact, remuneration to management and all of those charges governance, even if there is 100 of reimbursement, you may ask for detail. Of course, materiality levels are looked into it, but you will do a thorough checking. Disclosures in relation to industry in which the entity operates. For example, R&D cost for pharmaceutical company. So some industries, the law requires that you have to make specific disclosures. So that has to be disclosed. Whether attention is focused on a particular aspect of entity's business that is separately disclosed in the financial statement, for example, newly acquired business. So if there is a lot of focus on, let's say, a business combination, or if there is a lot of focus in, let us say, business has been sold. So in such cases, again, your materiality level has to be lower. In the given instances, factors might be there that would have indicated existence of certain transactions entered by YPL for which Mr. Kailash was required to lower the materiality for such transactions. Misstatement of lesser amount than materiality for the financial statement as a whole could also reasonably be expected to influence the decision of the user. So this paragraph, you can maybe just say that These are the factors which the auditor has to consider rather than throwing excess English jargon in the examination. Right? Then
let's move on. Next, we are doing case study number 28. Okay. Now, in this also, we got 2 MCQs. Okay, let's look at the first MCQ. This is relating to foreign company. Very easy MCQ. If you've ever studied foreign company, you will be able to answer this fast. Okay. Now, under option C, Mr. Mehta would be required to deliver various documents to the registrar of companies under the provisions of the Companies Act at what place? Okay. So here first MCQ says that see, there is some Mr. Mehta. Now, Mr. Mehta has to deliver some documents to the registrar of companies. Now, what will be the location of the registrar of companies? Okay, some of you have already answered and you're correct, absolutely correct. Okay, so just for reference, we are going to refer to option C. What does it say? Option C, let's read this. Mr. Mehta will get incorporated a new company in India itself at Kolkata as a foreign company which would work under the supervisions of its Thai counterpart and invest capital in the construction of infrastructure required. So here, simply by reading this, we can understand that here we are talking about a foreign company. So we know foreign companies' documents are to be submitted. Where are the documents submitted? Which registrar of companies? It's New Delhi. Perfect. Okay, so this is covered in your section number 380. 380 talks about submission of certain documents. Whenever a foreign company is created, then charter document, details of the directors, company secretary, address of that company, the place of business in India, all of those details are to be submitted to the registrar, and that registrar is always New Delhi registrar. Okay, the jurisdiction of New Delhi, the registrar holding jurisdiction of New Delhi. Okay, so B is correct option. Let's move on. MCQ 5. What is the status of Zen Limited as per the provisions of the Companies Act? Okay, Zen Limited, we have to check the status. So first you have to find out what is this Zen Limited. Okay, let's move on to the question. Let's read the part related. Zen Limited is one of his other companies registered in Thailand. This is the first fact, registered in Thailand, headed by his son. The board of directors usually meet and execute business decisions at his board meeting in India. Again, if you have read foreign companies, if you've solved foreign company questions, you know the answer. Okay, so what is happening here? This company is registered in Thailand, which is outside India. This company has board meetings that are conducted in India. Okay, so for that now, in order to understand if this is a foreign company or not, what are the options do we have? We have got either it's an Indian company, foreign company, not a foreign company, or special purpose company. Right, so we'll have to understand what is a foreign company. Let's read the provision. Just to recall, we'll read the provision. So foreign company definition is given in your section 4 clause 42. It says foreign company means a company or body corporate which is incorporated outside India, which has place of business in India by itself or by agent, physically or by electronic mode, and it conducts business activity in India. Okay, 2 conditions have to be satisfied. This company should be incorporated outside India. Now, in this case, this company is incorporated in Thailand. So therefore, that first condition is satisfied. Okay. Second condition, should have a place of business in India. Now, this place of business could be that it has a shop, it has a location, or it could be that there is an agent in India, or it could be that it's by electronic mode. That means there is a website. Okay. Now, electronic mode has been defined to us. There's a long list of what is electronic mode. But when you read this whole definition of electronic mode also, board meeting is not covered. So if this company is just incorporated outside India, if it only holds board meetings in India, that is not a place of business. Okay, if suppose this company has some online service or telemarketing, telecommunication, telemedicine, or some financial work that it is doing, or web-based marketing advisory, these kind of things, if it is doing online, then we can still say there is a place of business in India. But just board meetings in India is not place of business. Okay, so first condition is satisfied, this company is incorporated outside India. Second condition is not satisfied, it does not have a place of business in India, it is only holding board meetings in India. So is this a foreign company, yes or no? Is this a foreign company, yes or no? It is a foreign company, yes or no? It is not a foreign company, it is not a foreign company. Okay, this company is not a foreign company. Just by, okay, so let's look at the facts. See, this question says that this company is registered in Thailand. Yes, incorporated outside India, but it is not doing any business in India. It just, only the board of directors, they meet and conduct board meeting in India. That is not business. That's just meetings. Okay, so this is not a foreign company. Okay.
Moving on to the next one, case study number 28. Mr. Hari Mehta was an Indian citizen who is based in Thailand for the past 20 years. Father had family business in India when he graduated, so some background is given. Through a video conferences, they both discussed how in the present age of commercial globalization, multinational companies have branches, subsidiaries, divisions. So that aspect is given. Okay. So we'll see, unless the question requires us, we don't need to get back to this. Now, he tells CA Vani, who is CA Vani here? There is some reference. Yeah, here there is a reference of CA Vani. He started studying various laws applicable in India and further consults CA Vani, one of his friend's daughter in India, who is an expert consultant in handling international business matters. So a lot of background material. So rather we will see what are the options given. So following options available to invest in India: acquiring controlling shares in Golden Rivers Private Limited, an Indian associate company of one of his friends, Thai's company, RPP Limited. It is a company incorporated in Thailand and 55% shares held by Golden Rivers. An Indian RPP has presence in India also. Details are given below. Fixed asset, intangible assets, and all those things for tax purposes. CA Vani deliberates on how residential status of companies has changed. So we have this poem concept. So that is more on residential status. CA Vani tells that there are business models. So there is one business model of Amit's company, another one for Rahul's company. If there is a question on that, we'll get back to this. Zen Limited is one of the other companies registered in Thailand, headed by his own son. So a lot of complex family business transactions. Option B, Mr. Mehta tells that one of his associate companies engaged in the business of manufacturing and distribution of industrial gases can acquire a listed Indian company having a market share of more than 65% in the industrial gas business in India only after a due diligence of this Indian company is conducted. Okay, so this talks about due diligence. Third option, they'll get incorporated a new company in India itself as a foreign company, which will work under the supervision of its Thai's counterpart and invest the capital in the construction of infrastructure required to set up the new company. So that is the third case. So multiple scenarios are there. So let us not be very, scared with the amount of information given in the question. Once we look at the questions, we'll realize that it is much easier to handle. Okay. Now, by the time you see this sounds or this looks something similar to borrowing cost. These kind of tables we have seen enough when we do borrowing cost. Okay. So first, under option C, Mehta would be required to deliver documents to registrar of companies under the provisions of Companies Act. So this is under Companies Act, Residential Status Income Tax Act, again Income Tax Act, again Income Tax Act, and Companies Act. Okay. Then determine residential status. Then CA Vani would conduct due diligence work with respect to ABC Limited as required by Mr. Hari Mehta. Help her list out the contents of due diligence review report that she may submit. Then, following the provisions of Ind AS 23, borrowing cost, calculate the amount of interest to be capitalized and pass necessary journal entries for capitalizing the cost in respect of it. Now, though they have given so much of matter, this business, that business, this business, that business, finally it comes down to some simple, questions which are related to your borrowing cost direct question, then due diligence direct question, right? So don't get scared. Even in examination, before saying that I will solve this MCQ or I will not solve this MCQ, what you have to do is you have to see, is there something familiarity in the question? If the question is familiar, maybe you will be able to handle the question better. Now, tell me one thing, what is the point of asking this question here? This anyways you would have done multiple times in your financial reporting paper. So there is no great value add by looking at the case and solving this particular question, right? So that is one thing you have to keep in mind. And due diligence, again, from the CA final, from the audit chapter, what they have said, help or list out the contents of due diligence report. So there is a pattern or there is a format of due diligence report that we can. Now, when it comes to capitalization of borrowing costs, so here if you see, Key Limited began construction of a new building at an estimated cost of 14 lakhs on 1st of April. To finance the construction of the building, they obtained a specific loan of 4 lakh from a financial institution at the rate of 9%, and the building was completed by 31st of January. Company's other outstanding loans were as follows. 14 lakh loan, 12%, 18 lakh loan, 11%. These are other loans. These are not your specific loan. There is a specific loan of 4 lakh. Now, if you have a specific loan of 4 lakh, what do? The interest that is paid on the specific loan, which has been taken for the purpose of constructing this particular qualifying asset, assuming it is a qualifying asset, that will be capitalized. Correct? That particular loan will be capitalized. Now, how much to capitalize? That is a big question. Okay. Now, generally what students tend to get confused is, they have taken a specific loan of 4 lakhs on 1st of April. So basically 1st of April 22 till 31st of January of 23. How much loan have we taken? 4 lakhs. This period is 10 months. Okay. Now here if you see expenditure, April we did expenditure of only 3 lakhs. Next expenditure happened on August. Now what a lot of students do is, for 3 lakhs they will take 10 months. For August they will say August, September, October, November, December, January. They will take only 6 months. This is wrong. Any specific borrowing, entire 10 months has to be considered. So basically what I'm saying is, on this 4 lakh into the rate of interest is 9% into 10 divided by 12. So 4 9s are 36, 360 divided by 12, that comes to 30,000. This entire 30,000 has to be capitalized. No need to split. So then when do we need to split? You have to split after that. So you have spent 3 lakhs here. You have spent 3 lakhs here. From this 4 lakhs, you have spent 1 lakh from specific borrowing. Though you have incurred the expenditure on 1st of August, full amount, full 10 months has to be capitalized. Then balance 3 lakhs, what you will do is, you will calculate a weighted average of this and you will do the capitalization. So what you have to do? You have to calculate the capitalization rate. What is the capitalization rate? You will take 14 lakhs into 12%. You will get some interest amount. Then you will take 18 lakhs into 11%. You will get some interest amount. This total interest divided by the total amount of 32 lakhs, whatever you get, will be your capitalization rate. And using that rate, you will do the capitalization of borrowing cost. Okay. So, because it's a straightforward question, I expect you can do the calculation. I'll just explain you the calculation. Yeah, 14 lakhs, 18 lakhs, total interest divided by this gives me 11.4375%. Again, one more thing. When you calculate this weighted average, you have to take full 12 months interest. Don't think I will take 10 months and then do the calculation. Then again, it will be wrong. Okay. Then specific borrowing, 3 lakhs plus 1 lakh, 10 months, 10 months. Full amount will be capitalized. General borrowing, so out of 4 lakhs, 1 lakh is gone, 3 lakh for 6 months, 7 lakh for 4 months, 2 lakhs for 1 month. This is the interest to be capitalized. And what is the entry you will pass? Cost of building plus interest is the total cost. So building account to bank to interest to bank to interest payable 16 and 75. So actually there is actually the way you should pass interest is not interest payable. So what if this interest to interest payable, and here you should write only interest borrowing cost. Okay, that is the first part. Then CA Vani would conduct the due diligence. So what would be the contents of the due diligence report? So in due diligence report, you have the summary, you have the introduction, you have the background of the company, what is the objective, what is the terms of reference. So this is again a direct question, which I don't think there is a lot to break our head upon. This list will be a part of your notes and you can take it from the notes directly. So these are the various things which can be included. Okay. Now we'll conclude here, but a couple of things. So in this case specifically, if you see, case study, the case study is very, very complex, but the questions to case study are not very complex. Questions to case study are not very complex, so no need to be scared. That is one thing I want to give, I want you to keep in mind. You will be able to manage even if because the questions will be, see, some questions may be complex. I'm not saying all the questions will be easy, but still you will be in a position to, right? So we'll continue tomorrow with the remaining case study. Thank you.
Yeah. Very good evening, my dear students. I hope I'm visible and audible. Please confirm. Kindly please confirm that I'm audible and visible. Yes, perfect. Thank you so much. So come on, my dear friends. In the last session, we have discussed a lot of interesting case studies where we spoke a lot of interesting elements related to direct and indirect taxes. So now today we have got 2-3 more interesting case studies to talk where we get some very good knowledge about these interesting points. So without any delay, let's start the discussion. And I'm sure that you guys are ready for the discussion. Come on, friends, let's start. I'll share the screen. Just 1 second. Friends, is the screen visible for you? Please confirm that. I've shared the screen. Yes, thank you so much. Come on. So friends, look at this interesting case study number 28. It's a very good case law related to a lot of interesting points of taxation, especially direct taxation. So let's see that. Mr. Hari Mehta is an Indian citizen who is based in Thailand for the past 20 years. His father had their family business in India when he graduated, but he chose to do something different and migrated outside India to start a different business abroad and successfully took his challenge. At present, he has his business spread all over the Thailand and now he wants to take the business on a global scale. Being a true Indian he is by heart, the first destination for overseas investment he has chosen is in India. And being a hardcore and experienced businessman, he understands that to successfully venture out of a country with a new business or diversification, one needs to carry out proper research work and get acquainted with the knowledge of laws and the practical working of business at such target countries where one is willing to invest. So the entire paragraph, what they gave is only that there is one person, Hari Mehta. His father had got some family business in India, but he wanted to do something different. So he went abroad, took the challenge and started doing something different. But when he started looking at overseas investment, the first option what he looked at is India for a simple reason because his heart is in India. Next slide. He himself started studying various laws applicable in India relating to nature of his business and further consults CA Vani Mehta, one of his friends' daughter in India, who is an expert consultant in handling international business matters. Very good. Through a video conference, they both discussed how in the present age of commercial globalization, it is a universal phenomena that multinational companies, that is MNCs, have branches, divisions, or subsidiaries operating in more than one country. And in such situation, it is a common event for MNCs to transfer goods produced by a branch in one tax jurisdiction to associate branch operating in another tax jurisdiction. So that means, for example, let us say there is an entity in India and this entity has got one subsidiary or branch office in foreign country. And there is some cross exchange of goods or services between one entity in India, another entity outside India. In other words, there is a cross transaction between one unit in one tax jurisdiction, another entity in another tax jurisdiction, and both of them are associated enterprises. I hope you understood what we are trying to talk here. Obviously, the point what we are trying to talk is very clearly here. Transfer pricing is what we are going to discuss. This case study is a very good case study related to a lot of interesting points on transfer pricing. Next. While doing so, MNC has concerned in mind the goal of minimizing the tax burden and maximizing the profits. But the two tax jurisdictions or countries have also the consideration of maximizing their revenue while making the laws that govern such transaction. It is an internationally accepted practice that such transfer pricing should be governed by an arm's length price, technically called arm's length principle. So the transaction between both entities should definitely be at arm's length price, provided those two of them are associated enterprises. And for associated enterprise, we have got so many points given in the law where there is subsidiary holding or loan is given by one entity to another entity, where the loan advanced is 51% or more of the book value of the assets of the borrower enterprise. Or there is an interesting point where more than half of the board of directors of other entity are appointed by this entity. In all these cases, we'll apply the provisions of associate enterprises and apply the provisions of transfer pricing. Next slide. In other words, the transaction between associates should be priced in the same way as a transaction between independent enterprises. That is what is the whole clear-cut objective behind transfer pricing, where we are looking at something called arm's length price. See, for example, let us say I'm providing some service to a related person. That related person is making payment to me. Let's say, for example, market price for that service is 10 lakh rupees, but the related person is making payment to me only 6 lakh rupees. So in simple terms, the arm's length price is 10 lakh, but the payment what is received is actually 6 lakhs. So from the Indian government standpoint, there is a revenue loss to the government of India. That is the reason why they introduced this transfer pricing provision, where they have specified that the whole idea of transfer pricing is to ensure that we want your transaction should be at arm's length. And if it is not at arm's length, we will consider the arm's length price and do the adjustment. And technically that adjustment is called primary adjustment. And previous session, when we discussed one case study, we spoke about something called secondary adjustment also, where the primary adjustment is more than 1 crore and the amount is not being brought to India. Done. Next, principal governing taxation of MNCs are embodied in the OECD Model Tax Convention on the Income and Capital, which serve as the basis for bilateral income tax treaties between OECD member countries. What is that word, my dear friends? OECD member countries, and between OECD members and non-OECD member countries. According to these guidelines, transfer prices are the prices at which enterprise transfers physical goods and intangible properties or provide services to associated enterprises. Technically, they are related persons, but from transfer pricing point of view, we don't use the word we don't use the word related parties. We use the word associated enterprises. Next. Two enterprises are associated enterprises if one of the enterprise participates directly or indirectly in the management, control, or capital of the other. Or if both enterprises are under common control, that means there is an entity A which is controlling B. Or the situation where A and B both are controlled by C, there is a common control. Next, since international transfer pricing involves more than one tax jurisdiction, any adjustments to the transfer price in one jurisdiction requires a corresponding adjustment in another jurisdiction. If corresponding adjustment is not made, then double taxation will result. Obviously, no doubt about it. He tells CA Vani that he has the following option available with him to invest in India. Option A, acquiring controlling shares in Golden Rivers Private Limited, an associated company of one of his friends. Thai company RPP Limited. It's a company incorporated in Thailand, and 55% of the shares are held by Golden Rivers Private Limited. Good. And the details are given. They give fixed assets, intangible, trading operations, related, unrelated, they have given. But you can see one line. Purchase are from an associated enterprise, sale to unrelated. Sales to associated enterprise, purchase from unrelated. And last case, purchase and sales both are from associated enterprises. And they gave details of payroll expenses also. And they also gave details of total number of employees. Very good, very good. When they gave details of total number of employees and they gave details of incomes, my dear friends, technically, I'm pretty sure that they are going to talk about something called place of effective management. I hope you know very clearly that place of effective management is an important element in order to decide residential status of a company, especially in case of a company, my dear friends. Especially in case of a company, to determine place of effective management, that too in case of foreign company, we say that if the place of effective management is only in India, then it is regarded as resident. If not, it is regarded as non-resident. And in order to decide whether the poem, that is place of effective management, is in India or not, we look at something called ABOI test. One student rightly commented, we look at something called ABOI test. That is called active business outside India. What is that we look at? Active business outside India. You're getting my point of view? And let's say, for example, if the active business is outside India, then we treat that entity as non-resident. And tell me, my dear friends, to treat ABOI test, otherwise, to treat whether active business is outside India or not, what are the conditions we look at, my dear friends? Can somebody please tell me? Point number 1, law clearly says the passive income should not be more than 50% of total income. Passive income should not be more than 50% of total income. And second point, students rightly said assets. The point clearly says less than 50% of assets should be situated in India. Less than 50% of total asset is situated in India. The third point is less than 50% of total number of employees that must be situated in India or should be resident in India. And for the last condition, there's a fourth condition also which says that payroll expenses. Now we're not talking about number of employees. We're talking about payroll expenses. The payroll expenses incurred on employees in India should be less than 50% of total payroll expenditure. So if all these four conditions are satisfied, I repeat once again, if all the four conditions are satisfied, then we will say that the company is having active business outside India. Getting my point? All of us. Very good. And apart from these four conditions, my dear friends, we also look at something interesting point, that is where the majority of the board meetings are held. That is also an interesting criteria what we'll look at. So if the active business is outside India and majority meetings are held outside India, then we say that place of effective management is outside India. And if the place of effective management outside India, then they are definitely regarded as non-resident. This is a very, very, very interesting point related to POEM concept, my dear friends, which stands for place of effective management. Very, very interesting concept. Good. Student is asking a question. What if ABOI fails, but majority meetings are in India? See, generally law says that if all the four conditions are satisfied, it is said that company's active business is outside India. But there's also one more point where they gave in the law, the POEM of a company engaged in active business outside India. That means the place of effective management of a company where the active business is outside India shall be presumed to be outside India. Shall be presumed to be outside India if majority meetings are held outside India. That is also important. So not just active business outside India, we also look at something called majority meetings are held outside India or in India. So they must satisfy four conditions. The four conditions are important to tell whether the active business is outside India or in India. Once four conditions are satisfied, we say that the active business is outside India. Once active business is outside India and a majority meetings are held outside India, we say that POEM is presumed to be outside India. Got it, my dear friend? Yeah, very good. Thank you so much. Next point. CA Vani deliberates on how residential status determination of companies has changed in India recently when he left India to times now, and the importance of concept of POEM, which stands for place of effective management. Mr. Mehta tells CA Vani about his research on foreign companies in India and this POEM concept, and tells that he has studied the business model of two friends of his company. His friend Amit's company AB, saying a US company has its place of effective management also in USA, has advanced a loan equivalent to 255 crores to PQR Limited, an Indian company. And the total book value of assets is 450 crores. And the market value of the assets is 480 crores. and PQ Limited has repaid 45 crores before 31st March 2023. But let me tell you, repayment is not the criteria for us. For us, what is important? Repayment is not the criteria for us. What is important is only that the loan, what one company has advanced to another company, should be 51% or more of the book value of assets of borrower enterprise. That is what we look at. We are going to look at book value of assets of borrower enterprise. We are not going to look at the market value of the assets of borrower enterprise. Next point. His nephew Rahul's company, Kings PLC, a French company having its place of effective management also in France, has the power to appoint 4 of the directors of the Golden Reverse Limited Indian company, whose total number of directors in board is 9. If there are 9 directors and they have got power to appoint only 4 directors, then we say that they are not associate enterprise. Because to call them as associate enterprise, there must be a power to appoint more than half of the board of directors. More than half. Next. Zen Limited is one of his other companies registered in Thailand, headed by his son. The board of directors usually meet and execute business decisions at their board meetings held in India. Option B. Mehta tells CA Vani, one of his associate company, engaged in manufacture and distribution of industrial gases, can acquire a listed Indian company ABC Limited, having a market share of more than 65% of industrial gas, but only after due diligence and all. So this due diligence has got nothing to do with your taxation related part. So I ignore that option B. Moving ahead to option C. Mr. Mehta will get incorporated a new company in India itself at Kolkata as a foreign company which would work under supervision of its Thai counterpart and invest capital in construction of infrastructure. He has worked on this option and tells CA Vani that he has studied the borrowing and finance option. His father's new company has opted for Key Limited, began construction of building at a cost of 14 lakhs. To finance, they have taken a loan at so-and-so interest rate. Outstanding loans were as under. Expenditure income construction is as under. Mehta comes to India for the first time on June 17, 2022 to discuss these options as per their practicality with Vani and her team. And he leaves India on September 29, 2022. He has come to India on June 17, 2022. That too has come to India for the first time. And his total income, other than foreign sources, does not exceed 15 lakh rupees. This point is important because Indian citizen, if he is coming to India for a visit during previous year, we look at some interesting element called 120 days or more during previous year. But that 120 days concept will come into picture only and only in case where total income, other than foreign sources, is more than 15 lakhs. Let's see that. First question. Mr. Mehta would be required to deliver various documents to ROC. Next, what would be the residential status of Mehta for assessment year 23-24? Very, very interesting point. Let's answer that carefully, guys. Come on. First of all, my dear friends, as per section 6.1, an individual is regarded as a resident only if he satisfies any of the basic conditions. Number 1, he must be in India for a period of 182 days or more during the previous year. Number 2, he must be in India for a period of 60 days or more during the previous year and 365 days or more during 4 years preceding the previous year. So basically, these are the 2 interesting conditions which they give in the law. What is number 1? Indian citizen. What first one? He must be in India for a period of 182 days or more during the previous year. Second one is what? He must be in India for a period of 60 days or more during the previous year and 365 days or more during the 4 years preceding the previous year. But one point is very clear, my dear friends. In case of Indian citizen or a person of Indian origin coming to India for a visit during previous year. Only first basic condition would apply. I'm sure this all concepts you would have heard already, my dear friends. Yes or no, guys? Now, first of all, let me go back to the question once and check whether in the question they told whether he's a Indian citizen or not. Because question must tell that he is an Indian citizen. So starting line they told Hari Mehta is an Indian citizen. So in case of Indian citizen or a person of Indian origin, if he is coming to India for a visit, then definitely what will happen is, my dear friends, first basic condition will apply. Come on. When did he come to India? Last line they gave. He has come to India on June 17, 2022 and left on September 29, 2022. He has come to India on June 17, 2022 and left India on which date, my dear friends? September 29th, 2022. And I hope you all know that date of coming and date of going is always included. That's a clear-cut provision in the law. So total number of days in India is equal to June. When did he come, my dear friends? He has come on June 17th. He has come. That means he is there in India in June for the month of 14 days. Correct, right? Plus July 31 days, August 31 days, September 29 days. So total number of days in India is there only for 1, not 5 days. Accordingly, he cannot satisfy the basic condition and shall be regarded as non-resident. Somebody said October 3rd. What is October 3rd, my dear? Oh, you're telling the logic for 182 days and all. Fine, got it. Got it. Done. That's the story of this very interesting MCQ, guys. Moving forward. Under Income Tax Act, ABC Inc. and PQR are what? ABC Inc. and PQR. Let me check. ABC Inc. has given a loan to PQR and loan is 255 crores and the book value of assets is 450 crores. And already told we are not concerned with market value. And what is repaid, that is also not relevant for us. Student asks us, will we not check if total income is up to 50 lakh? 15 lakh in the question only they told that his total income is not more than 15 lakhs. In the question only they told that, my dear friend. Done. Yeah, let me do the working for ABC Inc. to PQR. ABC Inc. has advanced loan to PQR. And the loan given is 255 crore. And book value of PQR is equal to 450 crores. So percentage will be 255 divided by 450 into 100, which is 56.67%, my dear friends. Because we are going to look at the book value of assets, my dear friends. We are not going to look at the market value. And this provision will apply even if there is a repayment of loan. Getting my point? This provision of associated enterprises will definitely be applied even if there is a repayment of loan during the same previous year, my dear friends. Getting what I'm saying? And what I'm going to write here is that since the loan advanced by ABC Inc. is 51% or more of the book value of assets. It's 51% or more of the book value of assets of PQR Limited. They are regarded as associated enterprises. Very, very interesting point. That's the story of this. MCQ number 3. Let me go ahead, guys. MCQ number 4. See, these are some case studies. Look, some case studies are very crazy and very dangerous. You have to be very cautious with them. His nephew Rahul's company, Kings PLC, a French company. Yeah, let me go back to that MCQ 4. Kings PLC and Golden River are what? I told you that Kings PLC has got power to appoint 4 of the directors out of 9. Tell me, guys, are they associate enterprises? 100% answer is no, my dear friends. I clearly told you the logic. Two entities are regarded as associated enterprises only if more than half of the board of directors of one enterprise are appointed by another enterprise. And in the given case, my dear friends, very clearly in the given case, what is the whole point? Kings PLC has power to appoint. What is that they're having, my dear friends? They have got power to appoint. How many, my dear friends? 4 out of 9 directors. Accordingly, they are not associated enterprises. Very, very interesting question. What a lovely case study, man. It takes time. Some case studies will take time, but they're very interesting and important. So what is our option, my dear friends? Associate enterprise, they are not associate enterprises. Independent entities holding subsidiaries specified foreign company. Straight answer, if they are two of them are independent entities. Done. What is the status of Zen Limited as per provisions of Companies Act? That's related to Companies Act. Next, determine residential status of RPP Limited if during 22-23, 8 board meetings were held, 3 in India and 5 in Thailand. So, straight answer, majority of the meetings are held outside India. So, if ABOI test is satisfied, we say that the residential status is non-resident. Because poem of a company place of active management of a company which is engaged in active business outside India shall be treated as outside India if majority meetings are held outside India. Getting the point is everybody? All of us. Good. Vani would conduct due diligence work. Contents of due diligence review report. That's not related to tax. The next one is about borrowing cost. Come on, yes. Let's start the discussion with respect to the active business outside India. In case of foreign company, residential status is determined based on place of effective management. Place of effective management is the basis on which residential status is determined. And for the purpose of determining poem, important element is determining the test of active business outside India. Determine the test of active business outside India. In short, we call it as ABOI. Which point? Company is said to be having active business outside India only if following 4 conditions are satisfied. Come on, guys. What is number 1? Tell me, guys. Come on. Passive income is not more than 50% of total income. Come on, my dear friends. In this question, tell me how much is passive income? Passive income is nothing but, my dear friends, Indian figures are given, Thailand figures are given, fixed asset values are given, intangible assets are given, everything is given. So when do you say income as passive income? So passive income is nothing but your royalty, dividend, capital gains, interest income, rental income. They are called passive income. And passive income also covers where income from the transaction where purchase and sale of goods is from or to associated enterprises. What is that word, my dear friends? Income from transaction where both the purchase and sale of goods is from or to associated enterprises. Come on, friends. In the question, if you see, what is the transaction where both purchase and sale is from or to associated enterprises, which is 12 crores in India, and 24 crores is basically in Thailand. 12 crores in India, 24 crores in Thailand. Total is 36 crores. Then they also gave interest and dividend income, which is 48 plus 36. 48 plus 36 is 54 and 84. 84 crores is this one. 36 crores is your income from transaction where purchase and sale both are from or to associated enterprises. Getting the point? So total figure is 84 plus 36, which comes to 120 crores. 84 plus 36 is 120 crores. And what is the total turnover? Income from trading operation is 60 plus 120, that is 180. 180 plus come on, guys, 180 plus how much? 180 plus 60 plus 120 is 180 plus 48 plus 36. 60 plus 120 plus 48 plus 36. That is your total income. Come on, guys. Total income is equal to total income is equal to 60 plus 120 plus 120 plus 48 plus 36. That is what is the total income. And passive income will be interest and dividend income, wherein interest and dividend together is 48 crores is in India, 36 crores is in Thailand. Correct? Next. Income from transactions where both purchase and sale, where what my dear friends, both purchase and sale is from or to associated enterprises. Income from transaction where both purchase and sale, both of them is from or to associated enterprises. Getting the point, everybody? How much is that figure? 12 crores in India, 24 crores in Thailand. 12 plus 24, which is 36. So total passive income is equal to 84 plus 36, which is 120. And percentage of passive income as compared to total income. 120 divided by 264 into 100, which is coming to 45.4545, which is coming to what, my dear friends? 45.45455 percentage. That means it is not more than 50% of total income. Very good. So first condition is satisfied. Got it, my dear friends? Friends, I'm sure we are getting clarity on this point. Second condition, my dear friends. Less than 50% of total assets. Less than 50% of total assets are situated in India. Let us go back to the question. This case study is taking some time, but no problem. It's an important case study. So please be very clearly. Come on, guys. Please tell me what is total assets. Total assets in India are basically 288 plus 120 plus 96. Total assets in India is equal to 280 plus 288 plus 120 plus 96, which is nothing but 504. 504 crores is the total assets in India. Total assets outside India is equal to how much? 192 plus 480 plus 288 plus 120. That is my total assets outside India. And total assets together is equal to 1584 crores. Correct? Is it so? 504 crores is in India. Thailand is how much? 192 plus 480 plus 288. Oh, sorry, plus 288. That's it. Which is 960, which is 1464 crores. So look at my working, my dear friends, please. This is 288 plus 120 plus 96. This is 192 plus 480 plus 288. Total is 1464. That is in crores. Percentage of total assets in India is equal to 504 divided by total assets into 100, which is coming to 34.4263%. Accordingly, second condition is satisfied. Wonderful. Come on, friends. I hope we are getting full clarity. It's a very brilliant question, my dear friends. Less than 50% of total number of employees are in India. Less than 50% total number of employees are in India. So in the question, if I have to see, my dear friends, number of employees totally are 168 is in India. Number of employees in India is basically 168. And number of employees outside India, that figure is, my dear friends, 216. So total number of employees is equal to 384. So percentage of employees in India as compared to total employees, which is 168 divided by total employees into 100, which is coming to 43.75%. Accordingly, we say that third condition is also satisfied. Then fourth condition, my dear friends. Come on, the fourth condition. Fourth condition is what? Come on. Payroll expenses for employees in India should be less than 50% of total payroll expenditure. That is the point. Payroll expenses for employees in India should be less than 50% of what, my dear friends? Total payroll expenditure. Now let me look at the question. What are the payroll expenses for employees in India? Payroll expenses for employees in India. How much is the figure? It is 19.2, my dear friends. And payroll expenses for employees outside India, that figure is 28.8. And total payroll expenses is 48. Now, percentage of payroll expenses for employees in India is equal to 19.2 divided by 48 into 100. So that figure is coming to how much percent, my dear friends? It's basically working out to 40%. So less than, payroll expense for employees in India is less than 50% of total payroll expenditure. So very clearly we say that accordingly, fourth test is also satisfied. And I would write here, since all the conditions are satisfied, then the ABOI test is satisfied. Hence, the active business is outside India. Since all the conditions are satisfied, my dear friends, we specify that the active business is outside India. Since all the four conditions are satisfied, we would say that the active business is outside India. And since majority of the directors meeting are held outside India, what is that line, my dear friends? Since majority of directors meetings, director meeting means what? Board meetings are held outside India. Poem is presumed to be outside India. Hence, the residential status. Hence, what, my dear friends? Residential status. What is the company name? RPP Limited would be non-resident. That's it. Very, 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 very interesting case study. And I'm sure this case study makes a lot of sense for you, my dear friends, because this has got a lot of concept with it. And it has got a very interesting concept about place of active management, which is very, very important discussion. Are we clear with this? Kindly please confirm. Friends, are we totally clear with this case study? Good, very good.
Let's move to case study number 29. Okay, so here we have three questions which are relevant for us. Again, this is from your favorite section, 135, CSR. So should be easy. Yes, it is easy, and probably you will be able to solve it very fast because it is very similar to what we have already studied. Okay, so MCQ 1. The management of the company needs and helps believes that the CSR provisions are not applicable to it. On discussion with Mr. Kapoor, they approached CA Nayyar to consult the same. What should CA Nayyar take? What should be CA Nayyar's take on whether the provisions of CSR are applicable on this company or not? So simply speaking, you have to check whether this company need and helps. This is a company. Okay, whether this company needs to comply with CSR provisions or not. So for that, we need to see the nature of need and helps. Accordingly, we'll have to select the correct option. Okay. So where is need and helps? Okay. So this is the part relevant for us. Let's quickly read what they are saying about need and helps. Later on, as part of the company's CSR policy, it was decided that for every pack of consumable goods sold, 0.80 will go towards needs and help, which will qualify as CSR spent by this. Consequently, at the end of the year, the company sold 25,000 units, and an amount of 20,000 was recognized as CSR expenditure. However, this amount was not paid to need and helps at the end of the. Does this seem similar? This sounds very similar, no? Yeah, we have just now discussed a similar question. Okay, this company wants to, this company is selling some goods, and for every good that is sold, 0.80 will be given to needs and helps. But at the end of the year, they don't actually pay the amount to need and help. They just recognize it as CSR expenditure. So this is just now what we have discussed. Okay. So here above, I can't locate it, but somewhere here it is mentioned that this needs and helps is a Section 8 company. It is okay. Here it is mentioned. In different language, it has been mentioned. See, it has been doing CSR projects on its own without any requirement legally, along with an established charitable company by the name Needs and Helps. This one line talks about the nature of needs and helps. It is a charitable company. That means it is again a Section 8 company. Okay, so needs and help is a Section 8 company. Now, whether this company, okay, we can skip this. This company, does this have to comply with Section 135? Yes. Even if it is a Section 8 company, it has to comply with Section 135, as we have already discussed in previous question. The next question MCQ is also similar. It says whether this 20,000 rupees will be recognized as CSR expenditure or not. This 20,000 rupees is actually not paid to needs and helps. This is only recognized in the books. So again, this will not be considered as CSR expenditure. Why? Because it is not actually paid. It needs to be spent for qualification, otherwise it cannot be considered as CSR expenditure. These two are very just same, exact same with different names, so we are skipping it. Like, we will not go in details. Let's move on to the relevant question, which is question 7. Okay, now let's read this question. Now please carefully, we are going to read this question, because this question has got nothing to do with the case. So you have to understand this question, then only you'll be able to answer. This case has got nothing to do with this question has got nothing to do with the case. Okay. After the havoc caused by a devastating tsunami in Andaman and Nicobar Islands, a group of companies undertake during the period of this various commercial activities with considerable concessions and discount along the related affected areas. The management of Mahima Consumers Product Limited intends to highlight this expenditure incurred on such activities as expenditure incurred on CSR by publishing it in the financial statement. State whether the management's intention is correct or not. So what is happening? There is a disaster, tsunami. Okay, now what happens? A lot of companies, what they decided that, we will sell them goods. We'll do commercial activity, we'll sell them goods, but we'll give it at a concession or a discount. Okay, so they are doing commercial activity, but at a discounted rate. So Mahima Consumers is one of such companies. And this company says that, okay, we have given a discount. No, we have given a discount. So let's recognize this as CSR responsibility. Let's recognize this as CSR. Is this possible? Is this possible? Can they recognize it? Okay, you guys are saying no, but what is the reason? Why not? Why not? It's business. Perfect. It's ordinary course of business. They are not doing any extra favor. They're giving discounts. People give discounts to increase sale. People give discounts in general. So if it is a normal business activity, okay, in the ordinary course of business, then in that case, it will not be considered as CSR. CSR, you have to do something for the society. All right. So for this, you will have to elaborate this. You'll have to give reference of Section 135. And you'll have to mention that as per, see, this is also mentioned in certain notifications that were issued under section 135. So you can simply mention section 135 and related notification that any activity which is done in ordinary course of business will not be considered as CSR expenditure. Okay, then what is recognized in CSR, that also you have to mention that these activities have to be dedicatedly done for the society. All right. Okay, let's move on. If you want, you can read the detailed answer for this on your own, but that's what it is saying. See, if like in this question, no, there's not much to write. It's a one-line answer. Okay, what will you do now? So for this reason, in the answer, you have to give some introduction. Like, what is CSR? How can we report CSR? So CSR report is made for the public and the society at large. Here CSR report is to be done, CSR has to be done not by just generally any companies, but by those companies that are fulfilling certain criteria. Then only the activities which are mentioned in Schedule 7, they have to be undertaken. Okay, etc. So those basic details of CSR introduction you have to give, and then accordingly you have to say that if it is done in the ordinary course of business, it will not be considered. Then you have to conclude that in the given case, it is assumed that these are commercial activities, normal discount, and therefore the contention is incorrect. This is not CSR. Got it? Can we move on?
Good evening, everyone. So we'll continue our discussion with the subsequent case studies. Let me share the screen. We move on to case study number 29 from the case study digest of November 23. Now, this again has some kind of background followed by subsequent questions. Decade of 90s witnessed the last shift in way of doing business, so on and so forth. So this is more about the what we say liberalization, privatization, globalization part. So, a lot of sectors were opened up. This was in 90s. Then corporates also felt their social responsibilities in this regard, and thus a term was coined by the name CSR. Corporate social responsibility is the initiative to assess and take responsibilities for companies' effect on the environment, social welfare. So again, a lot of literature. Okay, so nothing specific to do with the subject. Here they have explained what is corporate social responsibilities. Then they have mentioned about the Indian scenario. Prior to 2014, they were voluntary, and then subsequently, they just had to disclose, and then there was an amendment, and then they became, they made it mandatory. All of those things again related to CSR. Now, here you see one such company is Mahima Consumer Products Limited, which manufactures consumable goods like bath soap, toothbrushes, soap cases. So this is basically, we say, in the FMCG segment. They have made a remarkable success in recent times, and it has been doing CSR projects on its own without any requirement legally. So that is what is about the company. Then we have a chartered accountant, CA Karan, Nayyar. Now, when you're reading, as I've been telling and I keep on re-emphasizing, the initial part and the last part gives you a sense of what is there in the paragraph. So only after you look at the question, you have to come back. And I'm telling this again and again because that is the way you can cover maximum case study. If you just start reading the case study, then it will be difficult. So Karan Nayyar is a partner of the firm, has been invited for a meeting with the BOD to make them aware of CSR provision. So a lot of things around CSR. Then they themselves have given, and I would be more than happy if in the examination they give the relevant portions of the CSR requirements. Then they have given the taxation aspect, CSR being an application of income, and hence you don't get any deduction under the Income Tax Act. Then you have the meeting of the company with the statutory auditors, and then as per CSR policy, they said so 0.80 will go towards need and helps, etc. Then, so first question on CSR expenditure. Then, what accounting treatment should be suggested to the company relating to the transfer of building? So now we have to go back in the case study and see where they have transferred this building, and when they have transferred this building, what should be considered as our accounting treatment. Okay, so this is the CSR part, CSR policy. They should disclose. Whether any unspent CSR expenditure is to be provided for, an excess amount can be carried forward in the future. So that will be dependent on the respective CSR rules, where they say, okay, what you can set off, how much you can set off, and whether we need to provide for any CSR expenditure. That is, so if you look at the provisions part, if you look at provisions, contingent liabilities, related discussions, if there is a legal obligation to spend certain amount, and if that has not been spent, for that we need to provide for CSR expenditure. Okay, then yeah, here is the part. The company also transferred a small building purchased by it to a school run and maintained by a Gram Panchayat for use as library as a school. So what has the company done? The company has transferred. Sorry. Just a moment. Yeah. So here what the company has done, they have purchased a school, they have purchased a small building which it has purchased, transferred to a school which is maintained by Gram Panchayat. So here the company has a property, plant and equipment. This property, plant and equipment has been given to Gram Panchayat. That is what the question is saying, right? The company has transferred, means the rights of the company has been transferred. Now, the question here is, should this, what is the question here? What accounting treatment should be suggested for the company relating to transfer of building? First, capitalized as a CSR asset as PPE as per Ind AS 16. Now, please understand, to capitalize anything as an asset, I should have a control over that asset. Once I have transferred the asset to Gram Panchayat has a control, so I cannot capitalize. Then, capitalize as a CSR asset as investment property. Again, I do not get any economic benefits from this particular asset, so I cannot capitalize this. Capitalize without any subject classification, incorrect. Charge to the statement of P&L. So the year in which you transfer, you have to capitalize, you have to charge that to P&L, or you have to charge that to income statement, because you will not get any future economic benefits from this particular transfer, right? So I hope that part is clear, very straightforward, that if you transfer any asset as a part of CSR obligations, you cannot recognize this as a property, plant and equipment. It will be an expenditure itself. So you have to recognize an expenditure for that specific part, right? Then CNR said that he would discuss the accounting of the revenue expenditure for corporate social responsibility made in the current financial year with the accounts department in the due course of time. You, being the assistant to CNIR, have been asked by him to provide the accounts department with a brief write-up on the same. So what are they saying? They're saying that he wants to discuss, the CNIR, the partner, he wants to discuss with the accounting team as to how should you account for the revenue expenditure for CSR that you're doing. Now, for this, there is a specific guidance given under Schedule 3. Whatever is the amount which is incurred, whatever is the amount that is incurred on CSR, you have to disclose that as a part of your P&L. Okay, so the amount will be disclosed. Whatever is the expenditure that is incurred, that will be disclosed in the P&L, and any amount you spend, that will be treated as an expense only. You cannot capitalize an amount spent on a CSR activity as your asset. Any amount spent on CSR, if asset has been transferred, then that also will be recognized as your expenditure only. So that is what is the requirement for CSR expenditure. A very simple and a straightforward question. Okay. Now, details of CSR, whatever has been spent or incurred, you'll give it as a note to the financial statement, providing details of how much amount has been spent, how much was required to be spent. All of that has to be disclosed in the P&L itself, right? So either on the face there is no heading, so you will provide it as a subheading or as a note to the P&L. Okay, a simple and a straightforward question. Then after the havoc caused by devastating tsunami in Andaman and Nicobar Islands, a group of companies undertake during the period from October 22 to December 22 various commercial activities with considerable concession discounts along the related affected area. The management intends to highlight the expenditure incurred on such activities as expenditure incurred to discharge corporate social responsibility. So one thing you have to keep in mind is if you are giving some discount, if you're giving some discount on your regular products, if you're giving some discount on regular products, right, that is a part of your operations. So for example, IndigoLearn says, we will give scholarship to some students. That is a part of my operations. I am not doing any CSR activity. I'm not spending. I'm selling my goods at a lower price, but I'm not spending my resources. So this specifically cannot be considered as CSR activity. A simple and a straightforward question, right? Moving on.
Now, without any delay, let's proceed to next interesting case study. I know this case study took some time because there's a lot of important element in that case study. That's the reason why this case study took time. No problem. Not that every case study will be so smaller in size. Some case studies are slightly lengthy, but ultimately the whole objective of this paper is integrated business solution. So sometimes there are some case studies where too much of taxation is coming into picture. And previous session we discussed one case study where only one point was covered in the entire case study related to taxation. So it's not always the same. Yeah. Good. Let's now look at the next interesting case study, my dear friends. Come on, guys. Let's look at the next interesting case study. The decade of 90s witnessed a large shift in the way of doing business in India. The new economic policy of 1991 opened doors of and for the Indian economy to the outside world for interaction and business both outside and inside and outside the country. The service sector grew like anything. India soon proved to the world that it is not limited to agriculture only and that there's much scope for industrialization and tertiary sector. So that's all a story and background what they're giving. The nation saw an upsurge in the global activities and thus its development was fast-paced. But every development has its cost, and that cost which India started sharing with the whole world was overexploitation of natural resources, global warming, ozone layer depletion, pollution, and the list goes on. Whatnot. There are so many natural calamities that went on going and still going on. Now it stands on the same platform as other nations in facing these issues. With the progress the world has been making, it also understood its responsibility to protect the planet from the ill effects of carrying out the road to development and modernization. And so did the corporates. That means ultimately they're going to talk about something called CSR, to talk about something called corporate social responsibility. This much story they told. And already we know from income tax perspective what is the concept. Any expenditure incurred towards CSR is not regarded as expense incurred for the purpose of business, as per section 37. But previous session I told you that if the expenditure is specifically covered in section 30 to 36, then that will be allowed as deduction. Done. So rest all is the story of the CSR. Prior to 2014, CSR activities were voluntary for corporates. With the amendment to Companies Act, they should make CSR mandatorily. Fine. There is one such company which manufactures some consumer products and it has been doing CSR project. And board of directors feel the need to know about CSR provisions. Very good. And for this purpose, they approached Nayyar & Co, a CA firm with an experience of 6 years in CA practice. With 6 years experienced firm, they are getting into understanding about CSR. Got the point, everyone? Next. Karan Nayyar, senior partner of the firm, is invited for a meeting with the directors to make them aware about all the provisions relating to CSR. Everywhere is talking all about CSR and Companies Act provisions. See, directly section 135 is printed in the case study. Net worth of 500 crores or more, turnover of 1000 crores or more, net profit of 5 crores or more. You heard this in company law, right? Please confirm, did you hear all this in company law? Yes, very good. Yeah. Kapoor spontaneously interrupted and appraised the meeting with the fact that amount of 5 lakhs was spent as CSR expense towards education of a girl child. He further explained that company has decided to claim it as expense against profits while computing income for taxation purpose. Can they do all that, my dear friends? Obviously, answer is no. CSR expenditure is never allowed as deduction unless it is specifically covered in section 30 to 36. I believe that we are getting clarity on this point. Majority points are all related to your corporate law. CSR committee shall recommend the board. Okay. The board shall disclose composition of CSR committee. Taxation aspect. See, directly they gave taxation aspect. That is what is relevant for us. CSR expenditure being an application of income is not incurred wholly for the purpose of business. Correct. As the application of income is not allowed as deduction for computing the tax income of the company, amount spent on CSR cannot be allowed as deduction in computing the taxable income of company. Very true. Based on memorandum, explanatory memorandum to the bill, CSR expenditure, which is of the nature covered in 30 to 36, shall be allowed as deduction. Already I told this point to you. And the nature of expenditure is not covered in aforesaid section and is covered by 37. The same is purported to be disallowed. Absolutely correct statement. The meeting concludes with company appointing them as statutory auditors. Later on, as a part of CSR policy, it was decided that for every pack of consumables sold, 0.8 will go towards needs and health, which will qualify as CSR spent. Consequently, at the year end, company sold 25,000 such pack and 20,000 was regarded as CSR expenditure. However, this amount was not paid to needs and health at the end of the financial year. Company has also transferred a small building purchased by it to a school run and maintained by Gram Panchayat. Okay, fine. Section 135, corporate law question. CSR expenditure, corporate law question. What accounting treatment should be suggested? Accounting treatment. Third question is very clearly an accounting treatment, my dear friends. Kapoor tells Nayyar that their company carries out CSR activity from rented premises in Pune. Rent paid for premises disclosed as CSR expenditure and subsequently their company also claimed deduction. Is this permissible? 100% answer is yes. Definitely it is allowed as deduction. The reason because if rent is specifically covered in section 30, this point we covered in the previous case study also. Already we covered. Next point. During the year, company spent certain amount towards education of girl child. Is the treatment as said by the company while computing the income for income purposes valid? Definitely it is valid. Wait a second. Is the treatment valid? They're asking. Come on, guys. Is the treatment valid? This expenditure is very clearly an application of income, but it is not incurred for the purpose of business. Education of girl child. That's what they told me. Somewhere they told this point, education of girl child. Here they told you. He further explained that company has to claim it as expense against profits while computing income for income tax purpose. Can they do that, my dear friends? 100% answer is no. It's an application of income and it is not incurred for the purpose of business. The answer is option E. That's it. Write up about CSR. Very clearly, 7th point is also related purely towards CSR, my dear friends. Section 135 they're talking about. Are we clear with this case study, my dear friends? In fact, a pretty simple and easy case study when I talk from a taxation perspective. From a taxation perspective, my dear friends, it's a very simple, easy case study. See, last case study, how much time it took. And this case study, how much time it has taken. So that's why I clearly told, not that every case study will take some time. Some case studies will be quickly done.
Let's move on. So next case study we're doing is case study 32. So case study 32 has got just one descriptive question. Let's look at the descriptive question. It's descriptive question number 7. Let's read it. Okay. Whether Mrs. ABC can accept the new statutory audit assignments of Big Private Limited as suggested by the management of Big Private Limited. Explain the answer with relation to the Companies Act. Okay, what is it saying? Whether Mrs. ABC, which is some firm, can accept the new statutory audit assignments of Big Private Limited. Okay, so can they accept Big Private Limited's assignment? We just have to check that. Okay, so we'll have to read the relevant facts above from the case so that we can understand what is the context of this. Okay, so let's read. So Big Private Limited, that is the name of the company. Clearly, as you can see, Big Private Limited. So it's a private company. It has got a share capital of 10 lakh rupees. Okay. The company has got a turnover of 100 lakh rupees. Okay. Then ABC Chartered Accountants, Mrs. ABC Chartered Accountants is already doing the statutory audit of many companies, which aggregate to 58. So this Mrs. ABC is already doing the statutory audit of 58 companies. So Mr. Virendra thinks that there is restriction on getting more number of taking statutory audit assignments as per the Companies Act. However, the management of Big Private Limited believes that since the company specifically excluded all the private companies from the ceiling of the number of audits to be conducted by the auditor, that is, an auditor or a firm are allowed to conduct the audit. Okay. Similarly, the Companies Act. Okay, so what is happening here? If you want, you can just read the question. I'll give you the summary of it. See, what is happening? There is this Big Private Limited. This company has got share capital of 10 lakhs, turnover of 100 lakhs. Okay. Now, they want to appoint Mr. ABC Chartered Accountants as their statutory auditor. Mrs. ABC Chartered Accountants is already holding the statutory audit of 58 companies. Now, we know that there is some section which specifies that the firm of chartered accountants or individual chartered accountants, there is a ceiling of number of statutory audits that they can do in a financial year. Is there a section that individually says that, there is a maximum number of statutory audits that can be done by an individual chartered accountant? Yes? Yes. Okay, so that is what it is being asked. So what are you being asked is that can this ABC Limited take the assignment of Big Private Limited? So for that, we have to understand the bifurcation of 58 audits also. So it is given, see, these 58 audits are basically public limited companies are 15, dormant companies are 5, one-person companies are 18, small companies are 12, then private companies having paid up capital more than 100 crores is 3, private companies having paid up capital less than 100 crores is 5. The total of all of this comes to 58. These are the companies for which this firm is already doing a statutory audit. Can this take up one more audit of this Big Private Limited? Okay, so 20, correct? 20 is the maximum limit. Now, this 20 maximum limit of statutory audits that one individual CA can take, it has some exceptions. Some things are not included in it. If you can recall a little bit, one-person companies are not included. Dormant companies are not included. Small companies, if you can remember, these were not included in the limit of 20. Remember? So we'll have to do some calculation. Let's see the exact provision first. So see, here the relevant provision is section number 141. 1 second. So section 141 talks about the maximum number of companies for which statutory audit can be taken. Section 141 clause 3 subclause G is talking about it. It says the maximum limit is 20 companies for an individual auditor. It does not include one-person company, dormant company, small company, and any private company having paid up share capital of 100 crores, less than 100 crores. These four are not included. Okay. So let's do some calculation. See, this Mrs. ABC is saying that it does audit for 58 companies. But we know all 58 are not relevant for us. Public limited companies we will consider, yes. Dormant companies are to be excluded, not to include. One-person companies again not to include. Small companies again not to include. Private companies having paid up share capital more than 100 crores, yes, that has to be included. Private companies having paid up less than 100 crores, again not to include. So this 3 is included in the limit, 15 is included in the limit. So total as per section 141, as per section 141, the limit says 15 plus 3. The limit comes to 18. So this company still has the option of 2 more companies. It can add 2 more companies, right? Now we have to see, can big private limited be included? See, for that you have to check if big private limited comes in any of these categories also. See, it's a private company, we understand, but it has got share capital of 10 lakh rupees and turnover of 100 lakh rupees. So is this a small company? It's not a dormant company. It's not a one-person company. It may be a small company. It also falls in this category. Private company having paid up share capital of less than 100 crores. Okay. So it already falls in one of this category, which is private companies having paid up share capital of less than 100 crores. So it is not included in any of this limit, but it is also a small company. Okay, so you will have to quote the definition of that also. What is a small company? See, small company is defined in section 2 clause 85. It says small company is a company whose paid up share capital should not exceed 4 crore rupees and whose turnover should not exceed 40 crore rupees. Okay, paid up share capital not exceeding 4 crores and turnover not exceeding 40 crores. Also, it does not include any public company. It does not include any holding company, subsidiary company, Section 8 company, or any company created under special acts. That is the definition of a small company. So can we say big private limited is also a small company? Yes. See, the share capital is only 10 lakh rupees, turnover is 100 lakh rupees. So it is below 4 crore, it is below 40 crores. So this big private limited is a small company. And also it falls in this category. Private company having paid up share capital of less than 100 crores. Okay, so I hope you have understood. Now please tell me, can this Mrs. ABC, Chartered Accountants, can this company take up the statutory audit of big private limited as per section 141 and as per the definition of small company? Yes or no? Can it take the statutory audit? I've got one answer. I want others to participate also. Yes or no? Yes or no? Correct. Yes, it can take up the statutory audit of big private limited because any which ways it's a small company. So even if this limit was not crossed, even if this company had more than 20 audits, then also the audit of big private limited could have been taken because we don't have to consider that in the ceiling limit of section 141. Got it? Okay, let's move on.
The next case study we'll take up is case study number 32. So, okay, so that's why I just discussed briefly. Case study number 32. This is about Rahul, who is a manager in a consultancy firm of chartered accountants, Mrs. ABC CA. Over the period of 7 years as a CA, he has worked on various assignments in diversified specialization. They have not been limited to particular profile. So just an introduction, nothing important here. Rahul has been looking on assignments related to Ind AS. Okay. HIMS Limited finance team does not have any experience in the preparation of financials as per Ind AS. So these kind of statements, I really find it funny, saying that the financial team doesn't have. Okay. Him Limited being a listed entity having a net worth above 500 crores is required to adopt Ind AS from 1st April 2021. So now, this date, you assume that this is the date from which they have to adopt. Okay, don't go back and see what is the actual requirement, or if they give, for example, instead of 21, they give 24. You assume that the rules are applicable from 24 in accordance with the company's accounting standards rules 2015. After doing extensive research, they have identified some issues which need specific attention. So entire thing again is pure background only. Okay. Now they have taken various issues. Now these issues, if you see, there is a property, plant and equipment. Then under Ind AS, they have designated mutual funds as investment at fair value through NL. Then you have calculated the deferred tax impact on financial statement due to Ind AS adjustment on the date of transition. So this is more about first time adoption on Ind AS as we look at the question. They have taken a loan from another entity. The loan carries interest rate of 7%, so and so on. Then they have declared a dividend. Then there is intangible assets. So a lot of things have been given here. Now, these are some issues. Then once the assignment related to Ind AS was over, Rahul was told to supervise the internal audit of the company. A freshly qualified CA, Mukesh, and another 3 article assistants are already working on the assignment. So again, there are some issues. They are considering expansions of operations in other part of the country. They want to purchase few properties by sale of existing properties which do not hold much significance. The company has identified a building for sale. So there is some building for sale here. Okay. Then the purchaser has agreed to pay some amount as first installment, and subsequently, if you see, accountant thinks the seller being a company, TDS is required. So finally, they move to taxation provisions and then GST provisions. Okay. Then they transfer 10,000 units of finished stock from factory to retail showroom in Delhi. So generally, branch to branch transfer, it comes mostly in under the purview of your GST part. So as you look at the question, you should be able to figure out, yes, these things are, happening, or these things have impact GST taxation. That is how you have to pick up. Then statutory audit taken by ABC, current date, excluding big private limited, are as follows. So there are public company and dormant 1% small companies. These are to calculate the ceiling limits of the companies of the audit. Okay. Assume that you are Rahul. So you are Rahul, and you are required to analyze the above scenarios and answer the following questions. So many scenarios have been given. First, capital gains. Second, TDS. Third, again TDS. Fourth, again TDS. Fifth, again TDS. So they give so much of information. And if you have been reading all the information, what is being asked is from the TDS. Then, the sixth question, very interesting. Prepare Ind AS impact analysis report of him limited for presentation to the management, wherein you are required to show the corresponding differences between earlier GAAP, that is accounting standards, and new GAAP, that is Ind AS. So earlier, what was the treatment under accounting standard, how that will be transitioned to Ind AS, against each identified issue in the first time adoption and its appropriate treatment thereon on the transition date. So basically, with reference to Ind AS 101, you have to mention that. Show its corresponding impact on the company's financials by measuring its end result in monetary terms due to transition by supporting your presentation with journal entry, which is to be done at the time of transition so as to give effect in the company's financial. Now, it is a very, very long question. Okay. And the solution will also be a long one, right? So, because it is a long question, and I hope they will give appropriate marks for such kind of long question, because they have asked us to prepare a impact, then they have asked us to pass a journal entry and see what will happen. So what we have to do is, for each issue, we will see what is the issue, what is the impact as per the accounting standard, what is the impact as per the accounting standard, what is the impact as per the new accounting standard, right? So this all things you will cover under Ind AS 101. So notes under 101 will provide the guidance of what is to be done. Okay. Now, will such a question come in the examination? Now, if you come back to the issues, we have how many issues? We have 6 issues. So even if they ask this kind of question, at least my expectation, if institute becomes reasonable, they have to give, or they have to give us at least 12 marks minimum 12 marks. So what we can expect is They may take 2 or 3 issues and then ask a smaller question. That is possible. Okay, but it is a very, very lengthy question. So we have to be very careful when we are analyzing the solutions. Okay, so let us handle one by one the issues. First, a part of PPE, company has elected to measure land at its fair value and want to use the fair value as deemed cost on the date of transition. Carrying value of the land on the date of transition is 5 lakhs. Fair value of the land on the date of transition is 8 lakhs. So what does it say? Company has elected to measure land at its fair value. Earlier, what they were doing? Earlier, they were, whether they were doing, fair value or cost, we don't know. We'll assume carrying value on the date of transition. This is the cost part. Land cannot be depreciated. Land cannot be depreciated. So it is not depreciated. So this is the cost. Fair value is 8 lakhs. Now, as per Ind AS 101, PPE on the transition date, you can do either using previous gap. This is previous gap. That is accounting standard, or fair value. Both are possible. Okay, so the property, plant and equipment on the transition date, either you take it at the carrying amount or fair value, at the choice of the entity. Okay, so here the company has chosen to measure it at fair value. Can this be done? Yes, the company can be done. It can be done. So now from 5 lakhs to 8 lakhs, this 3 lakhs of gain, this you will recognize in equity, under other equity, or you will put it under revaluation surplus. So the entry that you will pass will be PPE debit 3 lakhs to OCI 3 lakhs. So this can be done. A very simple, accounting treatment for that part. Then second, under Ind AS, the company has designated mutual funds as investment at fair value through profit and loss. Now tell me, financial assets, we classify using either amortized cost. Now here amortized cost is not there because mutual funds don't pay us interest. Fair value through other comprehensive income, that also will be for your interest bearing securities. Mutual funds, you will always take it as fair value through P&L. Now, as per the existing gap or as per the accounting standard, what is the relevant accounting standard for investment? Does anyone remember? What is the relevant accounting standard for investment? Does anyone remember? Accounting standard. Accounting standard 13. As per accounting standard 13, how do we value investment? Now, there are two categories: current investment, long-term investment. Current is lower of cost or fair value. Long-term will be at cost only, cost or market value rather. They don't use the term fair value, we use the term market value, right? So as per accounting standard, you will measure it at the lower of cost or net realizable value. That also is a appropriate thing. Whereas as per Ind AS, so Ind AS applicable here will be Ind AS 109, and in Ind AS, whatever investments are there, you can measure them at fair value. You will measure them at fair value because you have to measure them at fair value. Cost is 4 lakhs, fair value is 5 lakhs. Now you will measure them at fair value itself. Now this part, increase of 4 lakh to 5 lakh, please understand the treatment or the investment is fair value through profit or loss. Now if it is fair value through profit or loss, if there is any gain, that gain has to be recognized as a part of your retained earnings. It will not go to OCI, because if it was something to do with OCI related transaction, then it is a different thing. Here the fair valuation, the difference, that you will recognize in retained earnings because it's an FVTPL transaction. Okay, so what will you do? Investment you will increase by 1 lakh and you will credit the retained earnings. As simple as that. Third, you have already calculated deferred tax impact on the financials due to Ind AS adjustment on the date of transition. After consideration of possible effect as per Ind AS, deferred tax impact is amounting to 25,000. This amount will further increase the portion of deferred tax liability. There is no requirement to carry out the separate calculation of deferred tax on account of Ind AS adjustment. So they have simply said deferred tax, there is 25,000, right? Now, how do you account for it? Deferred tax liability has increased. So if the liability has increased, you will debit retained earnings and you will credit deferred tax liability by 25,000. That is how you will do. Okay. Now here, what is the note you will prepare? As per accounting standard 22, if you don't remember the number also, it's okay. But I hope all of you remember the number. As per accounting standard 22, we follow the income approach. As per Ind AS 12, we follow the balance sheet approach. Right? That's the only difference. Then the next one. The company has taken a loan from another entity. Loan carries an interest of 7% and it has incurred certain transaction costs while obtaining the same. It was carried at cost in its initial recognition. Principal amount is to be repaid in equal installments over the period of the loan. Interest is payable at each year end. Fair value of the loan on the date of transaction is 180 against the carrying amount, which is 2 lakhs. Now, when you look at the loan related transaction, right? Earlier, as per your there is no specific guidance on loan as such, but if you look at the borrowing cost, the cost incurred to take a loan that is debited to P&L. Whereas, as per Ind AS, you will amortize the borrowing cost, so the transaction cost. So whatever transaction cost is there, that will be used to calculate the effective interest rate. Okay. Now, when the fair value is 180, so when you incorporate the loan, right? Because you cannot go back and reset everything. Once you incorporate the loan, then what you can do is the fair value of the loan, which is our financial liability, that can be considered to be the carrying amount. Okay. Actually, you should have amortized it, but amortization may be difficult. So what you can do? What is the fair value? 1,80,000. This fair value will be the new carrying amount. Now, my carrying amount of loan is reduced. My borrowings have reduced. My fair value of loan has reduced. If the fair value of loan has reduced, I have gained something. So you will debit loan, which is the financial liability, and you will credit retained earnings, which is your, which is the gain that you have realized on this 20,000. So again, here on financial liability, you can consider the fair value on the date of transaction, right? Fifth one, company has declared dividend of 30,000 for last financial year. On the date of transition, the declared dividend has been already deducted by the accountant from the company's reserves and surplus, and the dividend payable has been grouped under provision. The dividend had only been declared by board of directors and not approved in the AGM. However, subsequently, when the meeting was held, it was ratified by shareholders. Right now, if you look at this, the proposed dividend you will recognize in the year in which it has been approved. Now, this is the case in the accounting standard also. Same is the case in Ind AS also. Earlier, we had a thing that, as per earlier schedules, we had to make a proposed dividend when it was declared by board of directors, but that is no longer required. So in both the cases, when it is declared and approved, you will recognize the liability, right? So what happens is, because I have wrongly made a provision, I will reduce the provision. To reduce the provision, I will debit the provision and I will credit the retained earnings by 30,000. Is this part clear? We do not, or we are not required to provide for dividends till the time it is approved by the board of directors. Any questions here? Six, the company has intangible assets as brands and trademarks amounting to 250,000 on the date of transition. Fair value of those intangible assets on the date of transition is 3 lakh. Company wants to carry the intangible asset at 2,50,000. Okay. So if you look at the intangible assets part, now here they're saying they want to carry at 250 only. Is it allowed? Yes, it is allowed. It is the choice of the company. Fair value or the carrying amount. So here, if they want to take the carrying amount, they can take the carrying amount, and hence there is no impact in the financial statements. Okay, so that is as far as the intangible asset part is concerned, right? So these issues you can just explain it. The solutions you can have a look at it subsequently. These issues you will discuss it. No need to remember everything. If you can pass the journal entry and explain the issue, 1 mark plus 1 mark, 2 marks should be given for each issue under consideration. So Yeah, so here they have given each issue with a proper explanation. You can go through it subsequently. Such a lengthy answer is not expected. If you have to write this answer, it will be some 12, 13 pages. Okay, so whatever you can explain, you can put that up.
Yeah, let me open the next case study, guys. Just 1 second. Come on, friends, can I proceed? Please reply. Please reply, my dear friends, can I proceed? Any doubts you're having, you can ask. Or else I can proceed. Please confirm that I can proceed. Please reply, guys, so that I can happily proceed. No doubt. Wonderful. Thank you very much. Come on. So let me talk about the next interesting case study, guys. This case study has got some good elements related to direct tax, and 1-2 points are related to GST as well. So let's see that. Rahul is the manager in a consultancy firm of chartered accountants, namely ABC Chartered Accountants. Over the period of 7 years, since his qualification as chartered accountant, he has worked on various assignments in diversified specialization. Rahul's expertise has not only been limited to particular profile only, but due to his versatile experience with number of has not been limited to particular profile only due to his versatile experience with number of engagements across the industry segments. Recently, Rahul has been looking on assignments related to IndiS. So he has been appointed for a project by his company consultancy firm to work on IndiS. Fine. I'm not talking about the IndiS related elements. IndiS transition, property, plant, equipment, gap, deferred tax related IndiS, carrying value, fair value. Yeah. Once the assignment related to IndiS was over, Rahul was told to supervise the internal audit of a company, Rudra Private Limited. A freshly qualified chartered accountant, Mukesh, and another 3 article works are already working on this assignment. Mukesh has presented 2 noted issues, which requires the consideration of Rahul, 2, for reporting the same internal audit observation, and to inform the management to take right decision accordingly. Issue number 1. Rudra Private Limited is considering expansion of its operations in other parts of the country. Very good. Then, for this purpose, it wants to purchase few properties, thereby the sale of existing properties, which do not hold much significance in operations or other administrative matters. The company has identified a building for sale, which is situated in another area than its present office. During the year, company sold the building amounting to 1 crore in the month of July to another corporate for its office use. Company had purchased this building 5 years ago, which is having WDR 1422 at 40 lakh. Apart from the said building, Rudra Limited has also purchased one more building during the year in its portfolio in the same building of the block for 60 lakh rupees. The purchase of the building has agreed to pay 50 lakhs in first month of October, and the amount was paid in 29th October. Very good. The balance payment is done in next financial year as per the agreement between purchaser and seller. Accountant of the purchaser of the building thinks that seller being a company, its TDS is required to be deducted at the rate of 5%. Absolutely nonsense. We are actually supposed to do TDS at the rate of 1%, because 194 IA. In case of purchase of immovable property, buyer is supposed to do TDS at the rate of 1%. In case where seller is a resident, if seller is non-resident, then 194 IA will not come. Section 195 will come. Already that kind of scenarios we discussed, my dear friends, already. Later, as per the discussion held with both the teams, it was decided that TDS is to be deducted at the rate mentioned in Income Tax Act and its income tax rules in force, and not necessarily the rate recommended by accountant of the company. Thank you very much. Purchaser company has deposited the amount to the credit of government on 27th of November, although TDS has been deducted as per the rates defined in the statute for timing in force. So let me tell you, generally, whatever TDS is done, it has to be paid to the government by 7th of next month. But in case of 194 IA TDS, my dear friends, there is time till 30 days from the end of the month in which TDS is done. So for example, if TDS is done in the month of June, we'll have time till 30th July. The special case where time limit is 30 days from the end of the month in which TDS is done. And this story is only in case of 194 IA. Next. TDS has been deducted at the rates defined in statute for the timing in force. That is neither less nor more TDS has been deducted. And thereafter same has been deposited. Assume that the rate on long-term capital gain is 20% as per income tax rules. So what? Still buyer will do 1% TDS. During the review of transaction in company books of accounts, a team member of internal audit has raised objection for a sale of the land by company. According to him, company should have levied the GST at the time of sale. However, company has not levied any GST. Tell me guys, will GST come? Definitely GST will not come into picture. Why? GST will come into picture only and only in case where there is a construction service. But on sale of land and building, there is no question of GST. Getting my point, everyone? Friends, come on, please reply. Are you clear with this, everybody? Sir, once again, oh my dear friend. So let me tell you, in the question they clearly told that GST is not charged by them. In the previous session, I clearly told you that on sale of land and building, there is no GST because it's neither regarded as supply of goods nor regarded as supply of services. Correct? No, right? Exactly. But in construction service, there is GST, where at least 1 rupee also is received prior to completion certificate. Next point. He believes since company has defaulted in charging GST and recording the same to the government, it may attract further interest and penalties in future. Issue 2. Rudra Private Limited has transferred 10,000 units of finished stock from its factory located in Delhi's Kriti Nagar to its showroom in Delhi's Chandni Chowk so that they can be sold from there. It has taken one registration in the state of Delhi. Very good, nothing wrong. Because I hope you know very clearly that for multiple states, for separate state, separate registration is mandatory. But for multiple place of business, within the same state, separate registration is not mandatory, it is optional. Next slide. And they have declared factory as principal place of business and Chandni Chowk showroom as additional place of business. According to Mukesh, company should have taken 2 separate registration in the state of Delhi, as the scope of GST is complex and wide. Absolutely nonsense. Rahul resolved both the outstanding issues pertaining to Rudra Private Limited accordingly by doing appropriate consultations with his team to reach on conclusions on enforcement. And complete Rahul was back in office to assume seeking the what would be the amount of capital gains for sale of building as per Income Tax Act? Friends, am I audible? Please reply. Am I audible, guys? Please reply. Is it fine now? Can I proceed? Some network instability. I think now it's visible. Can you please check now? Yeah, get back. So first bit they're asking, what is the amount of capital gain for sale of building as per Income Tax Act? First of all, my dear friends, we know very clearly that under income tax law, we come asset by asset, we follow something called block of assets. Hold one building for 1 crore rupees, and the company has purchased building 5 years ago, and the opening WDV is 40 lakh rupees. Here in the same 60 lakh. Friends, is it clear now? Please reply. Is the voice audible? Is the screen visible now? Can I proceed? Yeah. Thank you very much. So now I'll proceed, my dear friends. Thank you. So what is it I was talking? Calculate the amount of capital gain for sale of building. I was trying to tell you that under income tax law, we don't follow asset by asset approach. We follow something called block of assets. And whenever the block becomes empty, that is the time only we say that capital gain will come into picture. Or the block value should become negative, then only capital gain or loss will come into picture. In the given case, my dear friends, there was actually one building which is sold for 1 crore. And that building opening WDV is 40 lakh rupees. But apart from that, we have purchased one more building also during the year. So this block did not become empty at all. When this block did not become empty, my dear friends, there is no question of capital gain that will come into picture. So very clearly the answer is nil, my dear friends. You're getting my point? And this concept, what I'm telling now, is given by section 50. Section 50 clearly talks about capital gain in case of depreciable assets. Very simple point. Second case, calculate the amount of TDS which should have been deducted by purchaser towards purchase of property, my dear friends. Straight answer, TDS will be deducted. TDS is deducted, my dear friends, at the time of making the payment. And what is the story here? 50 lakhs only he paid. At that being on 50 lakh, 1% will be 50,000. So that is a tax that is required to be deducted by the purchaser at the time of making the payment. Clear? In fact, strictly speaking, my dear friends, if you look at the BEAR Act, the language given in the BEAR Act is actually TDS should be done at the time of credit of such sum to the account of transferor or at the time of making payment, whichever is earlier. That is what is the language which is actually given in the law. But the problem here is that in this particular question, they're talking only about assessment year 23-24. And they never told about whether the transaction is recorded in the books of accounts or not. Since that part is silent, my dear friends, That part is silent, my dear friends. We will do TDS at the time of making the payments, and that too will do TDS only on 50 lakh. On 50 lakh, 1% will come to 50,000. So answer will be option C, my dear friends. But strictly speaking, if you look at the Bare Act, TDS is supposed to be done at the time of credit to the account of such payee or at the time of payment, whichever is earlier. Done. Next point. In which form the details regarding the transaction of sale of goods and corresponding details required to be furnished. So let me tell you, there is a form called Form 26 QB, and that is clearly to be filed within 30 days from the end of the month in which TDS is done. So 30th November, by that date, that is required to be paid to the government, my dear friends. Next, in the question, when did he deposit? He has deposited by 27th of November. So that means he is very much within the time limit. Calculate the amount of interest Rudra Limited is required to pay. The interest will be 0 because he has anyways paid within the time limit. When he has paid within the time limit, then where is the question of paying that interest? Next. Calculate GST liability should have been able at the time of sale of land. I already told you that on sale of land and building, there is no question of GST liability, my dear friends. There is no question of GST liability on sale of land and building because sale of land and building is neither regarded as supply of goods nor regarded as supply of service as per Schedule 3. Next point. Descriptive question. First one is Ind AS. Second one is auditing, and whether the stock transfer is regarded as supply. Generally, if there is supply between distinct person, that is regarded as supply. But here, this is a question where there are two units which are in Delhi only, and one is principal place of business, other one is additional place of business. If there is a transfer of goods from principal place of business to additional place of business, that is not regarded as supply. If there would have been two separate registration, then definitely I would have told the answer is supply. If not, the answer is not a supply. So that's the story of this very interesting case study. Got it, my dear friends? And that's about case study number 32. That's it. So friends, what we'll do is we'll stop here for today. Next session only I'll discuss something very important. In fact, next session we are going to discuss one case study which has got a lot of interesting elements related to your tax audit, especially your Form 3CD. Lot of interesting elements of Form 3CD are covered in that case study, and that case study will take some sweet time. Even if I start that case study now, I cannot complete that. That will take some sweet time. That's the reason why we'll do that case study separately. Okay, good. Student is asking, sir, MSME. What is your doubt on MSME, my dear friend? MSME 3CD. Yeah, that also will discuss. Don't worry. So we have got a lot of interesting points in 3CD. All those interesting elements we'll talk in the next session. Very, very important session. So please don't miss the next session. Somebody is asking, sir, do we have to write explanation for our choice taken in MCQ question in the answer sheet? It's always advised to write when if it is if it's a case where you are just selecting your option, wherein you are just circling the right option in a OMR sheet, then in that case it is not required. But where you are not circling, you are writing the answer for the option, then it's always advised to write some explanation for that. And obviously, I'm sure you guys know that they will not provide OMR sheets. So you have to write an explanation. Somebody is telling, if institute permits, I'll make a video call during exam time. Oh my God. Institute will not permit whatever we like. Done. Thank you so very much, guys. Take care. See you all in the next session. Shivateja signing off. Thank you so much. Bye-bye.